Let's now quickly revise the topic of Introduction to Accounting Standards. Before we learn the word accounting standards, we need to know what we mean when we use the word generally accepted accounting principles. Generally accepted accounting principles are there in every country. These are what are issued as accounting standards by that country's regulating authority, or what are not issued as accounting standards but are followed by the people of that country very strongly. So generally accepted accounting principles are authoritative standards or commonly accepted ways which the people of that country follow for recording and reporting their accounting information. In our country, generally accepted accounting principles which are authoritative, meaning issued by the regulatory body, are two. One is accounting standards, the other one is Indian accounting standards. Why do we have two? We initially had only accounting standards, but to meet the global pressure, to meet the reporting standards what is globally followed, we have started converging with IFRS, implementing IFRS, which is global generally accepted accounting principles, in the Indianized way, that is Ind AS. Right now, accounting standards is followed by non-corporate entities, and few corporate entities have been following Ind AS based on the regulatory requirements, which I'll teach this to you in the little later part of the same video. So all the non-corporates follow accounting standards. Corporates, some follow Ind AS, some follow AS. And Ind AS is Indian version of IFRS, which is International Financial Reporting Standards. What do we mean when we say accounting standards? Accounting standards are written policy documents. This can be issued by three. One, government. Two, expert accounting body. Three, other regulatory body. Government is like MCA, Ministry of Corporate Affairs. When I use the word expert accounting body, I mean accounting standard board. And when I say any other regulatory body, any other body which is created time to time will also have the power to issue accounting standards. Whenever they want to issue accounting standards, they cover four important aspects. RMPT, recognition, measurement, presentation, and disclosure. We remember this in a really fun way, which goes like Akshay Kumar doing Sing is King, followed by Shah Rukh Khan's ideal step. Then you do Disco Divani and then match up the entire scene. It goes like accounting standards are issued by government, expert accounting body or other regulatory body, covering the aspects of recognition, measurement, presentation, and disclosure. And whenever they issue these are applicable for recording all the transactions and events as a normal preparation of accounting and also preparation of financial statements. Why do we issue accounting standards? We issue accounting standards because globally, say even in national way, people don't have standardization, people don't have uniformity, no comparison, no reliability. So these are the problems that people will face in preparation of accounting. Everyone follows different accounting policies. To bring them all to one place, there is one reporting standard issued which says this you also follow, I will also follow. All of us will follow one. So that the financial statements what are prepared based on this are uniform, are standard, are reliable, and are also comparable. So the objective of issuing accounting standards is to bring in comparability, to bring in uniformity, to bring in standardization, and to increase reliability on the financial statements. What is the process of setting? You identify the area where there are a lot of accounting policies. Goodwill valuation, fixed assets valuation, inventory valuation, recognition of provision. These are the areas where there can be different methods, different varieties, different policies. You identify the problem area. You create one study group to study this. They'll come out with one exposure draft, possible solution. That possible solution will be given to different bodies for review, like SEBI, RBI, SBI also will review, big industrialists, ICI if it is issued by any other body, or ICWA, that Cost Works Accountant or Cost and Management Accountants of India, ICSI, they'll issue to all these bodies. Everyone will give their reviews and then they will tell what is okay, what is not okay. Once that is done, that changes will be made, then they'll give it to public domain for people to publicly give their comment and opinion, which if it is found valid, it will be considered and the final draft will be issued and that becomes accounting standard. That is the standard setting process. And standards in our country, in India, are issued by MCA, Ministry of Corporate Affairs, that is by Companies Act. These are applicable for companies. But for non-corporate entities, MCA cannot issue accounting standards. Their ICAI's accounting standard board comes into picture. Accounting Standard Board of ICI will issue accounting standard for non-corporates, and MCA will issue accounting standards for corporates. Both are same. There is no difference. And the drawback of accounting standards is it cannot override law. It has to be within the jurisdiction of. So we have so far discussed accounting standards, Ind AS and IFRS. Everything looks similar, but has its own differences. Now let's see the global part after we saw the Indian side of. Why are we going to converge with IFRS and follow Ind AS? What was the need? We had our own accounting standards. Why was the need for Ind AS to be, I would say, propagated or to be brought into force? This is because whenever you seek investment from global companies, or whenever you invite companies from outside India to come do business in India, you want to help them understand again as to what are the reporting requirements of India. So they need to know reporting standards of India and they need to know reporting standards of their country. And both of them might not be same. There is again comparability issue, standardization issue, reliability issue, no uniformity. To bring in uniformity, reliability, standardization, comparability in the global outside, internationally, there was a body set up called as International Accounting Standard Committee, IASC. This started issuing international accounting standards, and this was supposed to be followed internationally, but it didn't become international till 2001. In 2001, 1st of April, this IASC was reformed into a new body called IASB, International Accounting Standard Board. This IASB started issuing same international accounting standards under new name called as IFRS, International Financial Reporting Standards. This got global acceptance and lot of countries started accepting it, including our friendly neighbor. But we kept on thinking, can we accept? Is it applicable? Is it completely our type? Then we understood that we cannot accept that IFRS vis-a-vis same to same. So we decided to make some changes. We added some Indian flavor to it for gardening. We removed some things what we don't eat from that pizza or which is made international. So whatever we removed is carved out from IFRS. Whatever we removed is carved out. We removed it saying this is not applicable. I won't follow. Whatever we added, our version of it became carved in. So IFRS minus carve out plus carve in is Ind AS. What is it? So ever since that we follow Ind AS. That's how we've conversed with IFRS. We have conversed with IFRS, not fully adopted the IFRS. How is IFRS adopted in India? IFRS in the converged form in Ind AS works like this. If it is IFRS 1, it becomes Ind AS 101. If it is IFRS 2, it becomes Ind AS 102 and vice versa. Similarly, the rest of the numbers are placed. And what is the roadmap for implementation? In 2015, 1st of April, on voluntary basis, Government of India told any company in India who is willing to become the lab rat, who is willing to comply with Ind AS, you can do. In 1st of April 2016, it was no more voluntary. They made it mandatory. For whom is it mandatory? If the company is listed or it is in the process of getting listed, or its net worth is greater than 500 crores, or its parent, subsidiary, associate, joint venture is one of the two conditions, is fulfilling one of the two conditions, then you are supposed to mandatorily follow Ind AS from 1st of April 2016. This is phase 1. In phase 2, that is starting from 1st of April 2017, they told mandatorily you are supposed to follow Indian accounting standards if you are listed or in the process of getting listed. However, exemption is there for if you are listed or in the process of listing in SME stock exchange. Small and medium enterprise stock exchange, if you are listed, Ind AS is not applicable to you based on listing conditions. Based on other conditions, you can still become applicable or you can voluntarily take it up. Got it? When we say listed or in the process of listing for applicability of Ind AS, it is other than SME enterprise. Yeah. So from 1st of April 2017, you are mandatorily supposed to come under Ind AS if you are listed or in the process of listing in other than SME. Your net worth this time need not exceed 500. If it exceeds 500 crores, 250 crores also, okay, Ind AS is still applicable. Or parent, subsidiary, associate or joint venture of any of the, for them it's mandatorily applicable. And this is introduction to accounting standard with the topic of Ind AS.
Let's quickly revise chapter 2 of our syllabus, which is framework for preparation and presentation of financial statements. The components of financial statements are four: balance sheet, statement of profit or loss, cash flow statement, and notes to accounts. Significant accounting policies, statements showing changes in equity are also part of financial statements, but however not mentioned here. There are a lot of people who are dependent upon these financial statements for their day-to-day operations or their decision making. People like investors, whether to invest in the company or not, they decide looking at your financial statements. Same applies to your employees, and same is the case with the people who give you money, borrowers, lenders, and also the people who have do business with you, people who basically sell the goods to you, and also the people who buy the goods from you. Financial institutions, government, all of these people are dependent upon your financial statements to understand your credibility. So these are the users of financial statements. Whenever you prepare financial statements, we need to always prepare it based on these three fundamental accounting assumptions. What are the fundamental accounting assumptions for preparation of financial statements? Going concern, accrual, consistency. These are the same what we discuss in accounting standard 1 disclosure of accounting policies also. Here also we tell that fundamental accounting assumptions is going concern, accrual, and consistency. Whenever an organization starts preparing its financial statements, it should ensure that, or it will always assume that it is going to survive for the foreseeable future, or it is going to continue to the foreseeable future. So there is no intention or there is no necessity to shut down its operations in the near future. Whenever the organization is a going concern, then the items will be represented at their original cost or historical cost, non-current items. Current items based on the standard that is applicable. But whenever the financial statements are prepared for an entity which is not a going concern, in the going concern ಮೇಲೆ ಒಂದು question mark ಬಂದ್ರೆ, then all the assets and liabilities should be shown at fair value. Get it? If it is a going concern, then non-current assets at historical cost, current assets at settlement price or cost, whichever is less. Different standards will apply. There are different valuation principles when the organization is going concern. However, when the organization is not a going concern, put all the standards aside, do valuation of all the items in the balance sheet, all the assets and all the liabilities. At what value? Very good. Then accrual means the transactions in these financial statements are recorded as and when it has appeared, as and when it has occurred, and not necessarily when it is affected in cash. If there is an expense incurred during the period, though it is not settled, it will appear in the financial statement as an expense in P&L and as a liability in balance sheet because it is not paid. It is not like expense will be written only when it is paid. Got it? Last one is consistency. When we prepare financial statements, we can definitely compare this with our previous year financial statement because we have prepared these financial statements based on the same accounting policies and principles what we followed in the previous year also. Understood? Then we discuss the qualitative characteristics of financial statements. Financial statements are prepared for the purpose of understanding, and the relevance of it is it will help us get the timely information, and also it will help us identify the benefit and cost analysis. How much benefit do I get, or how much cost I have incurred in acquiring the company's shares, or how much cost I have incurred inside the company, how much benefit am I getting it from the company by way of EPS. Then comparability. It will help me compare the business not just with its previous year but also with its competitors in the industry. And lastly, reliability. If I have to trust a company's progress, that is based on the financial statements which are audited and the audit report. For auditor to audit, first the financial statements have to be prepared. So financial statements which are audited helps me rely upon the progress of a company or rely upon the information that is provided by the company. Talking about how the items will be presented in the balance sheet, there are four measurement techniques. What are they? Historical cost, current cost, realizable value, present value. Historical cost is the cost that I paid to acquire a product. When I purchased that asset 5 years ago, 4 years ago, whatever I paid that day becomes the historical cost. And the same product, what is the price of that product today is my current cost. The asset that I already have in my balance sheet, what is the current market price of that product? That's current cost. If in case I buy that asset today, the price that I pay is current cost. The price that I paid that day is historical cost. Today, if I decide to sell that asset, how much money will I get is my realizable value. I'll repeat, The money that I paid to buy the asset 5 years ago is historical cost. Same asset, same model, if I have to buy today, what I should pay? Current cost. If I sell the asset what I bought 5 years ago today, the money that I receive is realizable value. Using this asset in the next 3 years, in the next 4 years, what cash will I generate? That becomes my cash inflows. If I discount it to today's date, the present value of the future cash flows this asset is going to generate will become my present value of the asset. Based on the situation, circumstance, and the applicable provisions of the applicable accounting standard, you will decide which value to use for which item in the balance sheet. But these are the four valuation principles. Last part of this unit is capital maintenance. The objective of capital maintenance is ensuring that we do business in this year at the same level at which we did business last year. Last year we had capital of 10,000 units. This year our capital should not go below 10,000 units. Irrespective of what is the market price, I should be able to do the business at the same level, not at a higher level, at least at the same level. When I say level, I'm not talking about amount, I'm talking about units. I'm talking about units in stock. So this is to ensure that we don't withdraw capital. And a businessman can withdraw his drawings by way of profit, but not eat into the capital. So this is ensured by capital maintenance. Here they tell how much is the capital that should be maintained. How much is the capital that should be? Very good. So there are multiple ways. First one is financial capital. Second one is physical capital. Under financial capital, we have two. One is historical cost. Second one is current purchasing power. Historical cost is based on an assumption that the price that was there at the beginning of the year is the price that is there at the end of the year. Price that was there at the beginning of the year is the price that is there at the. What is my opening stock in units? I'll determine that. Multiply that with the historical cost what was there at the beginning. 10,000 units, let's say. Beginning of the year rate is 10, end of the year rate, I don't care. I'll take the historical cost rate of 10 only. 10,000 units were there at the beginning, 10 rupees per unit is the rate at the beginning, multiply. 1 lakh should be the capital that I should maintain. From 10,000 units what I had at the beginning, when I sold these units, let's say I've sold these at 11 rupees. So 10,000 units into 11, I've got 1 lakh 10,000. The capital that I should maintain is 1 lakh. But I have 1 lakh 10, I can withdraw 10. If I withdraw 11,000, my capital will become 99. There is negative retained earnings of 1. I have overdrawn my capital. So the closing capital to be maintained is computed using the historical cost. That is the first method. Under the second method, current purchasing power, we always take 100 as base price. They'll tell you the purchasing price index at the end of the year. They say purchasing price index at the end of the year is 120. If they say 120, it means whatever is 100 rupees at the beginning of the year is 120 rupees at the end of the year. Opening capital was 10,000 units at rupees 10. 10,000 units at rupees 10 is 1 lakh. 1 lakh at the beginning of the year is equal to 100 rupees at the beginning of. At the end of the year, let's say the price index has become 120. So we do 1 lakh opening capital into 120 divided by 100. That gives me capital to be maintained as 1 lakh 20. What is the capital to be maintained? How do we determine capital to be maintained under current purchasing price? Very simple. Opening capital multiplied by closing price index divided by base price, that is 100. So we got 1 lakh 20,000. That should be the capital to be maintained. After I sold those units, let's say I realized capital of 1 lakh 25. The selling price of all the units, cash and other assets that I have with me is 1 lakh 25. Capital that is there closing is 125. Capital to be maintained is 120. 5,000 is available for withdrawal. Get it? What if I withdraw more than 5? Then my retained earnings is negative. What if at the end of the year, the capital that is there is only 1 lakh 18? Capital to be maintained is 1 lakh 20. I have 2,000 deficiency in my capital. My capital is less by 2,000. We call it negative retained earnings. This is the second method which is called as current purchasing power. Then we have the last method called as physical capital maintenance. Under physical capital maintenance, we do it like historical cost. But the rate that we apply will be closing rate. Beginning of the year I had 10,000 units and the opening rate was 10 rupees per unit. I want to maintain enough capital to buy 10,000 units in the next year. For that, I will take the closing rate. Beginning of the year rate is 10. Let's say closing rate is 12. I'll do 10,000 units multiplied by 12 rupees per unit. How much is 10,000 into 12? 1,20,000 is the amount of capital that I should maintain at the end of year to do same business next year. Let's say my capital at the end of the year is 1,10,000. I have shortage of 10,000, which is called as negative retained earnings. What if I have 1,25,000? 1,25,000 closing capital. Capital to be maintained is 1,20,000. 5,000 can be withdrawn. I'm not telling should be withdrawn. 5,000, it is available for withdrawal as profit. And that's our physical capital maintenance. And this is the complete discussion on framework for presentation and preparation of financial statements. Let's now quickly revise applicability of accounting standards, which is chapter 3 from your syllabus. The references to accounting standards is given in Companies Act 2013, and this is what mandates preparation of financial statements in compliance with accounting standard. Firstly, section 129, which talks about financial statements, subsection 1 to this section says that whenever a company prepares financial statements, it should be in accordance with accounting standards. Section 129 subsection 5 tells that for a company, when an accounting standard is applicable, if it does not follow that accounting standard, if there is any deviation, it has to very clearly mention such deviation from accounting standards. Same is also mentioned in accounting standard 1. Then let's talk about section 133. Section 133 is the list of accounting standards that is notified which a company should follow. It is notified by NFRA, National Financial Reporting Authority. Then we'll talk about the director's responsibility in preparation of financial statements and auditor's responsibility. Director's responsibility is given in section 134. Section 134 subsection 5 talks about director's responsibility statement. Under that, clause A tells us that director's responsibility statement, it is mandatory for the directors to say that they have fulfilled their responsibility of preparation of financial statement in compliance with accounting standards applicable to them. Further, under section 143, when the auditor releases its duties and responsibilities, an auditor under subsection 3 to 143 and then clause E, he has to ensure that financial statements which is auditing is in compliance with accounting standards. If not, he has to mention in his report such deviation. He has to qualify his opinion also if in fact the accounting standards are not followed by the entity. For the purpose of checking applicability of accounting standards, we need to remember that there are two governing bodies. One is MCA, Ministry of Corporate Affairs, or NFRA. That is as per Companies Act. The second aspect is ICI, Institute of Chartered Accountants of India. All the corporates, that is companies, are regulated by NFRA provisions, that is Companies Act provisions. However, all the non-corporate entities are regulated by ICI, Institute of Chartered Accountants of India. As per MCA's notification, the classification of business enterprises is into two categories. One, small and medium company. Second one, not small and medium company. SMC and non-SMC is what we call. However, as per ICI, it is classified into four categories. Level 1, Level 2, Level 3 and Level 4. Level 1 under ICI and non-SMC as per Companies Act classification are same. SMC classification as per Companies Act is divided into three sub-classifications by ICI, that is Level 2, Level 3 as well as Level. Why do we basically classify these business enterprises into non-SMC and SMC or into level 1, 2, 3, 4? Because if it is a non-SMC, that is it's not a small company, meaning it's a big company, all the accounting standards are applicable. Out of 32 accounting standards, 30, 31, 32 are removed, 8 and 6 have been withdrawn. So remaining 27 accounting standards are applicable completely to a non-SMC, that is to a large company. Meaning for a level 1 enterprise, as per ICA classification, all the accounting standards are applicable. If you are not a non-SMC, that is you are an SMC, certain accounting standards are not applicable to you. Certain accounting standards are relaxed. Not applicable means you don't have to follow that accounting standard. Accounting standard 17, segment reporting. Relaxation means that accounting standard is applicable, but certain paragraphs of that accounting standard need not be followed by you. For example, 15, 19, 20, 28 and 29. That's the exhaustive list of accounting standards against which there is relaxation to a small company. However, with regard to level 2, level 3, level 4 companies also, the list is given here. What standards are not applicable, what standards are applicable partly. Meaning where is there an exemption and where is there a relaxation. You don't have to mug these up. As and when you read a standard in your syllabus, check whether that specific standard is applicable to all forms of entities or only certain classes of entities. Then We'll go ahead and then see how do we tell whether an entity is SMC or non-SMC. How do we tell whether an entity is level 1, level 2, level 3 or level 4? Right now, there are two different tables, two different classifications. I put all of them together to prepare one master chart. Using this, you will understand in entirety. First, we will see only non-SMC and SMC. This is classification as per Companies Act. There are only two classifications, non-SMC and SMC. This is as per Companies Act. Non-SMC means big company. SMC means small and medium company. Your company is listed or in the process of listing, shares or debentures, whether in India or outside India, your company is not a small company. It is non-SMC. Let me repeat. Your company is listed whether in India or outside India, shares or debentures, then it is non-SMC. It is not a small company. If it is not listed, yes, if it is not listed, it's debenture. It's not listed in India. It's not listed outside India. It is not even in the process of getting listed. Then it is eligible to become SMC. It is not SMC. Why? We need to check other conditions. Second condition is about business, what the company does. If the company is doing the business of banking, including cooperative banks, it is doing NBFC business, it's doing insurance business, or it is any other financial institution, then it cannot be called as SMC. It will be non-SMC. In order to be called SMC, it should not be doing banking, it should not be cooperative bank, it should not be NBFC, it should not be financial institution, it should not be doing insurance business. Then you are subject to other two conditions based on borrowing and turnover. And lastly, the holding criteria to be decided as SMC. Then we'll check the turnover. Turnover of the company, if it is greater than 250 crores, then you are obviously not a small company. If it is 250 or less than 250, then you are eligible to be called as an SMC subject to other conditions. What if it's exact 250? I told you, if it is 250 or less than 250, it is eligible to be called as a small company. And turnover, when we say, we see the last year's turnover. And this is revenue from operations, including other income in your P&L. Then we'll talk about borrowing. If you're borrowing at any point of time during the year, it is greater than 50 crores, then you are not a small company anymore. You are a large company, non-SMC. If it is equal to 50 or less than 50, then you can be called as a small company subject to other conditions. Last point is, if your holding company is not a small company, you are also not a small company. If your subsidiary company is not a small company, you are also not a small company. Why? If you have a holding or subsidiary, you have to do consolidation. To do consolidation, accounting policies and accounting standards followed should be same. If you are not following certain accounting standards, if your holding company is following certain accounting standards, it is difficult for consolidation. So if your holding company is not a small company, though you fall in the criteria of small company, you will be called as not a small company and all accounting standards are applicable to you without any relaxation, without any exemption. This is as per Companies Act. Then let's talk about ICI, level 1, 2, 3, 4. Level 1 is same, that is non-SMC, not listed, not in the process of listing, whether shares or debentures, whether India or outside India. Not doing banking business, not doing cooperative business, not an NBFC, not a financial institution, not an insurance company. And turnover is more than 250 crores. And borrowings more than 50 crores. And your holding company is level 1 enterprise. Then you are level 1 enterprise. If you are listed or in the process of listing, if you're doing banking, NBFC, financial institution or insurance business, or your turnover is greater than 250, or your borrowings is greater than 50, or your holding company is level 1 entity, then you are a level 1 entity. However, in order to be level 2, level 3, level 4, that is MSME, my medium company, small company or micro company, should not be listed, should not be in the process of listing, whether shares or debentures, whether India or outside India. You should not be doing banking business, you should not be doing NBFC, you should not be insurance company, you should not be financial institution. It comes down to turnover, borrowing, and who's your holding or subsidiary company. If your turnover is 50 or less than 50, but more than 10, you are level 2. If it is 50 or less than 50 crores, more than 10, you are level 2 enterprise. If it is 10 or less than 10, but greater than 2, level 3 enterprise. Lesser than 2, level 4. Turnover, it is not more than 250. If it is more than 250 or level 1, it is 250 or less than 250, but it is greater than 50. Then it is level 2. If it is 50 or less than 50, but greater than 10, level 3. If it is less than 10 or equal to 10, you are level 4 enterprise.
Lastly, we should check your holding company. If your holding company or subsidiary company is level 2, even if you are level 3 or level 4, you will become level 2. If your holding company is level 3, you are level 4, you become level 3. You will only go up the ladder. You are level 2 enterprise. Your holding company is level 3. Will you become level 3? No, no, no. Your holding company will become level 2. That's a very weird scenario, not possible, but it's only way upward. And this is how you check whether accounting standards are applicable to your company or not. If it is applicable, are there any exemptions or are there any relaxations based on the level in which you belong? Got it? Good. Hello guys, come on, let's quickly revise accounting standard 1, disclosure of accounting policies. To start with, what exactly do we mean when we say accounting policies? Accounting policies are accounting principles and methods of applying these accounting principles in preparation of our financial statements. You cannot complete your financial statements without coming across accounting policies. In various segments of preparation of financial statements, you will surely come across accounting policies. To give some examples, whenever you're valuing inventory, which method of accounting policy should you apply? Which method of valuation of inventory should you apply? Should you pick first in, first out? Should you pick simple average method? Should you pick weighted average method? Accounting standard 2 tells that you can pick between FIFO or weighted average method for items which are ordinarily interchangeable, and specific identification method for items which are not ordinarily interchangeable. These two options, what accounting standard 2 provides us, among which we can pick one, is an accounting policy. Similarly, in terms of valuation of fixed assets, there are two models which accounting standard 10 PP prescribes. We can either follow cost model or we can follow revaluation model. Whichever one you pick is your accounting policy. So in this way, whatever the policies which are given as an option by the standard for us to follow is our accounting policies. So accounting policies, as I just mentioned, it is significant accounting principles and methods of applying these accounting principles in preparation of financial statements. Similarly, in investment accounting, you have an again option to do FIFO or weighted average method. When you are trying to value retirement benefits, again you have option. All of these options together is what we call as accounting policies. Now, how to pick among these several options that we have? We have two considerations. One is primary consideration, second one is secondary consideration. Primary consideration is very simple. We need to keep our financial statements true and fair. In order to keep the financial statements true and fair, whichever accounting policy gives us the best results, we follow that accounting policy. If both the options that we give, both the options that we have are giving true and fair view, then we go to secondary consideration. Secondary consideration are three. 1. Prudence. 2. Substance over form. 3. Materiality. It is not one of these, but all the three of these have to be considered. Prudence. By prudence we mean practicality. We need to be very practical when you do accounting. An example for prudence is conservatism. We need to account for expenses as and when we incur, and we need to account for losses even before it materializes. However, if you expect an income, it is not conservative to record it till the time it materializes. So by prudence we record profits and assets only when we acquire them, but we record the losses even before we actually incur that loss. So we are trying to record our profits and assets at not an overstated value, but if in case we expect a loss or we have a liability, we don't want to understate it. That's the concept of prudence. And when it comes to substance over form, we need to ensure that we record the items by their reality and not just by legality. If in case you buy an asset but it's not registered in your name legally, just because it is not registered in your name legally is not a sufficient area for you to postpone the recognition of the asset. Asset has to be recognized based on substance over form. Wherever there is a clash between accounting reality and legality, accounting reality will win over the legality, and you need to go by the reality in accounts to record the same. We'll have an instance of this in accounting 4 also, accounting standard 4 also, and you'll read this in multiple other places. And the last one is materiality. Materiality is we need to disclose all the items which are going to have substantial or material impact on the user. Now, by disclosing this information, the investor will take a different decision, and by not disclosing this information, an investor will take a different decision. In such a scenario, it is our responsibility when we prepare financial statements to disclose all such information which is material and necessary for the user to take his decision. So I'll quickly run you through everything what I just told now. The basis to decide accounting policy are true. The primary consideration is to ensure that the financial statements have true and fair view. The secondary consideration is prudence, substance over form, and materiality. Next, there are certain assumptions given under accounting standard 1, which are called as fundamental accounting assumptions. These are going concern, accrual and consistency. The reason why these are called as fundamental accounting assumptions is whenever we follow going concern, whenever we follow accrual system of accounting, or whenever our accounting policies and principles are consistent, there is no need for any separate disclosure. However, when we don't follow going concern, when we are not following accrual system of accounting, or our accounting policies followed are not consistent, then it is our responsibility to disclose that we are not following going concern, we are not following accrual system of accounting, or this specific accounting policy is not consistent. So with regard to fundamental accounting assumption, no disclosure is required when it is followed. However, disclosure is required when it is not followed. All of these significant accounting policies, what we call as SAP, is followed in preparation and presentation of financial statements. All of this should be disclosed. Now, can I disclose this in various places? I'll disclose one accounting policy in balance sheet, one in P&L, one in cash flow statement. No, you need to disclose all of them at one place. All the accounting policies which are significant, which are followed by the organization, are required to be disclosed at one place. And if in case you have not followed any specific rule of accounting, any specific policy which accounting standard mandates us to follow, we have followed the policy which accounting standard doesn't want us to follow. Like simple average method is not allowed under accounting standard 2 valuation of inventory. If you followed it, you will disclose it, but disclosure is not a remedy. I cannot go kill someone and then say, yes, I agree, I have killed. You can't sue me now, or you can't put me behind bars now, because I am accepting it myself. Acceptance is required, but acceptance is not a remedy. Acceptance doesn't make the error good. Error will remain an error. Not following the accounting policy to be followed, or following the wrong accounting policy requires disclosure, but such a disclosure is not a remedy for doing something wrong. And the last point that I want you all to note with regard to accounting standard 1 is changes in accounting policy. I told you some time ago that going concern, accrual and consistency is a fundamental accounting assumption. An organization should be consistent when it comes to the way it prepares, the way it follows accounting policies from one accounting year to another accounting year. But are you allowed to breach that flow? Can you stop that flow? Can you follow a different accounting policy from one year to another year? The answer is yes. You are allowed to change your accounting policy, which is an exception to consistency. But in order to change your accounting policy, it should be one among the following 3 reasons. Reason number 1 is the statute or the law has changed and the law wants you to change the accounting policy. Or the accounting standard has gone through a change and the new accounting standard wants you to change the accounting policy. Or the paragraph in the accounting standard has been amended requiring you to change the accounting policy. Last one is for the sake of appropriate presentation of financial statements. Maybe you followed an accounting policy which is correct, but there is another accounting policy what is best suited for your organization. It will show better financial results, better presentation of financial statements. When I say better presentation, I am not meaning to say higher profit. More appropriate, more reliable financial statements, or more reliable financial statements can be prepared with such change in accounting policy. In such cases, you should change your accounting policy and adopt the new one. And this is the quick revision on accounting standard 1.
A quick revision of the topic of cash flow statement. As the name itself says, cash flow statement is a statement. This is a statement which is financial statement. Section 2 subsection 40 definition as well as section 129 of Companies Act covers this cash flow statement. And this is a statement which is prepared to analyze cash flow. We can say that cash book also does the same thing, but cash book analyzes the cash flows into only inflow outflow. Here, each inflow and each outflow is further analyzed into 3 major activities, that is financing activity, investing activity and operating activity. Any business to originate, first you will get the idea, then you will raise the money, you will use that money and set up the infrastructure, and then you do operations. Same is what we are trying to analyze here. When you raise the funds by way of issue of equity shares, issue of preference shares, issue of debentures, raise of loan, it's all financing inflow. Using that you set up infrastructure, buy assets, that is investing outflow. And later you start your business, buy goods, convert the goods to work, finished goods, and then pay expenses, sell the goods, do the business. That's operating activities. And once you get the profit, using that profit, you pay interest, you pay dividend, that's financing outflow. You're done with the business, now you want to stop your business. You sell your assets, investing inflow. And using that you repay debt, financing outflow. You repay debenture holders, financing outflow. you redeem preference shares, you buy back equity shares, you basically close down the business. That is financing outflow. So do you understand how we're trying to analyze the flow of cash in and out into each of the activities? By having a look at these activities, we can understand the pulse of the organization. If too much of investing outflows are there, then the organization is growing. If investing inflows are more, the organization is selling its assets. It's basically closing down its operations. Huge financing inflows means they're borrowing more and more money. They're raising more and more capital. Repayment of debt and buyback of shares, redemption of shares, all of this will lead to financing outflow. That means organization is shutting down. To an extent, it's fine, repayment. But beyond a point, if you're buying back shares and if you're paying back loans, that means the organization is basically closing. And positive cash flows from operating activity tells the profitability of the organization. How rich is the organization when it comes to cash? And this is one of the metrics using which we can scale, we can understand the scalability of the organization as well as the operations and functions of an organization. You get it? Very good. And when we use the word cash and cash equivalent, in this context, the word cash and cash equivalent is very different from what we basically use under the context of Schedule 3. Under Schedule 3, when we say cash and cash equivalent, it includes fixed deposits which is made for a period longer than a year also. And it will never include the context of investments. However, cash and cash equivalent as per AS3 means cash is cash in hand and demand deposits with bank. Demand deposits is savings bank deposit and current account deposit. However, when we say cash equivalent, it includes investments which fulfill four conditions. RISH, readily convertible, insignificant risk, short term and highly liquid. When I say insignificant risk here, it means it should be listed securities or it should be government bonds or of that sort. When we say short term, we refer to the period of 3 months. If it is lesser than 3 months investment, then it is cash equivalent. If it is even fixed deposit for a period longer than 3 months, it will not be cash equivalent as per AS3. However, as per Schedule 3, it will still be cash equivalent. So the definition of cash equivalent as per AS3 and Schedule 3 are different. It will not match. Please be cautious about this part. And once we talk about this cash flow, whenever we pay dividend is paid against the shares that we have issued, that will be financing activity. However, dividend received will be usually investing activity because you have invested in the shares of the company and we're receiving dividend out of it. However, whenever we receive dividend, because we are an investment company, our only objective is not to produce a product or give service. Buy the shares, sell the shares, hold it till dividend, and then once we receive dividend, we sell. This is our business. In such a case, dividend received will be operating activity. Similarly, interest paid is financing activity, interest received is investing activity. However, if we are a financial enterprise wherein we don't have a product, we don't have service to give, our only objective is to run our own money, raising the money at lower interest, lending the money at higher interest. So we are money lending business. Our business is a financial enterprise. Then borrowing and lending of money, so it is operational activity. Paying interest and receiving interest will become operational activity. Got this? Then I told you the cash flow statement can be prepared in two formats, two methods. One is direct method, other one is indirect method. What is recommended by AS3 is actually indirect method. What we should prepare prominently in a practical scenario is actually indirect method. If you analyze a cash book, debit side there will be opening balance, credit side there will be closing balance. Receipts on the debit, payments on the credit. Opening, closing, I'll keep it aside. Opening here, closing here. Rest of the receipts and outflows, receipts and payments, I'll cut them into three parts. Operating, investing, financing. Operating receipts, operating payments. Together, it will lead to cash flow from operating activities. And investing inflows, investing outflows, investing receipts, investing payments. Together, net cash flow from investing activities. Financing inflows, financing outflows. Financing receipts, financing payments. Together, net cash flow from financing activities. So we have operating cash flows, investing cash flows, financing cash flows. Opening cash and cash equivalent to arrive at closing cash and cash equivalent. This is cash flow statement. Under which method? Direct method. Under indirect, it looks very much the same. Only difference is operating is found differently. If you closely observe the financial statements of an entity, balance sheet liability side represents financing activities. Balance sheet asset side represents investing activity. P&L account represents all operational activities. And even further analysis tells us that all the incomes that we have are actually inflows of cash. All the expenses are actually outflows of cash. Income minus expense is profit. Can I say income minus expense profit is inflow minus outflow, net flow from operational activities? We cannot promise that it is cash outflow or cash flow from operational activities, but it is very close. Net profit is a very, very close item. to cash flow from operating activities. It will become cash flow from operating activities if we eliminate few non-cash items or non-operating items that is there in our P&L. So what do? We'll start with net profit as per P&L account after tax. To this, we add back non-cash or non-operating expenses which were previously debited in P&L, like interest charges, like depreciation, amortization. All of these are non-cash or non-operating expense debited to PL. Because of this, profit has decreased. If I remove the impact of this, my profit will increase to become cash profit. Similarly, there are certain incomes which are non-cash and non-operating but are credited in P&L. For example, dividend received, interest received, profit on sale of assets. So these are non-cash and non-operating, or non-cash or non-operating. These non-cash and non-operating incomes which were previously credited in P&L have increased our profit. Now if I eliminate that, my profit will decrease to become cash profit. So what I would do, I would take my net profit as per P&L account. To this, I'll adjust non-cash and non-operating items. How do I do it? I add back non-cash or non-operating items debited to P&L. I deduct non-cash or non-operating incomes credited to P&L. Once I do this, I won't get cash flow from operating activities. I'll get operating cash profit. The reason why it is not cash flow from operating activities is certain items in the balance sheet liability side and balance sheet asset side actually represent operations. For example, current liabilities and current assets. We cannot look into each current asset and current liability in detail and check how much cash flows have happened. But we can write the net difference. How do we do that? We write changes in working capital. For a current asset, we do opening minus closing and then write it. For current liability, we do closing minus opening and write it. The reason is whenever there is increase in current asset, it means current asset is being purchased by paying cash. So we do opening minus closing. For a current liability, whenever there is increase, it means we have repaid the loan. So cash and cash equivalent should decrease. Whenever there is increase in current liability, that means you have borrowed the money, because of which cash and cash equivalent should increase. So what do? We take net profit as per P&L account. We adjust non-cash and non-operating items by adding non-cash or non-operating expense debited to P&L, by deducting non-cash or non-operating income credited to P&L. To this, we adjust changes in working capital. How do we do that? We add, we add current assets minus current liabilities and we deduct current liabilities minus current assets. For current assets, we do opening minus closing. For current liabilities, we'll do closing minus opening. See, current assets, we do opening minus closing. Current liabilities, will do closing minus opening. Once we do that, we get cash flow from operating activities before tax and extraordinary items. We deduct the tax paid and then we get cash flow after tax. If there is any extraordinary but operational items, they will be written here separately. This is before and that is after. That is to be disclosed separately. What we refer to as extraordinary items under AS 5. I hope you guys understood this. Very good. And whenever I say working capital changes here, there are 3 items which should not be included in this working capital. Item number 1, provision for tax. Item number 2, proposed dividend. Item number 3, cash and cash equivalent. I repeat, proposed dividend, provision for tax and cash equivalent. These 3 items should not be included within that. The reason, proposed dividend, last year's dividend is paid this year, this year's dividend is paid next year. So don't treat it like a current liability. Open ledger, right? Opening balance of liability on the credit, closing balance on the debit. Dividend declared further will be written on the credit, paid during the year will be found as balancing figure. Same with regard to tax. Tax provision is a liability, opening balance on the credit, closing balance on the debit. Further tax provision created during the year will be credited in provision for tax account. We identify tax paid as balancing figure in the debit side. This is the reason why we prepare ledger account. Tax provision created during the year is a non-cash expense debited to P&L. So it will be added back in cash flow from operating activities under indirect method. Dividend we don't add back. Reason is dividend is appropriation item. It will not be debited to P&L, so we don't add back. We add back items because it was previously debited and it has decreased our profit. Dividend is never debited to P&L. It has not decreased our profit, so we don't add it back. But provision for tax has been deducted from the profit to find net profit as per P&L, which is our starting point. So we add back. I hope you guys got this. Cash and cash equivalent will not going to adjust it in changes in working capital because that is the reason now you prepare entire CFS. And in the question, if they've given straight away adjustments, depreciation, amortization, profit on sale of assets, it's very easy. Start with PL, add or less these items, do changes in working capital, pay tax, cash flow from operating activities. However, certain questions they don't do that. They give you PL, they give you balance sheet. In that case, open ledger account for every item with difference in opening and closing balance, or item with same opening closing balance but as adjustment. You get this? But for 3 items you don't open ledger. current assets, current liabilities, and cash equivalent. But among current asset, current liabilities, you will still open ledger for provision for tax and proposed dividend. In each of this ledger, identify two things. One, P&L, two, cash. If it affects cash, categorize operating, investing, financing, check inflow, outflow, write it to cash flow statement. If it comes to be P&L account there, profit on sale of asset, loss on sale of asset, premium on redemption of debentures, premium on redemption of preference shares, or interest received, interest paid, expense paid, some item. All of these items might be non-operating or non-cash items debited to PL, or non-operating or non-cash items credited to PL. If it is non-operating or non-cash items debited to P&L, add back. If it is non-operating or non-cash incomes credited to P&L, deducted. And that's how we close our cash flow statement. Last point that I want you all to remember, whenever you're doing cash flow statement, always keep in mind double entry system and then prepare it in the order, and your cash flow statement is sure shot to tally. Come on guys, let's have a very quick revision of Accounting Standard 17 segment reporting. Under this, we report certain segments separately. We all know we have profit and loss account to identify the profitability of the organization. But that profit is not sufficient for decision making. We want profit not for organization as a whole, but we want profit for certain specific segments. Because you remember, no, Wilfred Pareto uncle has told that 80% business will give 20% profit, 20% business might give 80% profit. Such organizations part which gives major profit needs better analysis for better decision making. Let's get started. Segments in this entity or segments in this standard is basically divided into two: business segment, geographical segment. Business segment means the business is divided into various segments based on the product or service, because the risk and reward from each of this product and each of this service is distinct from another product and service based on the product service differentiality, because the risk and reward on that product and service is different. If we divide the entity, it becomes business segment. However, product and service within the economic environment is giving us same risk and reward, but in a different economic environment, it is giving different risk and reward. Risk associated is different, reward taken from that product or service, the reward taken from that geographical segment is different. So like branch based accounting. So then we divide the organization based on the economic environment because of varied risk and reward. That becomes geographical segment. Entity has a personal choice to make whether it wants to divide its entity based on business, or it wants to divide its entity based on geographical segment. It's its personal choice. But once it decides, then which of it is reportable is told by 17. 17 tells TRAM, a reportable segment is identified from a business segment or geographical segment based on T, turnover. Standard doesn't tell turnover, standard tells revenue. If the revenue from that segment is 10% or more, it is reportable. Then R, result. If the result from that segment is 10% or more, it is reportable. If asset from that segment A is 10% or more, then it is reportable. Last one, management by its discretion can call any segment as reportable. You guys get this? Now when we use this word, turnover, result, asset, management discretion, we need to see deep dive into these topics. When we say turnover, we take both internal and external. All the ordinary items will be considered except interest, except dividend, except profit on sale of investments, except any extraordinary items. And same is the case with regard to our assets. We'll take all the segment operating assets directly attributable to business or allocable to business. However, if there is any tax assets like DTA, these will not be considered. Both fixed and current assets are considered. Tangible, intangible is considered. And here also, if there is any tax expense and all, it will not be considered. And allocable or allocable expenses and revenues will be considered. You get this? And another important point is talking about result. Whenever we talk about result, based on which we'll identify reportable segment. Identify profit making segments and loss making segments. Profit making segments you write separately, loss making segments you write separately. Take the total of profit making segments, total of loss making segments, profit and loss. They bring both profit and loss closer. Check whichever is higher. Whichever is higher, on this you compute 10%. And that will act as basis for everything. This has to be taken in absolute terms. Let us say whichever is higher is loss. Don't take minus of that number. It is positive number. Compare it with all the numbers. It is result, not profit, not loss. You got that? Very good. So once we apply this, that becomes reportable segment. Another important point that you guys should notice, whenever a segment is reportable in the current year, it becomes reportable in the next year also based on continuity principle. If a segment is reportable in the current year because of turnover, result or asset based condition, then it is reportable in the next year also based on continuity principle. even if its turnover, result or asset doesn't exceed 10% criteria. However, the year after that, it's no more reportable. So continuity principle only for 1 year. Because it is reportable based on continuity principle in this year. Is it reportable in the next year also based on continuity principle? No, no, no. And management discretion also doesn't count. Only turnover, result, asset based criteria. If it is reportable in the current segment, it is also reportable in the next segment. Everyone got this? Then I want you to note another point, that once you pick all these reportable segments, take the total of the external revenue from these reportable segments. If the total of the external revenue from the reportable segments is lesser than 75%, I'll repeat, total of the external revenue from the reportable segments, if it is lesser than 75%, then management by its discretion should pick such segments as reportable so as to bring the total reportable external revenue to 75% or more. You get this? Last point that you should note about reportable segments is, according to accounting standard interpretation 20, if the reportable segment is only one, then you don't have to do reporting. Skip it. However, by management discretion, if you add one more segment as reportable segment, then you do it. This is not standard. This is ASI 20, which says that you don't have to report that segment separately. You guys get that? Then lastly, we'll talk about the disclosure parts. What are the disclosures? Let's say primarily you picked business segments and not geographical segments. For each business segment which is reportable, you need to disclose revenue, expense, asset, turnover, profit. What is the assets purchased during the year? What is the depreciation on that asset? And any other expenses related to that asset, cash and non-cash. This has to be disclosed separately for primary consideration. However, let's say we pick business segment, and later secondary consideration will be our geographical segment. So for each of these business segment, at each geographical location, what is the revenue, what is the asset, what is the profit, that has to be further disclosed. What if both are important? Then you would have to do matrix. Because one side you write primary, one side you write secondary consideration. At this location, this location, this location, this product, this product, this product, disclose everything. That's too complex. So it is better off that an organization picks biological, reportable segment based on geographical segment or business segment, whichever is of primary importance to them. You got that? Then finally, other disclosures are if there is any extraordinary item or prior period item, change in accounting policy or estimate as per AS5, that disclosure has to be done separately. Inter-segment pricing, what is the policy that they follow, is also supposed to be disclosed. And this is a quick revision of our entire accounting standard 17. I hope it was of some help to you.
Come on, guys. Let's quickly revise Accounting Standard 18, which deals with related party disclosure. This is a disclosure based standard. In this, there is no computation, there is no journal entry, there is no balance sheet preparation. You should only disclose who is a related party, how are they related, what is the relationship that you have, what are the transactions with the related party, is there any outstanding balance, is there any amount written off. Before we discuss all that, who is a related party? The person on whom you have control directly or indirectly or under common control. Directly control. You are the holding company, you have a subsidiary. This subsidiary is your related party. Indirect control is you are a company who has only 30% share in one company. Directly. You have one more subsidiary. That subsidiary has another 20-25% share in that company. So you directly have 20% shares. Through another company, you have 35-40% share, and that company is your subsidiary. So you have a subsidiary. That subsidiary has 35% in one company. You have 20% in one company. So directly you have 20, indirectly you have 35. So that company becomes your, very good. So you have control over that company because you have more than 50%. So you have control directly or indirectly or under common control, meaning you are a subsidiary, another company is subsidiary to the common holding company. So both of you are related parties. So you have control directly, indirectly or under common control, or you are being controlled, meaning you are the subsidiary and there is a holding company. Then also there is related party relationship. That is with regard to control. That is holding and subsidiary. Next part is with regard to associate and joint venture. If you have more than 50% stake in a company, it becomes your subsidiary. If you have more than 20% but less than 50%, becomes your associate. On subsidiary, you have control. On associate, you have significant influence. So the investor and associate are also related parties. The next word is joint venture. You and another company together create one company. Joint venture, jointly controlled business. That joint venture is your related party. But this other person with whom you did business, no, that co-venture is not your related party. I am A Limited, you are B Limited. Together we start one joint venture AB. Joint venture AB is a related party to A. Joint venture AB is related party to B. A and B are not related parties. That is joint venture. Next comes individual. Any individual need not be a person created by law, person who's natural person. So me, you, human beings, if we have more than 50% in a company, we have control over that company, so we become related party to that company. And for that company, we are related party. We both are related. What if you don't have more than 50%, you have more than 20%, then you have significant influence. So when you have control or when you have significant influence, as an individual, again you are related to that company. Next thing is your relatives. All of your relatives, that individual who has control or significant influence along with his relatives is a related party to that company. Last part is KMP, key management personnel along with his relatives is also a related party. What should we do with regard to related party? We have to disclose. What should we disclose? What is the name of the related party? What is the relationship with the related party? How are they related? Then, what is the nature of the transaction with that party? What is the amount that is transacted with that party? And what is the outstanding balance at the year end? At the end of the year, how much money do you owe to that party? Or how much money are you supposed to recover from that party? And during the year, if there is any money written off against that related party, what is the amount that is written off or written back? That has to be disclosed. And if in case there is a non-disclosure agreement, then disclosure cannot be made, then state that fact, that disclosure cannot be made. If in case for any reason you cannot make disclosure, state the fact that you cannot do disclosure. If there is related party relationship, but there is no transaction, still we have to disclose that there is related party relationship, but there is no transactions. So that's what is required as disclosure. Last point that should be noted is the relationship between the related parties can be there at any point of time during the year. It is not like 31st of March, they are not related parties, so no disclosure required. Angalla. Even one day during the entire year, if there is related party relationship, for the entire period, they are related parties, it has to be disclosed. And separate disclosure is required for the transactions that has happened during the period of related party relationship only. Let's say for 3 months they were related parties. After that remaining 9 months, they are not related parties. Balance sheet what is prepared on 31st of March, you have to state that that concerned party is a related party. Separate disclosure of transactions is required only for the transactions that happened in that first 3 months when they were related parties, not for the remaining 9 months. No separate disclosure is required. We quickly saw these questions. Holding limited, subsidiary limited, associate. So holding and subsidiary are related parties. Holding and associate is also related parties. Subsidiary and holding, sorry, holding and subsidiary are related parties. Subsidiary and associate are related parties. Associate and holding are not related parties. Understood? Holding and subsidiary related parties. Subsidiary and associate, associate and holding. For subsidiary, both holding and associate are related parties. But for associate, only subsidiary is related party. For holding, only subsidiary is related. Then we saw another case where holding company has two subsidiaries. From holding company's perspective, subsidiary 1, subsidiary 2, both are related parties. From subsidiary 1's perspective, holding and subsidiary, both are related parties. From subsidiary 2's perspective, holding and subsidiary 1, again both are related parties. Because subsidiary 1 and subsidiary 2 are under common control of holding company. Then we saw another question where holding company has two subsidiaries. One of the subsidiary has an associate. If you see from the perspective of the holding company, subsidiary 1 is a related party, subsidiary 2 is a related party, associate is not a related party. If you see from the perspective of subsidiary 1 limited, holding is a related party, associate 1 is a related party, subsidiary 2 is also a related party. To subsidiary 1, everyone is related party. If you see from the perspective of subsidiary 2, holding is a related party, subsidiary 1 is a related party. To subsidiary 2, associate is not a related party. Finally, if we see from associate's perspective, only one related party. Subsidiary 1. Only one related party. Who's that? Very good. Then after that, if a holding company has a subsidiary and holding company directly holds some shares in one associate company and through subsidiary they hold 30% in that same associate. Now, from the holding company's perspective, subsidiary is a related party, associate is also a related party. From the subsidiary's perspective, holding company is related party, associate is also related party. From associate company's perspective, both holding and subsidiary are related parties. But what we're trying to understand here, everyone is related to everyone. This holding has more than 20% shares in associate, which makes this associate of holding. So directly, holding company has significant influence. But indirectly, holding company has 30% in associate. So totally, holding company has 55% in associate limited. So holding company does not have just a significant influence. Holding company has control over associate limited. We should never do 55% of 30. No. Holding company has 25% directly in associate limited, 30% indirectly in associate limited. Holding company has more than 55% in associate limited. Associate limited is under control of holding, not under significant influence. But everyone is related to everyone. We understood this. Then holding company has a subsidiary company. Subsidiary has one associate. Associate has one associate. Now, holding and subsidiary are related parties. From holding company's perspective, associate 1 is not a related party. Associate 2 is not a related party. But for subsidiary, everyone is related. Holding is also related. Associate 1 is related. Associate 2 is not related party. For subsidiary, holding company is related, associate 1 is related. Associate 2 is, for associate 1, subsidiary company is related party, associate 2 is related party. Holding company is not a related party. For associate 2, only associate 1 is a related party, nobody else is related. Did you understand? So basically, subsidiaries associate is not my associate. Associates associate is not my associate. But subsidiary is my subsidiary. Did you understand this? Very nice. Then we saw similar questions. Only two questions that I did differently from our study material is one is Andy and Robert question. So I am Robert, my wife is Andy. I am a person holding more than 50% shares in a company. Then I am a related party because I have control over the company. My wife is my relative. My wife is also related party. My wife is under employment. Salary is paid by the company. Related party transaction. What if she quits the job after 3 months? For the first 3 months, she is related party. At the end of the year, it has to be disclosed as related party. But salary paid during the first 3 months should be disclosed separately. After that, if they have any transaction, that need not be disclosed separately. Last one is bank. UH Limited Bank had given loan to P Limited, in which UH Limited has more than 20% stake. So bank has more than 20% stake in your company. You become associate, bank becomes investor, associate and investor relationship. If the bank gives loan to you, it might be at market rate, but it is still a related party transaction required to be disclosed separately by the bank. And I think that's it. UK Limited and P Limited. Rest everything was very similar to what we've discussed. Narmada and Ganga. I am a director in Narmada Limited. I am a director in Narmada Limited or key management personnel. I am a related party. I am owning 100% stake in Ganga Limited. I make Narmada Limited sell goods to Ganga Limited at market price. So the accountant is saying no separate disclosure is required because transactions are done at fair value. It is okay if the transactions are done at face value. Because the key management personnel or the director holds 100% stake in a company, that company is a related party, relationship with the related party, transactions with the related party has to be disclosed separately. Understood?
Let's now revise accounting standard 20 earnings per share. Why do we compute earnings per share? See, when we prepare statement of profit or loss, entire entity's profit is available, but that is not enough to make decision. To make decision, we need to do comparison. So we are going to learn computation of EPS, which will help us compare our last year's EPS with current year EPS for decision making. Compare our EPS with our competitor's EPS or another company in the industry CPS. All of it to help us in comparison, to help us in decision making ultimately.
That is the objective of accounting standard 20, earnings per share. Under accounting standard 20, EPS are two types. One, basic, second one, diluted. Basic is mandatory for all the entities. Every entity will prepare EPS, will compute EPS and then write it in their P&L statement. However, diluted EPS, what we call as part 2 of EPS topic, is not mandatory for all of them. When we discussed applicability of accounting standards, you would have gone through them. Some standards are exempt, some standards are not applicable. Exempt means standard is applicable, some paragraphs in that standard is not applicable. So for small and medium sized entities, level 2, level 3, level 4 entities, there is exemption. No, that exemption is diluted EPS. Let me show. When you come to AS applicability, for small and medium enterprises, there is relaxation with regard to AS 20. Meaning 20 is applicable for small companies. In 20, some paragraphs are not applicable. One of the paragraph not applicable is diluted EPS. Same as per ICA, when we do level 1, level 2, level 3, level 4, for level 2, level 3 and level 4, exemptions is there. No, there if you see there is 20. See here not applicable. For level 2, 20 is not applicable. For level 3 and level 4, 20 is not applicable. Meaning they don't have to compute earnings per share. Are you getting it? Why? Because this ICA's classification is non-corporate entities. No, there will be no share capital there. Interesting. For those who have not seen this AS applicability, you can watch this video where it is covered in detail. Now let's anyways move back to accounting standard 20, earnings per share. And even when we prepare consolidated financial statements according to accounting standard 21, we have to still compute our EPS for the entire consolidated entity as whole. There are certain definitions that you can go through. I'll cover the important ones because this is a revision video. If you say equity share is a share which is not a preference share. For this, we compute EPS. EPS is never computed for preference shares. Preference shares, the dividend rate is fixed, earnings is also fixed. For equity share, we compute earnings per share. What is preference share? Preference share is a share with preferential right in two situations. One, for dividend. Two, for repayment. When the company is giving dividend, first it should give it to preference shareholder, then equity shareholder. When the company is repaying the capital, first it has to be paid to preference shareholder, then to equity shareholder. Those are preference shareholders. For them, EPS is not computed. For them, dividend is fixed. Then potential equity share. We will consider this in our diluted EPS. These are not equity shares, but they have the potential to become equity shares. They have the right to be converted into equity shares, or we have an obligation to issue equity shares against them. Example, convertible preference share, convertible debenture, share warrant, option can be employee stock option or other than employee stock option also. Any contingency which has to be settled by issue of shares, or any other partly paid up share against which dividend is not entitled to. Once it becomes fully paid up share, it will become entitled to dividend, then it will be equity share considered in EPS. Till then it is potential equity share. I'll repeat, if there is a share which is partly paid up, if it is entitled for partly paid up dividend, then it is equity share to be considered in basic EPS. However, if in the share certificate we mentioned that this share will be eligible for dividend only if it is fully paid up, till the time it is fully paid up, against that dividend is not entitled to, so it is not part of our basic EPS computation. It is a potential equity share to be considered only in diluted EPS computation. The day it becomes fully paid up, we'll consider it in basic EPS. However, if it is eligible for dividend for the partly paid up portion, then it is considered in basic EPS computation in the denominator. Next, there is definition of financial instrument, financial asset, and financial liability. We don't have to deal with that right because 30, 31, 32 dealing with accounting standards on financial instruments are removed from syllabus, removed from accounting standards only. You will read financial instruments only in CA final, you will read that there, but the definition is still there in the chart, so that just like that, if you want to read, you can. Come on, let's go to basic EPS. Basic EPS is computed by dividing Patesh by weights. Patesh is profit available to equity shareholders. In denominator, I will take weighted average number of equity shares. In the computation of Patesh, we should take gross profit, that is revenue from operations and other income, all the incomes added, all the expenses to be deducted, purchase of stock in trade, consumption of raw material, employee benefit expense, interest on debenture, all the depreciation, amortization, deduct all of this. We get profit before tax. From that you deduct tax, you will get profit after tax. From that you deduct your preference dividend. After you deduct preference dividend, what is remaining is the profit available to equity shareholders. We call it Patesh or ETESH, earnings available or profits available. This has to be divided by weighted average number of equity shares. Now we're discussing only numerator. You understood how to compute numerator? There are certain important points. Preference dividend will get added in case of loss. Profit is there. From that you deduct preference dividend. If the amount is loss, it is minus of 10,000. From minus of 10,000, if you pay dividend of minus 2,000, it will become minus 12,000 available to equity shareholders. In the case of cumulative preference shares, even in the year of loss, dividend will be declared and it will be paid in the later years. Let's say this year we have loss of 10,000 and preference dividend 2,000 is declared but not paid, will be paid next year. So this year minus 10,000, from that I'll do minus 2,000 preference dividend. I will be having minus 12,000 to determine my EPS, and EPS will be negative. Can EPS be negative? Yeah, EPS can be negative. If the company has earnings, it will be positive. If the company has loss, it will be negative. Sir, if it has loss, can I say LPS? LPS Allah, EPS negative. Loss per share Allah, earnings per share is minus. Are you getting this? Sir, small, no, nothing. It is earnings per share negative. And even if there is arrears of preference dividend, that is in the case of cumulative preference shares, shares which have the right to be receiving dividend in the year of profit accumulated from the year of loss. If that is there, let's say in this year we made huge profit. In the last 3 years we have made loss. And this year we are paying our preference shareholders dividend for 3 years, including 2 previous years. In EPS computation, from profit after tax, we should only deduct 1 year dividend, not 3 years dividend. Why? Payment is 3 years dividend, but declaration is only 1 year. Those 2 years, previous year when there is loss, you would have deducted in the last year on declaration. It is paid in current year. We have done questions on this. So arrears of preference dividend paid for earlier years should be deducted only for 1 year. Cumulative dividend will not be deducted. Only current year dividend will be deducted in computation of current year EPS. Paid in current year, not declared in current year. Those accumulated and arrears of dividends. Got that? Next, any appropriation to reserves, whether statutory or not statutory, we don't care. First compute EPS, then you do whatever you want with that profit. Sir, if there is statutory reserve transfer, don't adjust it. EPS computation is before transfer to reserves. Why? Even if you transfer to reserve, that reserve will be available to equity shareholders only. No, we are not talking about dividend distributed. We are talking about earnings attributable. So such statutory reserve which is not eligible for dividend is also a reserve which is belonging to shareholders. So before deduction of transfer to reserves, we should compute EPS. I hope everyone understood this. By this we are done with numerator, which is earnings available to equity shareholders. Next we have weighted average number of equity shares. How to compute weighted average number of equity shares? If a share is fully paid up, we will take 100% of its value. 10,000 shares fully paid up. 10,000 shares into 100%. If they are opening balance, full year. If they are issued during the year, time from the date of issue till the year end, how many ever months are there, so many will take. If the share is partly paid up, then what do? We should first check that partly paid up share, is it eligible for dividend? If it is eligible for dividend, then it is to be considered in EPS computation. If it is not eligible for dividend, it will be considered in diluted EPS computation as a potential share to the percentage paid up for the months that is there in the company. However, if dividend is eligible on those shares, then what to do? Those partly paid up shares, take it into percentage paid up. Let's say 8 rupees is paid up out of 10 rupees nominal value. We will take 8 by 10, 80%. If the shares are issued on 1st of April, so 100% of the period. So we'll do 10,000 shares into 80% paid up into 12 by 12 period. If it was issued on 1st of October, 10,000 shares into 80% into 6 by 12, because these shares got issued only in October, so it is there only for 6 months. That is with regard to partly paid up. If the shares have different nominal value, then we'll have 2 different EPS. If you have 2 classes of shares, you'll have 2 EPS. If you have 1 class of shares, you'll have 1 EPS. We should equate the number of shares. Imaginarily, we'll convert the number of shares and then compute EPS. Shares of 10,000 shares of 10 each fully paid up, 10,000 shares of 5 each fully paid up. What will you make it? You'll make it 15,000 shares of rupees 10 each or 30,000 shares of rupees 5 each. Compute the EPS for 1 class of shares and then identify it for 2 classes. So whenever there are 2 classes of shares in the balance sheet, EPS also will be 2, 1 for each class. Not the same for same class with different paid ups. I hope you understood this. Then what if there is bonus issue, share split or consolidation? whenever there is bonus issue, share split or consolidation, irrespective of the date of bonus issue, irrespective of the date of share split, irrespective of the date of consolidation, we are going to compute period for those shares from the beginning. Bonus issue is made on 1st of October. 10,000 shares are made as bonus issue. 10,000 shares into 12 by 12, though the issue is happening on 1st of October. What if bonus shares were issued on 31st of March? Still 12 by 12. Full year we should take. Further, also remember one more point. This is done because we don't receive any consideration. That money what we issued as bonus shares is there in the balance sheet in the form of reserves and available to us for utilization throughout the year. So we'll take full year. Whenever you do bonus issue, that is issue of shares for non-cash consideration, we need to restate our previous year EPS also as if this bonus issue had happened not in the current year but in the previous year. We write current year profits divided by current year number of shares, find EPS. For this comparison, previous year EPS will be wrong for comparison now. Why? Previous year EPS is without bonus issue. So in previous year EPS computation, in the denominator, add the bonus shares and identify EPS. That new EPS that you found for last year is called restated EPS or adjusted EPS only for comparison. And in the P&L for the previous year, show two EPS, one original as per previous year's P&L, one restated for previous year exclusively for comparison purpose. Got that? Then we have right issue. In the case of right issue, it is shares issued to existing shareholders for a price lesser than the fair value. Lesser than the fair value is also called as theoretical X right price. After the right issue, what is the price in the market? In this question, check if they've given theoretical X right price in the question. If they've given, good. If not, you find. How will you find? Number of shares before right issue multiplied by price before right issue. Price before right issue is cumulative right price. Price before right issue multiplied by cumulative right price or price before right issue plus number of right shares multiplied by right issue price. This is our numerator. In the denominator, you take number of shares before right issue and number of right shares. That is total shares after right issue. I'll repeat. Number of shares before right issue multiplied by cumulative right price plus right shares multiplied by right issue price whole divided by shares before right issue and right shares. You get theoretical X right price, that is fair value. This is the rate at which the share should have been issued by company. But company is issuing shares at a price lesser than this fair value. Why? They are giving it to existing shareholders. So what should we do? We should take number of shares, that is right shares, multiplied by right issue price. If you multiply, you get some number. You divide it by fair value. When you divide it by fair value, number of shares you get, that is cash element. For these shares, company is collecting cash. Over and above this, any shares given is free, bonus shares. So right shares right shares minus this cash element will give you bonus element. This bonus element shares, you take it for the entire period from the beginning till the end of the year, irrespective of the date of right issue. However, this cash element shares, whatever are there, you take it from the date of right issue. And because this bonus element is free shares given, we need to restate our previous year EPS, taking this bonus element in the denominator for previous year EPS. That will be adjusted EPS or restated EPS. Got that? Then, if in case in the process of amalgamation the shares are issued, if it is in the nature of purchase, we should take it from the date of acquisition. If the amalgamation is in the nature of merger, it has to be computed from the beginning of the accounting period. No questions are there on this anyways. If there are any convertible preference shares or convertible debentures, from the date of conversion, they should be taken in the denominator, not before that. Because before that, they are potential shares that will be taken in diluted EPS. Till the date of conversion, potential. Once converted, basic. Got it? Then ESOP. If there are employee stock options outstanding against which shares are not issued, they are potential shares. There also we take cash element, bonus, cash element, non-cash element, and non-cash element will be taken in potential shares. Once it is issued, employee stock options are exercised and they become shares. Then it will be taken for basic EPS. Got it? Then let's discuss diluted earnings per share. Diluted earnings per share is an imaginary earnings that you compute. What if scenario where a potential equity share like convertible debenture, convertible preference share or an option gets converted into equity share, and because of that our profits will decrease. So they are not shareholders. If they become shareholders, what will be EPS? They'll come and join our denominator. In the denominator, I will add potential equity shares. When I add potential equity shares in the denominator, in the numerator, they will add back the money that they had taken previously in their old capacity. If I am a preference shareholder, previously I would have taken preference share dividend. When I become equity shareholder and join denominator, my preference dividend, what I had taken from them previously, I will add it back to numerator. For this, no adjustment. Profit available to equity shareholders plus preference dividend divided by number of shares plus number of potential equity shares to be given to preference shareholders. If it is debentures, they give back the interest and they come sit in the denominator. Potential equity shares to be given to debentures will be added in denominator. Numerator, when we are adding back interest, which was previously written as expense, company had paid money. Now when the company is getting that interest money back, it is like income. You have to pay tax on it. So when you add interest, deduct tax 30% or whatever percent is given and then add it. So to the numerator, you do profit available to equity shareholders, what is used in basic EPS, plus interest into 1 minus tax rate. In the denominator, you write whatever you computed in basic EPS denominator, number of equity shares, plus potential equity shares which are to be given to debenture holders. That is to be done for convertible preference shares and convertible debentures. If it is stock options, what to do? Patesh will not change. Profit available to equity shareholders will not change. In the denominator, you need to compute it again. How do we compute it? Very simple. First, take number of options, multiply it with the option price that they have to pay. Multiply. We will get the total value. This total value, how many shares they should have given? We should divide it by fair value. They will give that in the question. Divide it by fair value. Whatever you get is cash element. From number of options, you deduct this cash element, you will get non-cash element. Same like right issue. But remember, in right issue, you might have to compute fair value, which is theoretical X right price. In this, they will only give it in the question. Much simpler. And if you're doing questions from study material or somewhere, you might see something called adjusting factor. Don't worry, you don't have to apply that formula. You have learned the computation logically without using formula. Continue to do this and check your end answer. It will absolutely match in all the circumstances. Then next thing that you would have to notice, potential equity shares to be considered only if they are dilutive in nature. Any potential share, if we take, because of that, the EPS that we get now is more than the basic EPS, then don't take that. We should take only if it is dilutive in nature. When we say dilutive, it is not the profit, it is the profit per share, it is earnings per share that we'd have to check. And if there are any convertible shares, no, till the date of conversion we should consider, not after the date of conversion. If they are convertible debentures for 8 months, 4 months it's become equity share. In diluted EPS will take 8 months, not 12, because for the remaining 4 months it will come in basic EPS. We've done one question where 8 lakh was given 8% and 6 lakh. We've done one AQ. So that covers this part. Finally, in your statement of profit or loss, you need to disclose your basic EPS and diluted EPS if it is negative. It is mandatory, not an option. You can't skip this. And EPS will be shown for extraordinary profits and ordinary profits separately. And reconciliation has to be done between ETH and diluted earnings. From earnings available to equity shareholders, how did you arrive at diluted earnings? You added back preference dividend, you added back interest net of tax. That computation has to be shown in financial statements and in the workings. And reconciliation between weighted average number of shares, what is considered in basic EPS, and potential shares which are added to denominator in diluted EPS. How did you arrive at those numbers? That computation, what we do, that should also be shown in the preparation of EPS computation. And if the EPS is there, if the classes of shares is more than one in the balance sheet, then EPS will be more than one. Different EPS will be computed for different nominal value shares, and that also should be disclosed separately. You guys got this? And that's quick revision of accounting standard 20.
Let's now quickly revise accounting standard 24, which talks about discontinuing operations. Whenever we talk about discontinuing operations, it can be a line of business or it can be a geographical location. When I'm operating from more than one location, let's say I have 4 branches, I can shut down one branch. That can become a discontinuing operation. Or let's say I'm manufacturing 3 products or I'm giving 3 different services. If I stop to produce one product, or if I'm stopping to give one service, that can become discontinuing operation. Like how we discussed in accounting standard 17, business segment and geographical segment. A discontinuing operation can be a business segment or can be an Geographical segment. It need not be a reportable segment. A non-reportable segment can also be discontinued. If you are still not understanding what do we mean by geographical segment and business segment, you have to revise accounting standard 17. Next, once we talk about this line of business, this should have been distinguished based on operational or financial reporting purpose. So this operation, what we are talking as our geographical segment or our business segment, this can be distinguished for the purpose of operation, meaning assets, liabilities, expenses, incomes, profit from this segment we should be able to determine separately. If we cannot determine asset, liability, expense for the purpose of operation or for the purpose of profit, financial purpose, I am not able to segregate that operation separately, then this discontinuing operation is not applicable. So to apply AS 24, that segment whatever is there, that should be able to be distinguished. We need to identify assets for that segment, liabilities for that segment, expense, income, profit for that segment separately. And if you have a plan, what is very, very important? Have a plan. And this plan should be to discontinue this operation. This is not applicable to the operations which are already discontinued. This is applicable to the operations which are planning to discontinue. That plan can be to discontinue the operations in a single transaction, like you're selling the business immediately in single transaction, or it can be in a gradual phased out manner, or it can be through abandonment. How many things are there? Three. One, immediately you're selling everything. Second one, in a phased gradual manner you're selling. Third one is abandonment. When you're selling it entire thing in one single transaction, that single transaction can be sell it to somebody else, or it can be demerger. Demerger means your company has 5 product lines, or a company has 5 branches. Let's assume product lines, business segment. You are segregating one segment or one product line into a separate company, like how Reliance Geo, Reliance Industries demerged Geo Financial Services into a separate company. You can do demerger, that is 2 companies coming together is merger, one company becoming 2 companies is demerger, or by way of spin-off, selling that entire wing with business to somebody else. This is a single transaction where you are discontinuing that operations. Second one is by way of disposing in piecemeal. Piecemeal means what? Not the entire thing is disposed once. You sell some assets, you settle some liabilities this year. Next year, you again sell some assets, you again settle some liabilities. The year after that, again you sell some assets, again you settle some liabilities. In a time-based manner, you have a plan to dispose all the assets and liabilities little every year. That is disposing in piecemeal. Last one is abandonment, termination through abandonment. You will not sell anything, maybe because there is no assets to sell. You will not settle any liabilities, maybe because there is no liabilities for that segment. What will you do? Abandon. Ange bitbudadashte. We will not do any sales we will not do any sales. We will not incur any expenditure. We will not get any income. There is no assets to sell. There is no liabilities to settle. Immediately you stop that. That is also abandonment. So discontinuation can be of a major line of business or a geographical area, which can be distinguished based on the operation or for the purpose of financial reporting, and it can be through single transaction, or it can be through piecemeal, or it can be through abandonment, and this has to be a time based plan. So whenever this is based on a plan and they decide this, they need to disclose this. How do they disclose? In your profit and loss statement, you write no revenue from operation, other income, total income, employee benefit expenses, depreciation, or to say finance cost, other expenses, total expenses, income minus expense, profit. This profit has to be written separately. How much is the profit from continuing operations? How much is the profit from discontinuing operation? Basically, you will prepare P&L account 2 times. In that P&L, first time you will write all the operations which are continuing, which are there this year, which will be there next year, which will be there in the next to next year also. That you will write one PL. Operations which are there this year will be not there next year. Write them separately. Call them what? Discontinuing operations. Even when you compute EPS from continuing operations, EPS on the profit from discontinuing operations will be computed separately. You do this kind of disclosure. When should you make this initial disclosure? This initial disclosure event is one of these. Whenever the board passes one resolution to do this discontinuing operations, or whenever they sign one binding agreement with some party who is interested to buy our segment. Whenever the board passes one approval, or whenever they sign one binding agreement, whichever is earlier will become the initial disclosure event. After that, whenever they prepare their financial statement, they would have to disclose. If it is a non-listed entity, at the end of the year. If it is a listed entity, stock exchange, they would have to give quarterly reports. No, in that quarterly report only, they would have to make this separate disclosure for discontinuing operations. Understood? What is the disclosures that we should make? Assets relating to discontinuing operations, liabilities relating to discontinuing operations, revenue and expenses relating to discontinuing operations, profit or loss from discontinuing operations. All of this has to be disclosed separately. What else we need to know is, whenever we have more than one product line, let's say we have 5 of them, and one of them is discontinued, this does not result in going concern being questioned. This does not make the organization not a going concern. You should always assume that though 1 or 2 or 3 operations are discontinued, organization is still a going concern unless otherwise mentioned, unless otherwise other indicators are triggered. Then if the demand falls, if the supply decreases, if the technology has changed, or if the profit is more in other department or other segment, you temporarily shift your employees, you open one more office for that department, or when you shift your capital to this, whenever you do all of these things, it is not resulting in discontinuing operation. For it to become discontinuing operation, you should have a plan, time based plan, either immediately or in gradual phased out manner to shut down the operations. When you don't have a plan, for operational convenience, if you reduce the operations, for operational convenience, if you shift the force, resources, employees, money from one to another, that will not result in discontinuing operations. Understood? Let's now quickly revise Accounting Standard 25, which talks about interim financial reporting. The objective of the standard is to prescribe the minimum content that should be reported in the financial statements that we prepare for a period lesser than the accounting period. And it also talks about the recognition principles, how to recognize the expense for this interim period, how to measure that expense, income, asset or liability for this interim period. That is the objective. See, the standard doesn't tell who should prepare interim financial reporting, but the standard tells if you are preparing interim financial reporting, you will have to do as per Accounting Standard 20. Why do you do? 2 reasons. Number one, voluntarily, your investors are seeking, the person who's going to give you money is seeking, or the bank in which you have taken loan is seeking you to give you quarterly report or any interim report, then you would do. Second reason, if you are a listed entity, if you are listed in a stock exchange, so it is a requirement as per clause 41 of listing agreement that you give quarterly reports to that stock exchange. So it is applicable if you are a listed entity or you need it on voluntary basis to give it to your lender or investor. Then if you are preparing interim financial reporting, you have to follow Accounting Standard 25. There is no other option. And interim period refers to a period anything lesser than the financial year. Financial year is usually 12 months. If you prepare financial statements for a period lesser than 12 months, 9 months, 10 months, 5 months, 6 months, case 25 is applicable. Very, very important thing. What if you start your financial year during the current year? This is your first year of operations. Started your operations on 1st of October. At the end of the year, you prepare financial statements for 6 months. That does not become interim period. That becomes complete financial year, and that is the annual financial statement you prepare, and it is not interim financial statement. For that, AS 25 is not applicable. You prepare it as per the normal provisions. You all understand this? Next, when you do interim financial report, you have 2 options. You can do a complete set as if it's a complete financial statement, or you can do a condensed set. When you say condensed set, no, whatever was your previous financial statements, subtotal and line headings, whatever is there, those items will be represented. This is like a summary statement. This is not 100% in detail. Got that? Next, what is the form and content for interim financial statement? You need to prepare condensed balance sheet. You need to prepare condensed statement of profit or loss, condensed statement showing changes in equity, cash flow statement, explanatory statement, notes to accounts and everything. And whenever you prepare this, the complete set like I mentioned is like a complete financial statement. Whereas in the condensed set, we need to disclose minimum information. Meaning in the previous financial statement we prepared, that headings will be there, no? Whatever headings and subtotals are there, at least those subtotals should be covered. You need not have detailed items inside every subtotal. Let's say other expenses detail may each expense detail is not required. Total of employee benefit cost, total of revenue from operations, total of other income, total of trade payables, trade receivables. So much if it's there, it is good enough. However, you need to make additional disclosures to ensure that the user of the financial statement is not deceived by the summary statement, or it should not be misunderstood by the user. So we need to make all such disclosures to ensure that it is not misleading or it will not lead to misunderstanding by the user. Understood that? Then whenever we prepare statement of profit or loss for the uh, interim period, we should still compute our basic EPS and diluted EPS. And whenever we prepare financial statement, we usually prepare comparative. We should do it in the case of interim financial reporting also. Whenever we do condensed balance sheet, let's say at the end of the second quarter, 30th of September 2024, I'm preparing one condensed balance sheet. For this, comparative will be the previous year financial end. For previous financial year end. That is, when you do condensed balance sheet as on 30th of September 2024, you should also do one balance sheet for 31st of March 2024. 23-24 year end. That will become the comparative. However, when you do consolidated profit or loss, when you do condensed profit or loss, you do one for the period. When you're doing for quarter 2, ending on 30th September, it begins in July. So for July, August, September, one P&L will be prepared. Current year, 2024, you need to do one more YTD statement. It's called as year to date. So interim period is July, August, September. You do July, August, September P&L. You need to do April to September also P&L. You need to do one P&L for July, August, September, one from April to September. April to September one is called as YTD, year to date. Or comparative to this, you need to do one more of previous year. July, August, September 2024, July, August, September 2023. Comparison. April 2024 to September 2024. For this comparative, April 2023 to September 2023. Same to same provisions will apply for cash flow statement also. All the necessary notes and significant accounting policies have to be given. When we do it for one complete accounting period, no, we follow nice recognition principles and measurement. Whenever we do it for less than an accounting period, it is based on lot of accounting estimates, and we need to keep in mind materiality when we do this. Accounting estimates are very normal and way too high when we do interim reporting. All of those have to be disclosed, and how much to disclose in the condensed financial statement depends upon the materiality, the extent to which it can affect the user's decision making. And in this recognition and measurement, when we talk about revenue items, if it is relating to that interim period, it has to be recognized in that interim period. If it is not cyclic, if it is cyclical, if it is seasonal, or if it is occasional, still you would have to record it for that period. Relating to whatever happens in that period has to be recorded in that period only. Let's say Q3, quarter 3, there is high sales. Can I defer it to quarter 4 and then anticipate in quarter 2 and quarter 1? No. Quarter 1 sales has to be recognized in quarter 1. Quarter 2 sales has to be recognized in quarter 2. Quarter 3 sales has to be recognized in quarter 3. We cannot defer. Defer means postponing to next quarter. Anticipate means recognizing one quarter prior. We cannot defer, we cannot anticipate. That quarter expense, that quarter. That quarter income, that quarter. The whatever I told, no, that seasonal or occasional items can be dividend, royalty, grant in the case of income, or it can be any other expense also. And with regard to expense also, same thing. It can be neither deferred nor anticipated. You should record that quarter's expense in that quarter's interim financial report. However, if those two interim periods are considered as two accounting years, and if you are deferring, then you should defer. Example is prepaid rent. If you pay rent for 2 years at once, you only record this year's rent in this year PL. Next year's rent you transfer to next year as prepaid rent in the current year balance sheet. Same you should do in interim reporting also. Understood? Then comes the beautiful topic with regard to income tax. With regard to income tax, there can be brought forward loss from previous year, or there can be slab wise rate applicable, or there can be profit in one of the quarters and loss in the other quarters. What we do in that case is, we should always remember that tax is not paid on quarterly profits. Tax is paid annually. So we should take the entire quarter's profits, do adjustment of carry forward profit if there is any, do slab wise rate if you want to do, or if it falling in two different financial years, apply different tax rates, identify the total tax for the entire year. Total tax divided by total income for the current year gives you effective tax rate. Such effective tax rate should be applied. It does not matter whether the accounting year falls in two different years, whether there is carry forward loss or there is slab rate applicable. In all the cases, we should always compute effective tax rate for the entire year, and that tax rate will be applied on each individual years for each individual quarter's profit. Understood? Then we have accounting policies. See, in the preparation of financial statements, we follow accounting policies. They are accounting principles and methods of applying those accounting principles. These accounting principles, what we follow, should be consistent from one accounting year to another accounting year, and they should be consistent from one interim period to another interim period. Meaning, accounting policies should be same for the entire year. However, if in case you have changed your accounting policy in the middle of the year, from let's say first quarter is over, you're in the second quarter and you change your accounting policy, what should you do? You need to redraft your interim report for the first quarter. Because it is change in accounting policy, we should give retrospective effect. However, if it is change in accounting estimate, we will not be giving retrospective effect. We will only give, very good, all the things which are not obvious has to be disclosed. This we do in any other case also, in the normal financial statements also. We learn it in AS5 or extraordinary items, exceptional items has to be disclosed separately. In the case of Schedule 3, you would have learned non-cash consideration if it is received against issue of shares, that has to be disclosed separately. Or if there is segment-wise reporting that has to be done, you should disclose separately. Contingent liabilities, if there is any changes, that has to be disclosed separately. This is not the exhaustive list, but the list of items. Whenever something non-obvious is appearing in the financial report, that should be disclosed separately. The last part is called transitional provision. That is nothing but first time implementation of IFR or first year of reporting. Let's say my entity started in 1st of October 2024. On 31st of March 2025, I prepare my financial statements. If I want to prepare interim reporting for that first quarter, that 1st of October to 31st of December, when I prepare what to say Q3, basically for my business Q1, accounting year Q3. If I prepare interim financial report, I cannot prepare comparative of previous year. Why? Previous year I was not there, my business was not there, nothing is there. So that comparative concept is exempted if in case you're doing the financial reporting for an interim period for the first time. You all get that? That's quick revision of Accounting Standard 25. Let's quickly revise Accounting Standard 2, Valuation of Inventories. Objective of this standard is to help us identify the value of inventories to be taken in evaluation of financial performance and also to evaluate financial position of an entity. The scope of the standard is given in paragraph 1, which tells us what are the items for which Accounting Standard 2 Valuation of Inventory is not applicable. It says it is not applicable to WIP arising in construction contract. It will be regulated as per Accounting Standard 7. And for WIP arising in service contracts, for which revenue has to be recognized as per Accounting Standard 9. And for service entity, there is no inventory. If inventory itself is not there, what is AS2 doing there? Nothing. Then we have shares and debentures. For shares and debentures and other financial instruments, we won't apply Accounting Standard 2. Because even if you are trading them, it is not your inventory. It has to be regulated as per the specific standard issued, which is Accounting Standard 13, which specifically talks about investment accounting. It doesn't matter whether it is share or debenture, whether it is equity share or preference share. Further, standard talks about certain items which are not covered under inventories, like livestock, forest and agricultural produce, mineral oils, ores, etc. These are all producers' inventory. What we call them? These items are not under the purview of Accounting Standard 2. In fact, these are not under purview of any accounting standard. When we discuss 10 also, we'll tell that these are not covered under Accounting Standard 10. So then how do we value them? Paragraph 2 of the standard tells that we can value these items at net realizable value. However, there is no specific standard applicable. Inventories like livestock, forest, agricultural produce, mineral oil, ores and gases will be valued using industrial norms. Going slightly ahead, paragraph 3 of the standard helps us identify the definition of inventory. As per the definition of inventory, there are three items: finished goods, Work in progress, raw material. These three are covered as inventory. Finished goods are such items which are kept in the active business for the purpose of sale, which are held in the ordinary course of operations for sale. Work in progress are such items which are in the process of being sold, in the process of being converted to finished goods. When it becomes finished goods, it will be sold. Lastly, we have raw material which will be consumed in the manufacturing of finished goods. In a manufacturing entity, we'll have raw material, work in progress, and finished goods. If it is not a manufacturing entity, if he is a trader, he will not have raw material, work in progress, he'll only have finished goods. However, if he is into manufacturing, he'll have three variants of inventory: raw material. For example, in a shirt industry, cotton is raw material, cloth is work in progress, ready-made product shirt is finished goods. Further, paragraph 4 of the standard says what are certain items which are actually not covered under the definition of the standard, para 3. However, these, though they don't qualify the definition of inventory under para 3, still accounting standard 2 is applicable to them. We'll value them as an inventory, we'll record them like inventory. What are those items? Material supplies, consumables, and goods. So these three, though they don't qualify the definition of inventory as per para 3, still they'll be valued like inventory as per accounting standard 2. Next, measurement. How do we value all of these items? This is given in paragraph 5. Paragraph 5 of a standard is a very important paragraph and very generic line. It states that inventory should be valued at cost or net realizable value, whichever is less. In this context, what is cost is going to be major part of our discussion in this. However, NRV is not too detailed. I'll tell it to you right now, NRV, and then go to cost. Actually, the order is first we would have to learn cost and then learn NRV. NRV is net realizable value. That is sale value less selling expenses. Realizable value is sale value. Net realizable value is not sale value. Selling price or sale value is realizable value. It is gross in nature. When we say net, we need to deduct all such expenditure which is incurred to make that sale happen. Transfer expenses, brokerage, commission, or any other expenditure which is incurred for the sale to happen. So selling price minus selling expenses is net realizable value. We will value the inventory at cost or NRV, whichever is less. Reason is conservatism. If you have some inventory, though it is not sold, if its price has gone down and if you are expecting to incur loss when you sell it in the future, such loss has to be booked immediately by way of conservatism. You don't have to wait for actual date of sale to record such loss. Record it right now. How? In the closing stock, when the value decreases, imagine your trading account credit side value decreasing, trading account debit side value decreasing, GP will immediately decrease. Hope you people are getting this. Talking about cost, what does cost include? Cost includes three items. One, cost of purchase, conversion cost, and other directly attributable expense. Cost of purchase. Cost of purchase will include purchase price, duties and taxes. Duties and taxes like GST, central excise duty, or custom duty, entry tax, anything that you pay. Should we include them or should we not include them? Depends whether input tax credit is available or not. If input tax credit is available, then you will take the input tax credit. Why do you add it to the cost of inventory? Don't add it to the cost of inventory. Take the cost of inventory as purchase price after deducting duties and tax. However, if input tax credit is not available, you purchase from an unregistered dealer, in or you for it's a blocked credit, or for some other reason if input tax credit is not available, in such case such amount of tax paid will form part of the cost of the inventory. I hope you got that. Then any freight expenditure, that is travel expenditure or transportation expenditure in any form incurred for bringing the goods from the place of purchase to the place of, so such freight expenditure is included. Any other directly attributable cost that you incur will be included if it relates to the value of the inventory, if it adds value to the inventory, if it is mandatory to be incurred to bring the inventory to the place of sale. One item has to be deducted. Trade discount, if any, allowed by the supplier, you deduct it. If there is cash discount, what will be attained only and only when you make the payment, that should not be adjusted. That will go to P&L account. So if say, let's say the price is 1 lakh rupees, cash discount of 5,000 is allowed. Inventory's cost is 1 lakh. That 5,000, don't deduct it from 1 lakh to make it 95,000. Inventory value is 1 lakh, 5,000 rupees discount received will go to P&L account credit side as income. Cash discount doesn't decrease the value of inventory, trade discount does. Then we have what are the costs of conversion? Expenditure incurred to convert the raw material from, expenditure incurred to convert the inventory from raw material to finished goods. This can be categorized into two: variable direct, indirect. If it is direct, it is direct material, direct labor, direct expense. Directly related to the inventory, in fact, you will have the per unit data available included at the per unit rate into the inventory. However, if it is indirect in nature, it can be further classified into two major classifications: variable overhead, fixed overhead. Variable overhead is such overhead which varies with the level of production. Higher the production, higher the overhead. Lower the production, lower the overhead. So here per unit data will be available. Total overhead divided by number of units produced. That will be allocated to each unit produced. That's not at all difficult. The beauty opens up when it is fixed overhead, meaning irrespective of the level of production, the expenditure is fixed. Whenever there is fixed overhead, that is expenditure is fixed irrespective of the level of production. What do we do in such case? Then compare normal production with actual production, or normal capacity with actual capacity. If the actual capacity or actual output is equal to or lesser than normal capacity, then total fixed overhead is divided by normal capacity. I repeat, if actual capacity is equal to or lesser than normal capacity, total fixed overhead is divided by normal capacity. However, if the actual capacity is more than normal capacity, then scrap this normal capacity, deduct the total overhead by actual capacity. Why? In costing, we have a concept of under absorption, over absorption. Accounts, we don't. There is no concept of over absorption in accounts. You cannot make profit on the expenditure incurred. So we charge the total expense based on actual units, because our estimation of capacity has gone wrong is what we believe in. And in costing, you adjust it with standard costing, adverse and favorable. Here we don't do that. Here we charge it to the inventory totally. If the actual capacity is more, we don't overcharge. If it is less, we'll check. If it is less, then such unused production capacity should be charged to P&L, not to the inventory. So that is the reason we do it based on normal capacity when actual capacity is less. However, if actual capacity is more, charge it based on actual capacity, not on normal capacity. Then we have other expenses. Any other expenses which is incurred to bring the goods to present location and present condition should be included in the value of inventory. That's what other cost paragraph says. Then what costs are excluded? Certain costs are specifically excluded. Number one, abnormal loss. Abnormal loss and normal loss are different. Loss which can be mitigated, loss which can be avoided, loss which can be controlled by taking specific measures, or normal loss. Loss which cannot be controlled. Sorry, loss which cannot be controlled, cannot be mitigated, or not in our control, or normal loss. This has to incur. We can't stop this loss. But loss which can be controlled, which can be mitigated, which is something within our control. If we follow correct measures, we won't incur such loss. That is abnormal loss. Normal loss, we can't do anything, no. So what do? We'll adjust it in units column only. Whenever we adjust normal loss, total value will be same for lesser number of units, because of which per unit cost will go up. So normal loss increases the cost per unit. Normal loss increases the cost. However, abnormal loss, we're going to deduct it in units column. We will also deduct it in amount column, because of which the cost per unit in the case of abnormal loss will remain same before and after. I repeat, in the event of normal loss, units are only deducted, value is not deducted, because of which per unit cost will increase for the good units remaining after normal. In the event of abnormal loss, number of units is reduced, value assigned per unit is also multiplied and written in amount column, because of which total value will also reduce, because of which what's happening, there is no increase in per unit rate, per unit will remain same. Such an amount what is there for abnormal loss should be charged to P&L, it will not be charged to inventory. Normal loss, I told you, no, total value will be same, per unit cost will increase. So normal loss is included, abnormal loss is excluded. What about storage cost? Any expenditure incurred to store the inventory at one place, this will not increase the value of inventory unless it is part of the production process. For example, timber, rice, wine, you have to store it to call the product complete. So then the storage cost will be included in the cost of the inventory. Otherwise, storage cost is not included in the cost of the inventory, that should be charged to P&L. Any other administrative overhead, selling and distribution overhead, which is incurred in the ordinary course of operation, should not be charged to inventory. I hope this made sense. Then talking about valuation techniques, we have several valuation techniques. You would have learned this in your CA foundation, chapter 4. If the units are ordinarily interchangeable, one unit can be replaced with another, then considering historical cost, we learnt in foundation that we have FIFO, LIFO, SAM and VAM. But AS2 says you can either follow first in first out method or weighted average method. These two methods can be followed if ordinary items are ordinarily interchangeable. One product can be exchanged with the another, and we are considering historical cost. If we are not considering historical cost, for example, we're doing business in FMCG sector where number of units involved is huge, value per unit is very less. There we follow adjusted selling price method. We'll identify the closing stock at selling price, eliminate the profit margin from this. That will give us closing stock at cost. Or standard cost. Standard will fix cost price per unit, multiply with number of units that is there. That itself is the cost price of the closing stock. Standard cost method or adjusted selling price method. If we cannot replace one product with another, if the business is like customized clothing apparel or jewelry, all of this, one product cannot be replaced with another. There we should go by specific identification method. For every unit of inventory, we need to specifically identify the value of inventory. We cannot skip. Are you getting this? This is with regard to valuation techniques. And next comes to the part where what if in one production process more than one product pops out? We'd have to check whether the product that's popping out is a joint product or a byproduct. When do we call it joint product? When do we call it a byproduct? If the product has commercial viability, it has commercial value, it is material, it is joint product. If not, it is immaterial. It has no commercial value. It doesn't, you didn't have an intention to manufacture it. You are ready to throw it into that gutter. Then it is byproduct. Get this? Whenever it is joint product, the cost that you incur in the entire production process has to be allocated to both the joint products. How do we do it? If that expenditure is incurred after the split off point, after you split and then started processing both the items separately, then you have separate costs, allocate that cost to them. If this expenditure is incurred before split off point, that is when the processing is happening together for both the products, that has to be apportioned to both the products. How do we do it? In a common basis which is reasonable and viable and logical. That reasonable, viable, logical basis is sales value. That sales value can be taken for joint products at the time of sales, at the time of split off point, or at the final point of sale. Wherever it is more clearly and evidently available, such sales value will be taken, not sale units. Sometimes one joint product sale value is high, number of units is less. One more joint product, sale units is more, value is less. So we should take number of units multiplied by selling price per unit value of two joint products. In that ratio, we apportion the joint cost incurred for both of them. If it is byproduct, there is no separate valuation for byproduct. It is valued at NRV, net realizable value. And this net realizable value of the byproduct will be deducted from the cost of production of the total main product. This is if the byproduct is immaterial. It is called as a byproduct when it is immaterial. After some time, I told you a beautiful example if you remember that cocoa powder and yeah. So if in case this byproduct ends up becoming a material product, so then don't treat it like byproduct. Treat it like joint product. Allocate cost to it on a reasonable basis. You get that? That's with regard to joint product and byproduct. How do we value raw material? How do we value finished goods? Valuation of raw material actually depends upon how do we value our finished goods. If finished goods are sold at cost or above cost, then finished goods are valued at cost, and then raw material is also valued at cost. If finished goods is sold below cost, then finished goods will be valued at NRV, because finished goods is sold below cost. No, NRV is lesser than cost. Finished goods will be valued at NRV. When finished goods are valued at NRV, finished goods are sold at loss. Raw material might be sold at loss. Raw material, you are not having a proper intention to manufacture a finished goods. Then what do? Then our raw material will be valued at cost or NRV, whichever is less. However, if NRV of the raw material is not available, we'll take replacement price of the raw material as the reasonable. How do we value our work in progress? Work in progress, there is no active market. Cost incurred for work in progress plus cost expected to be incurred to complete it. If we add, we get the total expected cost when it becomes finished goods. Compare that with NRV of finished goods. Take whichever is less. If whichever is less turns out to be cost, then you know what's happening? Finished goods will be sold at profit. So we have proper intention of manufacturing work in progress into finished goods and sell it at profit. Profit will be recorded only when you sell. Conservatism. So value work in progress at cost. Value work in progress at. However, when you take the work in progress cost incurred plus cost to be incurred, you will get the total expected cost and you compare it with NRV of finished goods, then you get whichever is less is NRV. Meaning this work in progress, when it becomes finished goods, it will be sold at loss. Conservatism, we have to book that loss now. What do? That loss has to be deducted from cost incurred. That will be the value of WIP. That will be the value of. Alternatively, you can take NRV of finished goods, deduct the cost to be incurred on WIP. You will get the same answer. Either of the approaches, if you follow, you will get the same valuation of WIP. So read this part once again. This is slightly tricky. Then can we reverse the writing down? We had written cost or NRV, whichever is less to NRV. NRV which is lesser than cost. Can we reverse it? Yes, we can. If the conditions prevailing because of which NRV was lesser than cost have reversed. Such economic condition has reversed. We can reverse and restore the value of inventory to cost, not above cost. Inventory cost is 100, NRV is 80. So because of some reason, some downfall in the market, some lack of demand, we valued the inventory at 80. Next year, if such economic condition has reversed, we can take the value of the inventory back till 100, not for a price more than 100. This is a quick revision on accounting standard 2, valuation of inventories. Got it?
Let us now quickly revise accounting standard 10, property, plant and equipment. To call an item as property, plant and equipment, it has to fulfill definition criteria. Definition is TRAPE. What is TRAPE? T, it should be tangible. 2, RAP, it should be used for renting, administration or production of goods or rendering services. Once it is tangible and it's one among this RAP, we should check E. Expected useful life should be longer than one accounting period. Once this is done, it is a property, plant and equipment. Now, once it fulfills definition criteria, we will check recognition criteria. Recognition criteria is E and R. E, FEB, that is future economic benefit should flow from this asset. Then RM, reliable measurement should be possible for that asset. Once it fulfills definition criteria and also fulfills recognition criteria, we can recognize that as property, plant and equipment in our books of accounts. This standard of property, plant and equipment talks about three things. One, when to recognize, how to recognize and what value should be recognized, the PP. Second one, when to depreciate, where to say how to depreciate and how much to depreciate the asset. Last one is impairment. Impairment will be discussed majorly in other standard 28 when we discuss later. Got that? Then we talk about the scope of the standard. Similarly, AS10 also has scope. Certain things are covered in AS10, certain things are not. What is not covered? Biological assets. What do you mean by biological assets? With life. Once with life. Life will be two types. One, living plant. Second one is animal. Living plants and animals are not covered under accounting standard 10. They are biological assets and they are not covered under AS 10. However, exception is there. What is it? Bearer plant. Though bearer plants are biological assets, we give them a new name called bearer plants. This is exceptions to biological assets. So for these items, AS 10 is applicable. For biological assets, that is plant and animal, AS 10 is not applicable. But for bearer plants, AS 10 is applicable. What are bearer plants? A living plant is considered as a bearer plant if it fulfills all of the conditions. How many conditions do we have? 3 of them. Number 1, this should be used in producing agricultural produce. Second condition, that agricultural produce should be there for more than one accounting period. Condition number 3, there should be very remote possibility of selling this asset as an agricultural produce. You get this? Once these 3 conditions are satisfied, then that plant will become bearer plant. Once it becomes bearer plant, AS 10 is applicable. You get that? Then let's quickly see as to what are the other items for which AS 10 is not applicable. So for biological assets, AS 10 is not applicable. For bearer plants, AS 10 is applicable. For wasting assets like ore, mine, oil well, coal deposit, iron ore, gold mine, for all of these, AS 10 is not applicable. There is no standard applicable for them. There we apply generally accepted accounting principles based on industrial standards. Then we have things which are covered by other AS, like assets which are taken on amalgamation. For that, AS 14 will tell how to value. And items on lease, AS 19 will tell how to value. So whenever there is a separate standard telling how to recognize them, then AS 10 will say follow them, don't follow me. That's what AS 10 is all about. You got the scope of the standard? Then whenever we say asset has to be recognized, it should fulfill definition criteria, recognition criteria. Against this asset, if there is a spare part or if there is a standby equipment, can we capitalize it or not? Depends upon the fact whether that spare part or standby equipment, whether it will fulfill definition criteria or not. If it fulfills definition criteria, it is PPE. If it doesn't, it is not. You'll also check the recognition criteria to recognize at what value should it be written. Then, whenever we talk about recognition, there are two types of recognition: initial, subsequent. Till the date the asset is ready to be put to use, any cost that is incurred will be taken initial cost. Once the asset is ready to be put to use, after that whatever expenditure you incur will be taken only and only if it fulfills the definition of subsequent cost. Shall we see what is initial cost? Initial cost has three main categories. How many categories? First one, purchase price. Second one, directly attributable cost. Third one, cost of dismantling. Let's discuss the purchase price in detail. When we say purchase price, it refers to the price that we pay to get the asset. If you pay the money, get the asset, that is cash price. If you don't pay the money, get the asset, and we say that we'll pay late, and they agree, that price that we pay later will not be cash price. It will be deferred credit price. Such a price is greater than cash price because it includes interest. Such interest cannot be capitalized. We have to check accounting standard 16. It will be capitalized only and only if it is qualifying asset. It is a qualifying asset when it takes substantial period of time for setup. Substantial period definition is not given in AS 16. However, accounting standard interpretation 1 says that period of 12 months can be considered substantial. So purchase price will include only cash price. If there is deferred price, adjust interest. Interest can be included subject to accounting standard 16 borrowing cost. That is if it is qualifying asset. Got that? Next, what about taxes? Taxes, duties, or anything that we pay will be included in the cost of the asset if there is no input tax credit. If there is input tax credit, if there is no input tax credit, we'll include it. If there is input tax credit, we'll not include it. You get this? Yes. Then talking about what if you purchase the asset but for a non-cash consideration, meaning you don't pay cash, you give one more asset, barter transaction, or you give securities, then we need to check whether there is commercial substance existing or there is no commercial substance against it. How do we check whether there is commercial substance existing or not? Old asset without exchange, if we hold it, what is the cash flows that will generate? If we exchange it to a new asset, from the new asset, what is the cash flows that we generate? If both are same, no commercial substance. If the cash flows from old asset, cash flows from new asset are different, distinct, diverse, then it is commercial substance will exist. Do you guys get this? Very good. So if there is commercial substance existing, then the value of the asset given should be credited at book value, but the value of the asset that we get should be debited at fair market value of the asset given or fair market value of the asset taken, whichever is more clearly and evidently available. However, if both are available, it will be recorded at the fair market value of the asset given. Get this? And difference can be P&L. It will be transferred to P&L. See this? Any difference will be transferred to P&L account. However, if there is no commercial substance, you cannot book any profit or loss. There can be cash. If there is no cash, then the value of the asset that we take, should be recorded at the book value of the asset that we give. So asset going out credit, asset that we take debit. Same value for both, no profit, no loss. There can be adjustment with cash, but there cannot be P&L. Because there is no commercial substance, how can you make profit? This is with regard to non-cash consideration. We're done with entire purchase price. Now we'll discuss directly attributable cost. Directly attributable cost in short refers to all the cost that is incurred till the time the asset is ready to be put to use. From the time you buy the asset, unassembling the asset, packing the asset, loading the asset, cargo, cartage, freight, octroi, duty, and once it reaches the country, again unloading and then bringing it to the factory, unpacking, and then assembling, engineering cost, installation cost, site setup cost, everything incurred till the time the asset is ready to be put to use is capital in nature, should be capitalized. However, items that are excluded is to set up the asset. If you move the existing office to a new location, the rent of the new location, or if there is a new product to be launched, the product launch cost, new service launch cost, or new facilities created, inauguration cost, not included. General administrative overhead, not included. Selling and distribution overhead, not included. If you generate the asset yourself, you build the asset yourself, you can charge cost, you cannot charge profit. Internal profits are also not included if the asset is self-constructed. Last part, cost of dismantling. At the end of the useful life of the asset, we remove the asset. For removal of the asset, we might incur expense. That cost that is incurred to remove the asset to restore the facility, to dismantle the asset, to discard the asset at the end of its useful life should be discounted to present day's date, and that should be added to the cost of the asset. At what rate do we discount? The rate that they give in the question. If they don't give the rate, it should be done at the rate at which risk-free return can be earned on government bonds. That will be the rate that will be considered usually in the industry. But in our questions, they give the rate, we'll take it. If they don't, they'll give us a discounted value of itself. By this, we understood how the initial cost should be considered. Next, we'll understand subsequent cost, meaning asset is already ready to be put to use or asset is put to use. Now we incur cost. Can we capitalize? It can be if it fulfills recognition criteria. What is recognition criteria? What is recognition criteria? An asset can be recognized as PPE if there is future economic benefit from the same and there is reliable measurement. Once these two conditions are satisfied, then subsequent cost also can be capitalized. See, subsequent cost. To recognize it, it should fulfill recognition criteria. What is recognition criteria? Future economic benefit and reliable measurement. For example, if there is repairs and maintenance which is incurred on regular basis, charge it to PL. If there is replacement of parts in the PPE, you might have done this in CA foundation, capital revenue, capital revenue, capital revenue, rings and piston change, capital. What is a small part change? Revenue. So we should check the recognition criteria. Thereby to tell, no, check the nature of business, purpose for which it is incurred, recurability, materiality, all of that. Here we are more clear, standard answer. What does it say? Check recognition criteria. Fulfills recognition criteria, capitalize. Doesn't fulfill recognition criteria, don't capitalize. If you do any major inspection or overall, we did this in that airline question. Seats were changed. And what was that? One more was changed. Galley. Seats and galley when it was changed. So that was major change or major inspection when you do of the engine and everything in the aircraft. Once a year or twice a year. That should be capitalized. You make the overhaul of the entire asset. Check if it fulfills recognition criteria. If it does fulfill recognition criteria, capitalize. Otherwise, not. Do you get this? Next thing that we learn is about the cost model or revaluation model. At the balance sheet date, at what value should you record the asset? There are two options. This is not accounting estimate, this is accounting policy. So we discussed in AS5 also. So changing from cost model to revaluation model is change in accounting policy. So we have two models. One is cost model, other one is revaluation model. Cost model, what we do is we record the asset at original cost, depreciate it, remove the impairment loss if there is any, and then we'll arrive at the carrying amount. What if this carrying amount is incorrect? It is because this depreciation is not correct. Then we do revaluation. Instead, what we do is, here we take the carrying amount as a revalued amount. If the value of the asset is 10, we depreciated it by 1. Closing value is 9. We think 9 is not the right value. Asset should be 9,500 in the market. Then depreciation of 1,000 that we charged is incorrect. We should have charged it 500 depreciation. So what do? We record the asset at 9,500. Sir, but 10,000 minus 1,000 asset is 9. If you make that 9,000 asset as 9,500, you are making upward revaluation by 500. Alternatively, if the asset is 10, depreciation 1,000, asset is 9,000 in your books, but market value of the asset is 8,000 or market value is 7,500. You want to record the asset at 7,500. From 9, you bring it down to 7,500. That difference is downward revaluation. So if you follow revaluation model, you will take the revalued figure in 1 year. Next year opening will also be that fair market value or revalued figure. From that we deduct accumulated depreciation and accumulated impairment loss. After the revaluation, whatever you done, then what we get is the revalued amount, carrying amount at revalued value. You get this? So asset can be revalued. What do you mean by revaluation? You are not happy with the value that is there. Then you will say re-innosati value marna and you do valuation again. So that new value that you give to the existing value is revaluation. Revaluation can be done only for the class of the assets, not individual assets. Let us say I have two buildings, office building number 1, office building number 2. When I do revaluation, I cannot say I'll do revaluation only for building number 1. I should do revaluation for both building number 1 and building number 2. But I have two office buildings and one factory building. Can I say I'll do revaluation only for factory building? Yes. Because the purpose is different. The nature is different. So I can do revaluation for class of assets, not individual asset. See this? Revaluation to be done for entire class. Group of assets is similar. Grouping of assets is done based on the nature of the asset and use of the asset. Now, talking about revaluation, it can be upward, it can be downward. When you do upward revaluation, asset value is increasing, debit asset, credit will be given to revaluation reserve. If you downward revalue the asset, asset will be credited, debit will be given to P&L. Why P&L? It is loss. Sir, why not P&L here? Conservatism. If there is loss, recognize immediately. If there is profit, recognize it only when it is actual. What we do here is, whenever there is loss, we immediately transfer to P&L. Here, when we increase the value of the asset, we credit to revaluation reserve. The value of our asset has gone up. Let's say value is 10,000 asset. We revalued it to 11. Asset went to 11. Correct or not? If the asset was 10, next 10 years, depreciation would have been 1,000, 1,000, 1,000, 1,000, 1,000. Now, when you revalue the asset from 10 to 11, next 10 years, depreciation will be 1,100, 1,100, 1,100, 1,100. So, every year 100 rupees depreciation increased. That will be compensated by revaluation reserve transferred to P&L over 10 years. So, when the asset value increases, credit revaluation reserve, this revaluation reserve will be transferred to P&L over the remaining useful life of the asset. When the asset is downward revalued, entire revaluation should be transferred to P&L account in the very first year. Then there can be reversal. Let's say asset is 10,000. You revalued it up by 1,000. Revaluation reserve 1,000 is there. After you did it, you realized, 11,000 is wrong. Asset should be 10,600. Now, when you reduce 400, it is not downward revaluation. It is reversal of earlier upward revaluation. So, read this. If there is downward revaluation, but if the asset was previously decreased, if the asset is previously increased, now when we do downward revaluation, we will not write P&L to PPE. Here we wrote P&L to PPE, no. We write revaluation reserve to PPE to the extent revaluation reserve is there. When the asset is downward revalued, we usually write the, when the asset is upward revalued, we usually write the entry PPE to revaluation reserve. But if the asset was previously decreased, then we would have previously transferred the asset value to P&L, no. Now also to that extent we will transfer to P&L and not revaluation reserve. To that extent we had done before, because this is reversal and not upward revaluation. Asset which was previously upward revalued, if it is downward revalued, to the extent revaluation reserve is there, we will adjust with revaluation reserve, not transfer to P&L. If the asset which is downward revalued is now upward revalued, to the extent it was previously transferred to P&L, we will adjust with P&L, not transfer to revaluation reserve. Only beyond that we will transfer to revaluation reserve. Got it? This is with regard to revaluation. Last part, depreciation, derecognition and retirement. Depreciation of asset. Depreciation is systematic allocation of depreciable amount of the assets over its remaining useful life. And depreciation can be done under 3 methods according to accounting standard 10. 1. SLM, 2. WDV, 3. Production units method. How do we pick these methods? Based on the FEB, future economic benefit. If the future economic benefit is a straight line, SLM. If the future economic benefit is a slide, WDV. If the future economic benefit is dependent upon the level of production, production units method. Do you get this? We start depreciating the asset when it is ready to use. We stop depreciating the asset once the asset is derecognized. We start when it is recognized, we stop when it is derecognized. Whenever there is change in the method of depreciation, that is change in accounting, estimate as per AS 5. Next, derecognition. Recognition means asset is recognized. Derecognition means asset is not recognized. Stop. When do we stop? 1. Asset is kept ready for disposal. Or we recognize when there is future economic benefit. We derecognize when there is no future economic benefit. Meaning asset is stopped working, now we are keeping it ready for sale. So asset is disposed or there is no future economic benefit, then we derecognize the asset. Carrying amount of the asset is there, no, that will be immediately transferred to P&L, that will become loss. Sir, how does it become gain? If you sell it, it will become gain. And this entire derecognition is regulated by AS 9. Sale should be recognized when there is transfer of risk, reward and effective control. There is reliable measurement of the consideration and reasonable certainty of that receipt. Then we should recognize the sale. This is given in AS 9, not AS 10. And impairment of assets, we'll learn it in accounting standard 28. Last part, retirement. What is retirement? Retirement is stopping to work before you die. Asset is stopped working, but it is not yet dead. Asset is stopped working, but it is not yet dead. It is waiting to be dead. It is waiting to be. So asset is not in active use. It is held for disposal, but not yet disposed. Dead is like sold, not working, ready for sale, but not yet sold. Such an asset should be recorded like inventory. Inventory held for sale. Here asset is also held for sale. Inventory will not be used. We are selling bikes. Will you use the bike? No. You pack it and keep it ready for sale. Here also asset is stopped working or you have stopped using and this asset is ready for sale. Should be treated like inventory. How do you value inventory? Cost or NRV, whichever is. AS2 is not applicable. Treatment is like that of inventory. So here this asset should be recorded carrying amount, not cost. What is it? Carrying amount or net realizable value, whichever is lower. And when we do this cost or NRV, whichever is less, If in case we pick NRV, we're reducing the value of the asset. Such reduction in the value of the asset should be transferred to P&L account. Should be transferred to P&L account immediately. Did you guys get this? This, my friends, is quick revision of entire accounting standard 10 PPE. Ashte. Okay, now.
Let us now quickly revise Accounting Standard 13, which talks about investments. Starting with the definition of investments. Investments are assets which are held for the purpose of dividend, interest, rent, or for the purpose of capital appreciation. The scope of the standard specifically mentions what are the items against which Accounting Standard 13 cannot be applied. You cannot apply this standard to recognize income by way of dividend, interest, and rent. To recognize dividend, interest, and rent, no, Accounting Standard 9 is to be followed, not Accounting Standard 13. Accounting Standard 13 helps us understand how to account for investments, which will fetch us interest, dividend, and rent. And if you bought any specific asset, to give it on lease, either in the form of operating or in the form of finance lease, though you have invested money in the same, you cannot treat that as an investment under Accounting Standard 13, because there is more detailed Accounting Standard 19 which talks about how to deal with assets that are let out on lease or which are purchased on lease. Then talking about the last part, if in case you have an obligation to give a defined benefit to your employee at the end of his employment term, and to give the money like gratuity or any other funds to him on retirement, you are saving up some money at the end of every period. Such an amount is called as plan assets, and such an amount of investment made in mutual fund or in terms of equity instruments or debt instruments or in any other form to meet the requirements of retirement benefits to be given to employee will be specifically covered under Accounting Standard 15 employee benefits, and you should not try to account it under Accounting Standard 13, which talks about investments. Talking about investments, it can be majorly classified, like how I do is investment properties and financial instruments. Investment properties are investment in land, building, or anything of this sort, majorly for the purpose of capital appreciation, and this is the excess money in the business that's kept aside, and this is not in the ordinary course of operations. This is not to be used in the ordinary course of operations. So these will be majorly treated like Accounting Standard 10 PPE, and there is no great discussion about these items in 13, but they are covered under 13. But accounting is done under 10. Talking about financial instruments, debt instruments, equity instruments, all of these are majorly classified into two categories. One is current investments, other one is non-current investment. Whatever items which are expected to be sold within 12 months or you intend to hold it not longer than 12 months are current instruments, and they should be readily marketable. If they are readily marketable or readily realizable or readily convertible into cash, and you intend to hold it for less than 12 months, then it becomes current investments. On the other hand, if it is not a current investment, it will be called as non-current investment. Why do we classify a financial instrument held as an investment into current and non-current? This is because the way we account current investments and the way we account non-current investments is different. Current investment is valued at cost or market price, whichever is less. However, on the other hand, a non-current investment is usually valued always at cost. However, whenever there is decrease in the price or the market price or fair market value, whatever you call by, of a non-current investments, and such decrease or dip is permanent in nature, it's not going to get recovered, then you provide for such loss and decrease the value or cost of that non-current investment. Otherwise, a non-current investments will be always valued at cost, and our current investments on every balance sheet date will be restated to cost or market price, whichever is. Now, the next is the discussion on cost. What and all does cost include? Cost includes purchase price that you incur to buy the specific instrument. If in case you paid some brokerage, registration fees, stamp duty, security transaction tax, anything in this context, that will also be added to the cost of the asset. And if in case you have purchased this specific instrument on a date other than the date on which dividend is issued, or on a date other than the date on which interest is issued, then that instrument what you buy would not just include the price of that instrument, but it will also include the accumulated interest or accumulated dividend. This has to be eliminated. We need to record the investment in the form of debenture at X interest price and share at X dividend. But share, the context is slightly different. I'll come back to it slightly later. Whenever you buy a specific debenture, there is a possibility that the seller will recover interest accrued till that date from us.
We need to identify and eliminate that interest and then take the price. If they give cumulative of interest, we'll eliminate the interest. If they give excluding interest, when interest is not included, we'll take the tax interest. Brokerage as a percentage when it is given in the question, brokerage or stamp duty as a percentage when it is given in the question, to be computed on X interest price or cum interest price, whatever is mentioned to us in the question. If the question gives X interest price, on that we'll compute brokerage. If the question gives cum interest, on that you compute brokerage and then eliminate interest. You get this? This is because broker charges the brokerage on the price that we agreed or mentioned in the agreement. And we believe that the transaction price what they've given to us in the transaction is the price at which the agreement is entered between the buyer and seller. Then same thing, talking about interest, dividend and rental. These are incomes and it should be transferred to P&L. This cannot be capitalized, cannot be included in the cost. If in case we compensate the seller for some amount of interest or dividend, what he has earned but we will receive, that has to be eliminated from the price. And what if there is non-cash consideration, meaning we have purchased a specific instrument but we have not given cash, we have given another financial instrument, or we have given asset in any other form as consideration. That specific asset what we receive as investment, in this case, no, unlike A10, always commercial substance is there, because no two instruments will give same financial return, cash flows will be different, so it's always like commercial substance is it. So the asset that we received for non-cash consideration should be recorded at the fair market value of the consideration given, fair market value of the asset sent or fair market value of the asset received, whichever is more clearly and evidently available. If both of them are very clearly and evidently available, priority 1 is given to fair market value of the asset given away. After this, let's talk about the treatment of dividend. A minute ago, I told you we'll discuss later. This is the context. So dividend can be treated into two times depending upon the point of holding. One is pre-acquisition dividend, other one is post-acquisition dividend. What do we mean by pre-acquisition dividend? So now whenever the company declares dividend, the period for which the company is declaring dividend, during that period, say the period for which the company is declaring dividend, during that period, if you are the holder of share, that is pre-acquisition dividend, sorry, post-acquisition dividend. If in case you bought the share after the period for which the dividend is declared, it is pre-acquisition dividend. Let me give an example. Let us say company is giving dividend for the year 2023-24. The dividend for the year 2023-24 is issued in 24-25. In the year 2024-25, let's say some date in the month of July, when we are receiving dividend, when we are receiving, I bought the share in April 2024. I'm receiving the dividend in July, but I'm receiving dividend for April to March 2023-24. So from April 2023 to March 2024, I was not holding this share. I bought this share only in April 2024. Now I'm receiving dividend in July. So this dividend is from the profit for the period during which I was not the shareholder. So this dividend is pre-acquisition dividend. Let us say instead of buying the share in April, I bought the share in March. It doesn't matter what date. Let's say I bought the share in March 2024. Then in the month of July, company is declaring dividend for April 1st, 2023 to March 31st, 2024. During that financial year, I've been holding the share. So the dividend that I receive in July is post-acquisition. After I bought the shares, I've received the dividend. If in case the dividend is pre-acquisition dividend, it is not my income. I have not earned that dividend. So this dividend belongs to the holder of the share in the previous year. So the holder of the share in the previous year, when he sold the shares to me, he would have sold it at a price higher than the normal price. So the purchase price, what I've recorded in my investment account on the debit side, would be cumulative of dividend price. But unlike debenture, I cannot deduct it at the time of entry because on the date when I purchased, I don't know how much of dividend. So I would have recorded at cumulative dividend price only. On today's date, when I get to know the dividend, I would have to reduce the cost, what I already recorded in my investment account debit side. But I cannot change the entry what I recorded long ago. So what do I do? To reduce the cost, I'll write the pre-acquisition dividend in the amount column on the credit side in investment account. If I write dividend received for the pre-period in my amount column in the investment account on the credit side, it will decrease the cost which is recorded in the debit side in the amount column on the investment side. On the other hand, if the dividend is post-acquisition dividend, this is received for a period after I acquired the shares, such dividend amount will be written in the dividend column because it is income which will go to P&L.
By writing pre-acquisition dividend in the amount column, we reduce the cost. By writing dividend in the dividend column, we treat it as income and post it to P&L. That's the difference between pre-acquisition and post-acquisition. Pre and post-acquisition dividend concept comes up only and only for final dividend. That is dividend declared by the company in the general meeting for an entire year. However, between two annual general meetings, if the company declares dividend, that is called as interim dividend. So during the year you're holding the share, during that year only you receive the dividend, you have already acquired the shares and they've given the dividend. So interim dividend is always post-acquisition dividend. This will not be adjusted against the cost. Post-acquisition dividend will be returned to P&L account. So you should write it in the investment account in the dividend column, not in the amount column. That's with regard to interim dividend. Then talking about shares. So company can issue two types of shares other than the normal issue. After you have acquired the shares of a company, you can receive bonus issue, you can receive whenever the company gives you bonus issue, it is free shares received. It is capitalization of reserves. With regard to bonus issue, only the nominal value of the shares is increasing, but price is not at all increasing. For the sake of accounting and for disclosure purpose, you will prepare one column in the investment account called as nominal value column. This is not the amount column. This has no significance. Just to ensure that dividend can be computed with ease and disclosure requirement is fulfilled, we'll write that dividend. We'll write that nominal value column. So whenever bonus shares are received in the debit side in the investment account, write two bonus shares. It is not a proper journal entry. Just write two bonus shares and write the amount only in the nominal value column, nothing in the dividend column, nothing in the amount column. So only nominal value of the shares will increase because of bonus issue. And after this, if in case there is sale of shares, don't say bonus shares are sold, so purchase price is zero, entire sale consideration is profit. That should not be how we account it. You should always remember that once the bonus issue has happened, share value in the market will get averaged out. So we take the opening shares held plus bonus shares. That will become our denominator. And the cost that we had incurred for acquiring the opening shares, that will be the numerator. So total value of the shares before bonus issue divided by shares before bonus plus bonus shares, that will give us the average price. And this is the average cost of bonus shares even when they are sold. So don't write the total sale value of bonus shares as profit. You need to find the average cost and then determine the sale consideration and profit of bonus share. If in case it is right shares, all we need to remember is right shares whenever it's given, the investor has three options. One, to subscribe the shares. Two, to renounce his options. Three, to do nothing. If the subscriber, if the right shareholder subscribes to the shares, it is a normal purchase entry, but the entry will be at right issue price. So we'll write bank account debit to investment in shares. So in investment in shares account, you'll write on the debit side 2 back. Write that amount in the amount column, and that's it. Very simple journal entry. If in case this shareholder renounces his right, sells his right to some other person. Remember, he's not selling the share, he's selling the right to buy the share. Such sale consideration, that is number of rights sold multiplied by right value, whatever consideration you get, this has to be taken to P&L account credit side. This has no place in investment account. It has to be taken to P&L account credit side. This has no place in investment account. However, there is an option given in the standard. This is not mandatory. This may be followed. This may be followed. This is when you bought the shares today and immediately company announced right issue, and right after that share price dipped. And during this you sold the rights. So you purchased the shares at cumulative right price and the company made right issue, and right after the right issue share price in the market dipped. In that case, whatever the number of rights you sold multiplied by selling price, whatever you get, instead of taking it to P&L, and here these shares X market price decrease, no? So when you take the cost will be at cumulative right price. And then the closing balance number of shares will be at theoretical X right price is their market price. When you do cost or market price, whichever is less, it becomes less, and such loss will go to P&L account debit side. So sale of rights income you wrote to P&L account credit, cost or market price, whichever is less when you did less, that also goes to P&L. So one is expense, other is income. Instead of writing expense and income in P&L, that income what you get by sale of rights, you have an option to reduce the cost of the investments using this, to ensure that there is no separate charge to P&L. So this is just an option given. So I'll repeat this again. Whenever the right options given by the company to the shareholder are sold by the shareholder, sale consideration, that is number of rights multiplied by right issue price, will be transferred to P&L account credit side. However, if the shareholder buys the share at cumulative right price and immediately after the purchase, company goes for right shares
and then investor sells his rights and there is decrease in the price, then the investor has an option to take that consideration in the amount column on the credit side in investment account to adjust the cost. This is just an option given. And the last one, if in case the shareholder does nothing, let's say it doesn't buy the share, doesn't sell the right, you also do nothing and eat this 5-star. Don't eat it because I want it here. And the last part is reclassification. When you classified an investment as long term, thinking that you will hold it for long term, period longer than 12 months, and later you feel like no, you want to dispose it, you want to reclassify it to current investment now, then what should you do? Such an investment which was long term, which is now about to be shifted to current investments, should be valued at the original cost or carrying amount what is there. Carrying amount might be different from original cost only and only when there is huge decrease in the value of that long-term or non-current investments, that is adjusted. Otherwise, that long-term investments will be at cost only. However, if it was huge decrease and it is recorded, that carrying amount will be less, cost will be more. Whichever is less will be considered. Got it? However, in a vice versa scenario, you have initially recognized an investment as current investments, which is expected to be sold within 12 months. Then you see a long-term potential in this investment and you want to reclassify it to long-term. When we do that, you need to do it at cost price or fair value, whichever is less. Fair value here refers to market price. And this is how we value or count for investment. Let's now quickly revise Accounting Standard 16, which deals with borrowing cost. Borrowing cost usually refers to the cost incurred for borrowing the money, giving you the first impression that it is dealing with interest. Interest is form of borrowing cost, but interest is not the only thing which will be called as borrowing cost. The word borrowing cost will include several other things. What and all will it include? Like in the case of Accounting Standard 19, finance lease, when we take an asset on lease, for which we are making the payments in installments, we might pay them much more than the cash price of the asset. That excess money paid, what we call as finance cost or unearned finance income in the books of the person who's giving the asset, that is also borrowing cost. This will be computed as per AS 19, but it can be treated as borrowing cost as per AS 16. Next, interest and commitment charges. When we take loan, we pay interest. That interest is borrowing cost. If we give them commitment stating that this money that I borrowed, I'll repay it after 3 years only. Even if I repay it at the end of second year, I'll still pay third year interest or I'll pay some compensation like your prepayment charges in loan. That is also to be considered as borrowing cost. Then comes the interesting topic of discount or premium on borrowings. If in case the borrowing is in the form of debentures, at the time of issue of debentures, if we give discount or on redemption of debentures, if you are paying them premium, that discount on issue or premium on redemption would have done this. No, discount on issue plus premium on redemption is loss on issue. That loss on issue is also to be treated on par with borrowing cost. Then next topic is about amortization of ancillary cost. If in case to take this borrowing, you have incurred some expenditure, that expenditure will also be amortized along with the borrowing cost. So that's also part of your borrowing cost. And this one last beautiful item, this is exchange difference. Usually the borrowing will be in Indian currency in an Indian bank. If in case you have a borrowing outside India in a foreign bank, like foreign currency borrowing, that foreign currency borrowing has to be restated at the end of each year because it is a monetary item. We've discussed this in AS 11. If you want, please go back and revise AS 11 after this. So when you restate a foreign currency borrowing which is there in a foreign currency, from the recording date or reporting date to closing date, that difference, what appears to be exchange difference, can be construed as not foreign exchange difference, but can be construed as borrowing cost to an extent. To what extent? That we'll discuss towards the end of this video. Now, going further, all these items, FIDAE, what we call as FIDA, will be called as borrowing cost. Usually, before Accounting Standard 16 came into picture, we feel like transferring this borrowing cost to P&L. But Accounting Standard 16 wakes up to tell us that if in case this borrowing is made to buy a qualifying asset or to build a qualifying asset or to install a qualifying asset, then instead of transferring this borrowing cost to P&L, add it to the cost of the asset, capitalizing the borrowing cost instead of transferring it to P&L. That brings us to the question, what is qualifying asset? Does it have to write an exam to pass? No. An asset will be called as a qualifying asset if such an asset takes substantial period of time for its setup. The asset should take substantial period of time for its setup. It should take substantial period to be ready. Sir, my friend takes more time to ready. Can I call her qualifying asset? You can call her qualifying assets, but I am not responsible if she slaps you. The point here is asset will take substantially longer period of time to be set up. The word substantial is not defined by accounting standard 16. Is it referred by any other accounting standard? No. But I have to refer accounting standard interpretation 1. ASI 1 says 12 months, but it is not 12 for all the cases. It is left to our professional judgment. Certain assets which take 11 months can be called as qualifying assets. If you think that time period it took, no, during that whatever interest paid, it is better off capitalized, not rather than charging to P&L. Sometimes if an asset take 14 months, you can say, hey, this could have been installed in 8 months. By mistake, because of our delay, we took 13 months. Let us not capitalize. That can be a decision. So 12 months is not a hard and fast rule. The substantial period is left to professional judgment of the accountant. I hope you guys understood this part. Like I mentioned, whenever you take a borrowing, this borrowing includes FIDAE, and if it is incurred against a qualifying asset, instead of charging to P&L, we should add it to capital. We should add it to the asset. If it is not against qualifying asset, it should be charged to PL. What is included in the borrowing cost is this FIDAE. What is not included is any imputed cost, imaginary cost for raising equity or preference is not considered. Only on the borrowing, and the borrowing has to be actual. Can I say, if in case I had borrowed, I was supposed to pay 8%. Instead of borrowing, I've taken capital. I'll apply 8%. Can you apply? Apply 8%. But that's just for your noting. You can't apply A16 on that. It is not on imaginary interest. It should be actual interest. I hope you got it.
Yes, sir.
This borrowing, whatever we take, can be two types. One, specific borrowing. Two, general borrowing. Specific borrowing says, okay, I am there only for you. If you are not there, I am not there. I came just for you. Till the day you are there, I am there types. Meaning that borrowing is made only for the purpose of qualifying asset. When you're borrowing also, you told them why you need money. I need this money just for this asset. If not, I would have not taken money from you. And after we take, that money is used only for that. That is specific borrowing. Specific borrowing is a borrowing specifically made for the purpose of qualifying asset. On the other hand, what do you mean by general borrowing? It is other than specific borrowing, not borrowed for specific purpose. General borrowing money can be used for buying that asset, can be used to do party, can be used to do employee benefit expenses payment, can be used to do anything. Yeah, you can do anything out of it. So what we do with specific borrowing rate is we apply actual borrowing rate to compute the amount to be capitalized. With regard to general borrowing, what do? There can be more than one general borrowing. If there is only one general borrowing, we'll take that rate. If there is more than one general borrowing, we don't know which general borrowing is utilized. So if there is about 3 general borrowings, we'll rate general borrowing 1, general borrowing 2, general borrowing 3. Interest rate on GB1, interest rate on GB2, interest rate on GB3. Multiply principal with interest individually, take the total interest, take the total borrowing, total interest by total borrowing. If you do, we'll get weighted average rate. That weighted average rate will be applied for identifying interest on the funds used from general borrowing. Are you guys getting it? With regard to a specific borrowing, we will start capitalizing the interest from the date of borrowing the money. However, on general borrowing, we start capitalizing from the date on which we spend the money. When I say date of borrowing, it is subject to the conditions that assets active construction has started, money has been actually borrowed, interest has been actually started. All the 3 conditions should have been fulfilled. Only then we can start capitalizing. When do we stop capitalizing? The day the asset is ready to be put to use. Is it different for qualifying, non-qualifying? No. Whether it is qualifying asset or it is non-qualifying asset, end date is same. That is the date on which the asset is ready to be put to use. However, beginning date for a specific borrowing will be date of borrowing, provided that the conditions are fulfilled. For a general borrowing, it is date of spending. Do you guys get that? The priority will be usually given to specific borrowing first. Let's say I've spent 10 lakh rupees on the asset. I have a specific borrowing of 8 lakh. I have general borrowing of 5 lakh. I will first use up entire specific borrowing for the 10 lakh asset. Balance amount that is spent on the asset after the specific borrowing is assumed to be taken from general borrowing. And during the idle period, like I have borrowed the money, but I have not spent it on the asset. When the money remains idle, like idly, on that if I earn interest income, that interest income has to be deducted from the borrowing cost before adding to the capitalized part of that asset. This facility is only for specific borrowing. Why? For specific borrowing, we start capitalizing from the date of borrowing.
I borrowed today, but I spent next month. This month the money is idle. On that interest, what is earned will be deducted from the total interest, including this month interest has to be capitalized. From that we deduct, only leftover amount will be capitalized. From 1st of April, asset construction started. From 1st of April, you made specific borrowing. Specific borrowing money got spent only in 1st of May. 1st of April interest cost also can be capitalized because it is specific borrowing. During 1st of April, if there is some idle period and you earn some interest income, that will be deducted from the total specific borrowing cost and only then it will be capitalized. For general borrowing, this facility is not there. That interest income earned on the idle period will be going to P&L. Why? If I make general borrowing on 1st of April, if I spend general borrowing from 1st of May, April month's general borrowing interest will not be added to the cost of the asset. It has to go to P&L. Why? For a general borrowing, the capitalization starts only from the date of spending, not from the date of borrowing. I hope you guys got it. Going slightly forward, then we'll discuss when do we start capitalizing, when do we pause capitalizing, when do we stop capitalizing. Start date will be based on these conditions. Conditions: number one, expenditure should be started for developing the asset if you are building it. If you're buying it, expenditure should have been incurred to buy the asset. Next one, borrowing cost should be incurred, meaning you should have borrowed that money, interest computation should have started. And if in case you have not purchased the asset, if you have if you have not developing the asset, if you have purchased the asset, the process of purchase and installation should have started. If you are constructing the asset, process for construction should have started. So basically, expenditure should be incurred, construction or installation process should have started, money should have been borrowed, and interest should have been started. Only then you can commence the capitalization. When do you stop capitalization? When the asset is ready for its intended use. In between, if there is place where you pause the development of the asset, you are allowed to suspend, meaning basically temporarily stop capitalizing. Let's say the asset construction is happening over 18 months. After about 9 months, you've taken break of 2 months. This 2 months interest, instead of adding it to the cost of the asset, you can choose to transfer to P&L. If you choose to transfer to P&L during those 2 months, that is called suspension. After those 2 months, when you again start the active development, again you can start or again you can continue capitalizing. However, if the delay is necessary for the construction process, we took the example of you building a bridge over the sea. During the high tide season, 2 months you don't do active development. That is part of the process. During those months, you don't stop capitalizing. You continue capitalizing. Those 2 months also will be capitalized. You get what I'm trying to tell? Then we have the last part of our standard, which basically deals with exchange difference. See, we all know that we will take the loan at the place where the interest rate is less. Let's say I have purchased one asset. To purchase this asset, qualifying asset, I want money. That money what I want can be either taken as a borrowing from Indian bank or from a foreign bank. I would take it as a borrowing from the country where the interest rate is less. Let's say in India the interest rate is 8 and in foreign country the interest rate is 2. It's so tempting to borrow the money in the foreign country. I borrowed the money in the foreign country. On that foreign currency borrowing, let's say dollars, let's apply foreign currency exchange rate and let's apply foreign interest rate. Foreign currency borrowing multiplied by interest rate in the foreign country multiplied by closing rate of exchange will give me actual borrowing cost, which should be taken here. That is actually my borrowing cost. There is no doubts in that. But what has happened is between two countries, exchange rates move because of the interest differential between two countries. In India, if the interest rate is 8 and in USA the interest rate is 2, exchange differences will move in such a way that this advantage cannot be taken. I'll tell you in short what you should do. There is some additional borrowing cost what you should identify. How do you do that? Very simple. Identify how much is the interest that you would have paid if you had taken the loan in India. You get some interest. You identify the interest that you paid because the loan is in foreign country. Compare them. You saved some money. You paid some lesser money as interest. This is point A. You keep it on one side. At the beginning of the year, you had recorded foreign currency loan at the opening rate. Restate that foreign currency loan to closing rate. Then there will be increase in liability. Compare both of them. Whichever is less among both of them will be considered as additional borrowing cost. And that will get added to actual to be found the additional one. In fact, I'll pin a separate link on this video in the description for this foreign currency borrowing to you people. You can watch that to understand this. And from the total increase in liability, we deduct the additional borrowing cost. Whatever is remaining will actually become your foreign exchange difference to be treated as per AS 11.
AS11, foreign exchange difference, AS11. Part of foreign exchange difference can be treated as borrowing cost, that comes under AS16. Ultimately, at the end, you need to disclose what is the accounting policy that you are adopting, what is the amount of borrowing cost which you are not choosing to transfer to P&L, and then which you are adding into the cost of the asset, needs to be disclosed separately as disclosure requirement. Did you get this? Let's now quickly revise Accounting Standard 19, which talks about leases. To begin with, what is a lease? Lease is an agreement between two parties. Who are the parties to agreement? One person is called lessor and the other party to lease is called as lessee. The agreement is to transfer an asset. Lessor is the person transferring the asset. Lessee is the person who is calling the asset. So lessor transfers the asset to lessee. Whenever he is transferring, he will prepare one document writing that I am giving the asset to you for a consideration that you would have to give me, and that becomes a lease. So lessor transfers the asset to lessee for the consideration to be given by lessee to lessor over the lease period, and that becomes a lease. And actually, there was no need for a big standard like lease. The problem started when people started fabricating sale transactions into lease. To overcome this kind of a problem, which needed lot of accounting discrepancies, the standard brought into picture just to divide the leases into two categories: operating and financing, where operating leases are actually genuine lease transactions. Finance leases are nothing but sale transactions, sale of asset on credit, but pretended to be like a lease transaction. Because people started pretending it as a lease, government prescribed a separate accounting for that kind of lease, which is actually not a lease but a sale, but pretending to be a lease. You'll understand slowly. I'll help it to you people. Certain things that you should know: it is scope. The standard does not apply to exploration of natural resources, mining, ore, natural resources. When you take AS19 is not applicable. And if the licensing of these videos, plays, motion films, you give a movie to Amazon Prime and all of this, so that kind of things, no, accounting standard 19 lease is not applicable because they are intellectual properties and intangible assets. And next step, for use of land also, again AS19 is not applicable because land usually has indefinite useful life, and for lease purpose you should have an asset with definite useful life. So AS19 doesn't apply here again. There are two categories of leases. One is finance lease, second one is operating lease. A lease where substantial risk and reward is transferred by the lessor to lessee is finance lease, basically sale. Substantial risk and reward is transferred. You remember AS9, we discussed the same thing. If the substantial risk and reward against an asset is transferred from lessor to lessee, it is finance lease. If it is not a finance lease, it is operating lease. Operating lease is giving an asset on rent. Finance lease in short is sale of an asset. Finance lease in short is sale of an asset. And in order to call a lease as finance lease, it should be non-cancelable lease. Meaning what? It should not be cancelled. Sir, cancel madangelva. No, it should be cancelled only by a remote contingency. It should be cancelled only at option of the lessor. It should be cancelled in order to enter into new lease with the same party. That is basically making it non-cancelable. Then how do we classify a lease into operating lease or finance lease? These are the conditions. It is not like 1 out of the 3 conditions are fulfilled, 2 out of the 5 conditions. There is no 1 out of these many. You need to judge them professionally. What are the conditions? Number 1, lessee will get ownership of the asset at the end of the lease. Lessor is the owner. No, lessee is only user. When the lessor gives the asset to lessee to use it, lessee should use the asset and give it back. At the end of the lease, if the lessee is having a right to buy the asset, then it is actually not lease only, it is sale. Am I right? During the lease period, asset is with lessee. After the lease period, asset will be with lessee. Then where is lease? It is sale. You fabricated to look it like lease. So the primary condition is lessee, if he has an option to buy the asset at the end of the lease period, then it is finance lease. Next one, lessee has an option to buy the asset at the end of lease, but not like others. Let's say you are lessee, I am lessor. I have given the asset you on lease for 5 years. At the end of 5 years, if I take the asset back from you and give it to somebody else, they will give me 10 lakh rupees. But I am giving the asset to you after 5 years, not for 10 lakh, but for 2 lakh. Why is it that you're getting it at a price lesser than 10 lakh? Maybe because I've already collected enough money from you. Maybe because other than you, nobody else can use that asset. Maybe because that asset is designed for your usage only. Or maybe because the asset's effective useful life is over at the end of the lease. Meaning,
I have not given the asset to you on lease. I have sold the asset to you, but fabricated to make it look like lease. So primary condition number one, lessee has an option to buy the asset at the end of lease period. Condition number two, lessee will buy the asset at the end of the lease period at a price lesser than fair value. Fair value means arm's length price in an unrelated market with an unrelated party on whom I don't have undue influence or coercion. At what price will I sell? If I am selling to the lessee at a price lesser than that, then it is finance lease. Come to the third condition. Lease term covers major part of the life of the asset, or we can say lease term, the period for which I have given the asset on lease to you, covers substantial period of the useful life of the asset. When we say substantial period, there is no 90%, 20%, 50%, 60%. It is pure professional judgment. And just based on one condition, we cannot tell finance lease or operating lease. We need to see all the five conditions, and based on all the five conditional numbers, we need to come with a professional judgment. Yeah, usually there is a misconception. I don't know where and how does it start, but people start telling 90%, 75%. Please slowly refer the questions in the past. There are questions where useful life and then come part of lease has come to 74%, 73%. Still, it is considered as finance lease. So it is no rule. Counting standards itself is basically not rule based. It is always principle based. This is one part. The useful life of the asset, whatever is there, no, major part of its useful life, it's on lease. If it is on lease for major part, it is finance lease. Got it? Basically, after the lease, lessor doesn't have a point of taking that asset back. Why? Asset is dead already. Meaning, entire useful life, it's on lease only. So actually, I did not give it to you on lease. I sold it to you, man. Do you agree with me? Very nice. Come to the next part. Present value of minimum lease payment. I am lessor. You are lessee. You have to pay me money. I am lessor. You are lessee. You have to pay me money. The money that you're supposed to pay me as per the agreement is called minimum lease payment. Minimum money, what you should pay to me is minimum lease payment. How do we have to pay money? You have to pay money in two forms. One, every period, at the end of each periodic payment. We call it periodic payment. That is lease rental. Second one, you have an option to buy. No. Because you have an option to buy. If you agree to buy, you promise to pay me some money. That and this together is minimum lease payment. You have agreed to pay periodic payments and you have agreed to pay some money at the end to buy the asset. So lease rentals plus residual value guaranteed by lessee. Lease rentals plus residual value guaranteed by lessee. Putting it together will form the minimum lease payment to be made by lessee to lessor as per the lease agreement. And this you would not pay me today. You would pay first lease rental at the end of first period, second lease rental at the end of second period, third lease rental at the end of third period. It is periodic payments that you would make. These periodic payments, I would have to identify the present value of these future payments. Today, if you're making me 1 lakh rupees lease rental payment for 5 years at the end of each year, today's value is not 5 lakh. At the end of year 1, I get 1 lakh, not today. At the end of year 2, I get 1 lakh. Year 2, if it is 1 lakh, year 0 beginning, how much is it? We will discount it to find it. So that is the reason we take PV, present value of the minimum lease payment that I'm going to receive in the future. That should form substantial part of the cost of the asset. That should form substantial part of the cost of the asset. The mindset that you would have to have here is keep lease aside for some time. I am lessor, you are lessee. I have sold the asset to you, but you are not paying the money to me immediately. You will tell you will pay it in 5 installments. I will charge you interest. Interest is my income which should go to P&L. The money that you paid for the asset should be my cost of the asset reimbursement. Am I right? Let's say you're paying 1 lakh, 1 lakh, 1 lakh 5 times over 5 years. You get it? So I will say 1 lakh, 1 lakh, 1 lakh is principal plus interest, principal plus interest, principal plus interest. Let's say the cost of the asset is about 1 lakh. I'm telling today if you pay 4 lakh and take the asset. If you're paying in installments, I want you to pay 1 lakh every year for 5 years. In that 1 lakh every year, if you pay 5 lakh, if you pay 4 lakh is the cash price, you pay 5 lakh, 1 lakh is interest. That interest income, I don't earn it in the beginning of year 1. I earn it at the end of year 1 little, at the end of year 2 little, at the end of year 3 little, at the end of year 4 little, and balance money at the end of year 5. So to me, 4 lakh is the amount that I'm supposed to recover from you right now for the asset. 1 lakh I will charge you extra because of delay. This 1 lakh is my finance income. At the beginning of year 1, this 1 lakh is unearned finance income. Why? I will earn it eventually over the period. So I should record your receivable at 4 lakh. Basically, that's what I'm trying to tell. You eliminate the interest portion, identify the price at which you sold the asset. That price at which you sold the asset is nothing but minimum lease payment that you would have to pay to me. That is lease rentals plus guaranteed residual value promised by lessee to the lessor in the lease agreement discounted to the first day is present value of MLP. If the present value of MLP is forming substantial part of the cost, again, why are we comparing it with the cost? Very simple. Present value of MLP is the money that you're paying for buying the asset. If you paid me almost entire cost of the asset, then it is finance lease, basically sale. You get that? Again, here substantial means there is no definition. 60 can be substantial, sometimes 70 might not be substantial. We'll see all the considerations together. There is no percentage mentioned anywhere in the standard. I hope you people got that. Then the last one that we have is asset is of specialized nature. Asset is so specialized that only and only you can use. Other than you, nobody else can use it. Only and only you can use the asset, not nobody else can use the asset. Then even after the lease period, I don't have an option. I have to give the asset to you only. I can't sell it to anybody else. It is as per your requirements. That is, asset is of specialized nature. If the asset is of specialized nature, then the lease is finance lease. There is no one of these conditions, 2 of these conditions, and 3 of these conditions. Check all the conditions based on professional judgment. You decide it. You guys got that? What are the 5 conditions? Lessee has the right to buy the asset at the end of the lease period. Lessee has the right to buy the asset below fair value. And then major part of the useful life of the asset is covered by lease. And present value of MLP covers the cost of the asset. Major part of the cost of the asset. Asset is of specialized nature. If these conditions are fulfilled, it will be finance lease. Understood? In the case of finance lease, as a lessee, you pay me lease rental, which is periodic. You pay me residual value, which is at the end of the lease period. Lease payment is periodic. Guaranteed residual value is at the end of the lease. Guarantee can be given either by the lessee or someone on behalf of the lessee. Either it can be guaranteed by the lessee or someone on behalf of the lessee. Sometimes lessee does not guarantee. Lessee will tell, let us see. That day, if I feel like paying so much, I'll pay. That will be not guaranteed, but still believed to be residual value of the lessor. Lessor has asked, lessee has not agreed. You are telling at the end of the lease, you will pay 2 lakh rupees for the asset. I am asking 5 lakh. I have told 5, but you agreed only 2. So according to lessor, residual value is 5. According to lessee, agreed and guaranteed is only 2. So 3 lakhs, what the lessee has not agreed, but lessee still believes, is unguaranteed residual value. Whenever you do any accounting from lessor's perspective, you will do MLP plus GRV plus UGRV. Whenever we do any computation from lessee's perspective, you will do MLP plus GRV. UGRV will not be considered. Why? You did not guarantee. Why will you consider? I am still feeling that I'll receive it in spite of no guarantee. So I will consider the same. So minimum lease payment is the money that you have promised that you will pay. What have you promised to pay? You promised to pay lease rental plus guaranteed residual value. If I take present value of it, present value of MLP, that will be the point of discussion. And then comes another point called as gross investment. Gross investment is basically money that I am expecting to have been invested on that asset. I am supposed to recover what you pay plus what you have not promised to pay. What have you promised to pay? MLP plus GRV. What am I thinking I'll receive over and above that? UGRV. Add UGRV to it, it will become my investment. What investment? Gross investment. What is my investment? So what is your MLP? Lease rental plus GRV. What is my investment? MLP plus UGRV or lease rental plus GRV plus UGRV. So that's from my standpoint. To you, you are not supposed to pay MLP right now. Your liability right now is present value of MLP. What is your liability? Present value of, when you record your liability towards lessor, you will record it at present value of MLP. When I record my asset, I will record it at present value of gross investment, including unpromised, unguaranteed residual value. And this present value of gross investment is nothing but net investment. And difference between gross investment and present value of gross investment, the difference is there. No, That is the interest income that I will earn over the lease period. At the beginning, I have not yet earned, so we call it unearned finance income. What do we call it? Unearned finance income. So quickly see it. This is how it will look like. Gross investment is total lease rental plus guaranteed residual value by lessee. If you add these two to this, if you add unguaranteed residual value, it will become gross investment. And net investment or present value of gross investment is present value of all of this, present value of lease rental, present value of GRV, present value of UGRV. You get present value of net investment. To take difference between gross investment and present value of gross investment, you actually get finance income. I don't want you to follow this format. I'll tell you, just have to write year 1, 2, 3, 4, 5 lease rentals. You write here, add GRV, you get GI, and then add you get MLP, add UGRV, you will get GI. You'll write present value factors here and then multiply, take the total. GI is here, present value of GI is here. Different will become finance income there only. So you don't have to use any formula in accounting standard 19. Everything happens just by table. But this I thought it you just for you to know. And the point for discussion is parties to lease agreement. Let's see, the one who receives the asset, you should record the asset and liability. Asset is lease asset, what you got. Liability is money that you owe me. Liability is the money that you owe me, that you would have to pay it. So you record the asset and liability at least of these two things. One, fair value of the asset at the time of inception. Basically like cash price of the asset. If you say, lease beda, enu beda, I will give full money. Give me the asset. What money do you want? If you ask, I'll tell one price. No, that is fair value at the time of inception. Or present value of MLP. What is present value of MLP? Money that you signed in the agreement to pay. But the money that you signed includes interest. From that, if you eliminate interest element by discounting, what arrives is present value of MLP. So you owe me present value of MLP, correct or not? And the asset cash price would be fair value at the time of inception. You will take whichever is less. At that value, you will record your asset. At that value, you will record your liability. Are you getting it? And over a period of time, you go on adding interest and then you will pay the periodic installments. You being a lessee, you don't have ownership of the asset. I am the owner. But still, you get to charge depreciation because of substance over form. And lesser, I have a receivable from you. I will record it at present value of gross investment. That is basically net investment. Lease rental plus guaranteed residual value plus unguaranteed residual value. I will discount it to today's date and I'll record it in my books. And based on that, I'll book my finance income each period. You will book finance expense, I'll book finance income. This is finance lease. Let's now see operating lease. Operating lease is something very cool, yeah, easy. Whenever you pay lease rental, to you it is expense. Whenever I receive lease rental, to me it is income. I am the owner of the asset. You are not the owner of the asset. I will record the asset in my balance sheet. I will charge depreciation. You will not charge depreciation. Who am I? Lesser. Operating leasely, lesser will record the asset, lesser will charge depreciation. Lessee will not charge depreciation. Lessee, whenever he pays the money, to lessee it is expense, to lesser it is income. Now we'll come to the most beautiful part of the standard, which is sale and leaseback, which is actually very easy. You don't have to break your head at all. What is sale and leaseback? Sale and leaseback is where I am not wise at the beginning, but later I become smart. I'll repeat. At the beginning, when I raised enough money, I should have taken that money for working capital management and I should have bought the asset on rent. I should have not purchased the asset, because buying the asset on lease or rent is an ideal thing. You don't have to show the asset in balance sheet. You don't have to charge depreciation. You don't have to put huge investment. Basically, you you pay the money in installments. That is the advantage. But unfortunately, what have I done? I purchased the asset. I did not take it on lease. I purchased the asset. After purchasing, all my cash is out. Now I am feeling the pinch. Oh my God, I don't have money to do my business. What would I do now? I'll find one rich guy, sell the asset that I have to that rich guy, and take the asset back from him on lease. He actually doesn't want the asset. He doesn't even see the asset. We sign two documents. Document number 1 is signed to sell. I sell. He buys. The moment he buys, we flip the page and then write one more agreement. This is for lease. He is giving it back to me on lease. I'm taking it back from on lease. Basically, in this case, I'm taking loan from him, giving the asset as pledge, but I won't call it loan. I'll call it sold, taken back on lease from the same person. Now, when I sell the asset, I'll make profit. or I can make loss. That profit or loss, how it is to be recognized, this depends upon what is the kind of lease I'm getting it back from him. When I sell the asset, I'll make profit or loss. When I take the asset back on lease from him, what kind of lease is it resulting? That will decide the kind of accounting should be done for the profit that happens on the sale. If the sale and lease back only, reverse lease is finance lease. Finance lease means what? Keep this lease back asset. Think of what we discussed in the beginning of this and tell me, what do you mean by finance lease? Purchase or sale. Am I right? So I'm taking the asset lease from him. Basically, I'm purchasing the asset from him. Am I right? I am lessee. Who am I? Lessee. He becomes lessor. First, I am owner. I become seller. I sell the asset. He becomes buyer. He becomes owner. That owner will become lessor. He will give the asset to me on lease. So first I sold. Then I took it on finance lease. Finance lease is like purchase. I sold it. I bought it. I sold it. I bought it. Weird, no? When I sell it and then buy it, no? That profit cannot arise. Profit cannot. Why? I sold it. Let's say I made profit. 1 lakh is the cost of the asset. I sold it to him for 1 lakh 20. I made 20,000 profit. He will give it at least back to me, no? Now, why did he pay 20,000 extra? Why did he pay 20,000 extra? If he paid 20,000 extra, later when he gives finance lease to me, he will recover that 20,000 from me extra. Asset book value is 1 lakh. I'll sell it to him for 1 lakh 20. I'll make 20,000 profit. You know, why did I sell it to him for 1 lakh 20? I want 1 lakh 20 cash. Like, sir, 1 lakh 20 you give. He's like, hey, asset value is 1 lakh. I'm like, give 20,000 extra. I will take the asset back from you on lease, no? If it is somebody else, I would pay 10,000 lease rental. You take 12,000 rupees from me. Take 2,000 extra for every year for 10 years and take the money. So you will give me 1 lakh 20,000, 20,000 extra. And he will recover that from my finance lease payments that I'll make later. So whenever I get that 20,000 profit on sale of the asset, that should not be recognized to P&L immediately. That should be deferred and amortized over the lease that follows. Transaction number 1. I am having an asset of 1 lakh. I sell it to him for 1 lakh 20. He buys it for 1 lakh 20. He gives it to me on lease. Now when he gives it to me on lease, the lease period is 10 years. Cost of the asset 1 lakh, sold for 1 lakh 20, 20,000 profit by owner. That 20,000 profit by owner should not go to owner's P&L account immediately. It should be written over 10 years, every year 2,000, 2,000, 2,000, 2,000, 2,000. That's what this says. See, when the asset is sold and leased back, lessee, owner before sale, continued as user even after sale, might make profit or loss on such sale. Treatment of such profit or loss depends upon the type of resulting lease. If the lease is financing, profit or loss on sale between carrying amount and sale price should be deferred and amortized over the period of lease in the proportion of depreciation. If I sell the asset to him, I am the owner, I sold, I became seller, he bought the asset, he became buyer, he will give the asset back to me on lease, he becomes lessor, I becomes lessee, but the lease is operating lease. Lease is, have I sold it? Have I sold it? Yes. Did I buy it again? No. Operating lease is like rental. So I have actually sold the asset. So there is actually profit. So profit can be transferred to P&L immediately. But what profit? What profit? Fair profit. Now, we both are interested parties. I can play with the selling price with him. Why? I'm interested in the next transaction with him. Cost of the asset is 100 lakhs. Can I ask him to give 120? Yeah. If he gives 20 rupees extra, why will he give 20 extra? Next, operating lease is there. No, in that he'll recover extra money from me. Are you getting it? Next case is, I can say I want 100 rupees, okay, for the cost of the asset. Fair value is 100. He can say, I will pay only 90. I'll be like, no, cost is 100. He's willing to pay 90. I will say, okay, you give me 90. But later when I take operating lease, I will also give less rent. So the next transaction can be adjusted. Are you getting it? So what we do in this case is, I have cost price or book value in my books. He is giving me selling price. I will not compare cost price and selling price profit as actual profit. In between, if I would have sold it to some other party, at what price would have I sold? Fair value. I'll consider that. Cost price and fair value difference, what is there? That is actual profit that will be transferred to P&L. Fair value to selling price difference, what is there? That is not actual profit. That will be deferred and amortized over the lease period because That will be affecting our lease payments. I'll repeat. In the case of operating lease, cost price, fair value, difference you take, that you recognize immediately. That you recognize cost price and fair value, recognize immediately. Fair value, selling price, defer and amortize. Simple. You don't have to see 9 cases. Study material, there are 9 cases. This is more than this is equal to this is less than. Nothing, yeah. Simple. Cost minus fair value. Profit or loss, book immediately. Fair value and selling price difference. Defer and amortize. Read this. Difference between cost and fair value, recognize immediately to P&L. Difference between fair value and sale value to be deferred and amortized. Only one point. Between fair value and selling price, if it becomes loss, if it becomes loss, don't defer. Why? Conservatism. Book it immediately. That's accounting standard 90. Let's now quickly revise accounting standard 26, which deals with intangible assets. This standard is very similar to the standard accounting standard 10, property, plant and equipment. So please quickly revise AS 10 before you come to AS 26 to save a lot of time in AS 26. Accounting standard 26 tells that how to recognize an item as intangible asset, how to record it, how to measure it, and how to impair it, and how to also amortize it over its useful life. Whenever we talk about this standard, the standard talks about expenses incurred on advertising, training, and startup cost, and also expenditure incurred on research and development. These are also regarded as intangible assets. If you paid money for the purpose of licensing agreements, patents, copyright, trademarks, software, all of these are also considered as intangible assets. In fact, these are the examples of accounting standard 26 intangible assets. This standard specifically excludes talking about certain things. Number one, inventory, because inventory is specifically covered under 2. And construction contracts are also excluded under revenue recognition because it's covered by 7. Same applies on goodwill, which is an intangible asset. But if that goodwill is arising in the process of amalgamation, that is not goodwill as per AS 26. That is goodwill as per AS 14. How to recognize that goodwill, how to account that goodwill is also given in accounting standard 14. Same happens with goodwill arising on consolidation. Goodwill arising on consolidation, accounting standard 26 doesn't apply. It is recorded as per AS 21 only in consolidated statement. It would not even appear in standalone financial statements. And leases which are covered under AS 19 and deferred tax assets which are covered under AS 22 are not covered under accounting standard 26. And there are some financial assets against which separate set of standards are there in Ind AS. There are no standards in AS. Again, those are not covered under AS 26. Mining assets, natural resources and all are not covered by any of the accounting standards. Insurance contracts are also regulated by IRDA regulations and Insurance Act regulations. They are also not covered under AS 26. And if there is any expenses on termination of an employee or termination of a contract, that will not generate any intangible asset and that should not be covered by AS 26 again. What is called as an intangible asset in that case? Call an item as intangible asset. No, definition is very similar to PPE. It should be identifiable, meaning we can identify future economic benefits separately from this asset. Not just in group, in individually also it should be able to contribute to our future economic benefit. Like what to say, it will generate cash flows to us in the future. It should be non-monetary. Non-monetary is the same definition that we use in accounting standard 11 as well as in branch accounting. Items which cannot be expressed in fixed or determinable amounts of money. And it should not have physical substance. It should not have any existence. If it has physical substance, it will become PPE. Only point which will distinguish an item from PPE to intangible asset is no physical substance. Certain items which are intangible assets will have physical substance. For example, software embedded in a CD. See, we'll do these kind of questions later, but right now it's a revision video. We'll not skip doing these things in detail. If there is a software in a CD, it is identifiable as a separate asset. It is monetary. It has physical substance, but that is not significant. You pay the money not for the CD but the software in it. So it can be considered as an intangible asset though it has physical substance. You get this? If you buy computer with the software, then computer is a tangible item. You cannot call it intangible asset. You cannot say, no, I bought the software, they gave it in computer. No. There the physical substance has a significant contribution in money. Then it is not considered as an intangible asset. But if you buy only software, then it is considered as an intangible asset. Do you get this? If you buy a license, all of that are intangible assets. Then going slightly further, You understood the definition that an intangible asset is an item which is identifiable separately, which will generate future economic benefit, but it is non-monetary, does not have physical substance. And we should have control over this. And this specific thing should be used for producing goods, rendering services, renting out, or administration. Same thing we read in PPE also. There the definition starts as a tangible item. Here it starts as an intangible item, which is non-monetary and does not have physical substance, but can be used in production of goods, rendering of services, administration purpose, or for the rental purpose. Some important things is, what do you mean by identifiable? It is distinguishable from goodwill. It is not just like goodwill. It should be something other than goodwill. It should be able to sell it. You should be able to generate cash from the same. It should be able to give you monetary benefit in the future. Next one, non-monetary is which cannot be expressed in fixed or determinable amounts of money. No physical substance, no tangibility. No tangibility. In order to recognize this, like how we do in PPE, here also we have two things: initial recognition and subsequent recognition. Initial recognition is at the time of purchase. How do we record? In order to record it initially, it has to fulfill definition of intangible asset, definition criteria. Second point, it should give you future economic benefit. Third point, you should be reliably able to measure its value. If there is fulfilling definition criteria, there is future economic benefit and reliable benefit, then reliable measurement, then we'll record it initially. Subsequently, on the same intangible asset, if we incur any expenditure, should it be put to P&L or should we be adding it back to the cost? For example, you pay renewal fee for the software. Should it be added to the cost or returned to P&L? That depends upon the subsequent recognition. Subsequent recognition conditions are again three: future economic benefit, reliable measurement. In PPE, only these two used to be there: FEB, RM. Here also same, FEB, RM. Along with that, there is one third point called directly attributable. That subsequent recognition expense, whatever is there, if that expense can be directly attributable to the product, then you can call it subsequent recognition cost and add it to the cost. If you cannot directly attribute it to it, it is generally for everything else, then it cannot be added to the cost of that intangible asset. So, initial recognition criteria is definition, future economic benefit, reliable measurement. Subsequent recognition, future economic benefit, and reliable measurement, along with directly attributable condition. I hope you people understood this. Then, measurement. How to measure this? It should be measured at the consideration given. If you give cash consideration, amount of cash that you give is the cash consideration. What if there is non-cash consideration? Like you pay money, sorry, you don't pay money, or you give something else in the place of this. We need to exactly do what we do in age 10. Priority 1, priority 2, fair market value of the asset given, fair market value of the asset received, whichever is more clearly and evidently available. Priority 1 to fair market value of asset given, priority 2 to fair market value of the asset received. And before this, you need to check whether commercial substance exists or not. This part I'm not discussing it in AS26 video. Please revise from AS10 video where I've covered this at large. Got that? If it is internally generated, this part again we do in AS10. If you're generating that intangible asset in-house, cost incurred, not in the research stage, but from the development stage, will be added to the cost of the asset. In this, you can never have internal profits. And once you regard some amount as expense, because it is at the research stage, then you move on to development stage. Then you start capitalizing. You cannot say, whatever I've previously charged to expense in P&L, now I'll reverse it to become capital. Can we do that? No, we cannot do that. That's the point that you should note when it comes to measurement. Did everyone understand? With regard to initial recognition, cash consideration, it will include the purchase price. Tax and duty should be included if input tax credit is not available. If input tax credit available, that will not be included in the cost. Any other directly attributable expenditure incurred till the time that intangible asset is ready to be put to use should be included in the cost. After deducting trade discount, if any, after deducting government grant which we have received from the government as per AS12, if we are following reduction from the cost approach. Alternatively, as per AS10, if we follow deferred income approach, then asset will be recorded at full value without deducting government grant. You can refer AS12 for this part revision. And non-cash consideration, like I mentioned, we've covered it there. With regard to self-generated asset, the research phase, that is when you're gaining the knowledge, technical as well as what is a scientific knowledge when you're gaining about that development, that amount will not be capitalized. It should be charged to P&L, because at the research stage, you're not sure of the product coming out. You're not sure of the outcome. So you cannot capitalize, because you cannot think, you cannot with certainty tell if there will be an outcome. If you cannot tell with certainty about the outcome, then how can you capitalize? How can you say that there will be future economic benefit? To capitalize an item and call it asset, you should have future economic benefit as a point. No, when you don't know if the outcome is positive or not, how can you promise future economic benefit? So it will be returned to P&L. Once the research stage is successful, experiment is become good, you start developing that product, then what do? Then any expenditure incurred is for application of the knowledge and technical knowledge that you got, scientific and technical knowledge. So at development stage, whatever cost incurred will not be transferred to P&L, it will be capitalized. We add it to the cost of the asset. And when do we start capitalizing the expense on intangible asset which is built internal? This is an important paragraph, para 44 of Accounting Standard 26. Remember these conditions. Number one, technologically, what is it? Technically, technologia, there should be feasibility of completing the product. Point number one. Second one, technologically it is feasible, but you are lazy. No, doesn't work. Technologically it is feasible. You have the intention to complete that project. After you complete the project, you should be able to use that product that comes out, or you should be able to sell that product. Basically, future economic benefit. Number one, technically possible. Number two, you have intention to do. Number three, it will give you product to sell, or it will give you product to use. Next, you should be able to sell it, no, for some consideration. Future economic benefit should be there. And we should have adequate resources to complete. I have intention to complete, but I don't have resources. Not good enough. And finally, you should be with reliability. Measure the cost that you should incur to complete the project. If all these 6 conditions are fulfilled, then we will capitalize the development cost on intangible asset which is internally generated. Otherwise, transfer it to P&L. What are the conditions? Technical feasibility, intention to complete, ability to use or sell. For future economic benefit, adequate resources and reliable measurement. If unable to distinguish research and development, then charge to P&L. Only when you can clearly distinguish research with development, you believe that this is development stage, you believe that you will complete it, you believe that you can sell, you believe that you have resources required, you believe that you can reliably measure it, then recognize it as internally generated intangible asset. Otherwise, don't. Then we have the last part, expenses to be not recognized as intangible asset. If you don't incur any expenditure, it is not directly attributable to asset, then don't add it. Goodwill, when this goodwill is there, is purchase of amalgamation are internally generated. No, this is not intangible as per AS 26. This is as per 14 you would have recorded. This has to be amortized over the later years. This is not treated like 26. 26 just still tells one para on this. There are certain items which should not be included. Staff training cost, promotional advertisement, relocation, selling and distribution. Read through this. These are not part of intangible asset. Then we have amortization. Amortization is like depreciation. Systematic allocation of amortizable amount or depreciable amount of the intangible asset over its useful life is amortization. It should start when the intangible asset is ready for use, and it should be written over a useful life. PPE, there is no cap. No cap is not your Gen Z word, no cap. No cap is no top limit. You can depreciate it over any number of years. Which one? PPE. But when we talk about intangible asset, there is a cap. There is a limit. What is it? Maximum 10. Can you can you amortize an intangible asset over 15 years? Answer is by default, no. If you want to amortize it over a period longer than 10, you should be able to prove with evidence that its useful life is greater than 10. If you can't prove, then no, then maximum 10 years. You'd have to prove it with evidence. See, persuasive evidence should be there saying that longer period is justified. That is best estimate. Check for impairment regularly. You should check regularly for impairment. Refer AS 28 for impairment. And we need to do that. Methods allowed is straight line method, WDV method, or production units method. Straight line method, charge to P&L is same every year. WDV method, charge to P&L keeps decreasing every year. Production units, higher the production, higher depreciation. Lower the production, lower depreciation. No production, no depreciation. Here it is amortization. Amortization. and it should follow the pattern of economic benefit of the asset. If the economic benefit of the asset is, then amortization will be, if the economic benefit from the asset is decreasing year by year, amortization amount also should decrease every year. That's the logic. Residual value, at max, the asset should be recorded at zero. You cannot record it at negative amount. If there is any commitment given by third party saying that I will buy your intangible asset, let's say you bought one software for 10 years, you bought the license. After 5 years, or let's say after 6 years, upgraded new software will come in the market. So you want to buy the upgraded one, you will sell it after 6 years. So that is end of useful life according to you. But license is for 10 years. When you give it, you might not get any money. But let's say I have given you promise, I will buy that software after 6 years from you. Why? I'm small businessman. To me, that software is also good enough. You need a bigger software, better software, you took it. So if I promised you some money, then there is residual value. Otherwise, there is no residual value. For tangible assets, will have residual value. Intangible don't even have physical substance. How can you have residual value? Residual value for intangible assets is usually by default zero. It will be taken at some value when someone has given you commitment that they would pay, or when there is an active market for that expired intangible assets, or what to say, outdated intangible assets also exist. Then retirement or disposal. Retirement is kept for sale, not used. Then you should value it at cost or NRV, whichever is less. And dispose means selling it. Whenever you sell it or when you retire it, if you reduce the value, book that P&L account. Certain mandatory disclosure requirements as per AS 26 is should record the useful life, pattern of amortization, which method are you following for amortization, what is the carrying amount, and impairment if any happening on this intangible asset. All of this has to be disclosed in your books of accounts, and that's accounting standard 26 intangible assets. Let's now quickly revise accounting standard 28, which is chapter 5 unit 7 of your syllabus. This is impairment of assets. Impairment is decrease in the value of the asset other than by way of depreciation, other than by way of downward revaluation. Depreciation is systematic allocation. Systematically, we allocate over the useful life. Downward revaluation is when we feel the asset's value is much lower than what it is. We have charted lesser depreciation in the previous years, so we do downward revaluation. What is impairment? Impairment is an indication that the asset's economic benefit has dropped because of some factor. That factor can be external factor, factor can be internal factor. Like the asset that is used, using that we are manufacturing some products, a significant fall has happened in the units manufactured using that asset, or there is significant decrease in the market price for that product only, or there is one new technology that has come because of which this is outdated, efficiency has dropped, or something happened because of which it went down. Interest rates have been moved by the government in such a way that it will no longer be beneficial to do this business, or people's choices have changed, material has become obsolete, you are planning to discontinue, you are going for a reconstruction, or the asset has started performing poorly though it has longer useful. All of these are the indicators. We will not be knowing to do impairment. If any of this indicator triggers, that's when we do impair. How do we do impairment? Very simple. We will think of the asset. Asset can be seen in two ways. One, use the asset till the day it dies. Second one, sell the asset today. When I see this asset, I feel like, should I use this till the time it stops working, or should I sell it right now? Let's say this is my asset which I'm trying to identify impairment for. I will see if I use this asset till the day it dies, how much benefit will I get? I will check. If I give, let's say I'm giving this phone on rent. I give this phone on rent for every month, I'll collect 500 rupees as rent. So how many years can I give this phone on rent? I will do one estimate. I can give it for 2 more years on rent. 500 rupees per month. For 12 months, it comes to 6,000. Another 12 months, it comes to 6,000. Can I say my annual receipt for this 6,000 for first year, 6,000 for second year, 12,000. But we will not receive 6,000 today. I'll receive 6,000 after year one. I'll receive another 6,000 after year. Assuming that I'll collect the rental annually, I'll discount first 6,000 for 1 year. I'll discount second 6,000 for 2 years for an assumed internal rate of return. I will get the present value of cash flows this will generate to me in the future. That is value in use. What is that? Value in use. If I use this, how much value will I get from that? Value in its usage. Second option, I will not use it. I will sell it today only. Net selling price. Net 10K. From the selling price, I will deduct the expense I'm incurring for sale. Someone will tell that they will buy this phone. I'll tell I'll buy this phone, but change the battery and game. I'll buy this phone, but remove this case, put one new case and give. I'll buy this phone, change the charger point and give. So to sell it, I might have to incur some expense. Or someone will tell that they will sell it on my behalf, but they want 10% commission. So from selling price, if I deduct selling expenses, I'll get net selling price. I told you I have two options with the phone. Number one, use it till it dies. I'll take the cash flows that it will generate in the future, discount it to today's date. I will identify the second one, net selling price, the value that I'll get if I sell this asset. I will compare both. I'll compare both value in use and net selling price. Whichever gives me higher cash flow, that is what I'll pick. No, let's say the present value of the future cash flows comes to 9,000. But if I sell it today, I'll get 10,000. What should I do? Sell today. So I'll pick the bigger option. I am not selling. I'm telling that we should pick the bigger option. 10,000 is called as recoverable amount. Higher of net selling price and value in use will be considered as recoverable amount that will be recovered from the asset when we take the best possible option. This will be compared with carrying amount. Let's say recoverable amount is 10,000. Asset is in there in my balance sheet at 15,000. So I've recorded the asset at 15. Best possible option, if I take also, I'll be able to generate only 10,000. So this 5,000 is decrease in the value of the asset. This is not loss on sale. Why? I have not sold. This is not downward revaluation. Why? This is not arising because of wrong depreciation in the past. This is not depreciation because this is not systematic allocation. Then what is this? Impairment loss. What is this? This will be charged to P&L account. Now comes the most interesting part. This impairment loss is not calculated for each individual asset. We will do it for one smallest identifiable group of assets. I'll give you a better example. In this classroom now, the benches are saying that they pay 10,000 rupees to sit on me for 1 month. So my value in use is 10,000 rupees per month. Is that right? No. The same bench, if I put it on the street, people won't pay 10,000 to sit on the bench. Projector will say people pay 60,000 rupees to listen to me for 6 months. Every year I'll generate 60,000 rupees per student into 300 students. That is my value in use. Is that the thing? No. Projector is having the value because I am teaching. Same projector, if you put on the street or anywhere else, project something else, it won't generate so much of cash. Are you getting it? So it is not individual asset that is generating cash flow. Individually, for projector or bench, I am not able to identify cash flow. Projector, the screen, chairs, benches, fans, AC, speaker, mic, camera, table, this laptop, everything together is one CGU, cash generating unit. It is smallest identifiable group of assets against which we can identify cash. There is a chair in theater. Can that chair say people pay 500 rupees to sit on me for 3 hours? My value in use, cash flow that I'll generate, 500 rupees into 4 shows per day, into 365 days in a year. Chair was bought for 20,000. Can it say 20 lakh is its value in use? No. Alone chair no one is paying to see. They're paying to sit on the chair because the theater, it is there inside the theater. So the chair, projector, screen, ambience, everything together, it is one CG. So we will do impairment not for individual assets but for an entire CG. Cash generating unit. And same is the concept of corporate assets. Whenever we purchase a CGU, we might sometimes end up paying more money than the value of the CGU. I purchased an entire cash generating unit. I ended up paying more than the value of that CGU. I bought 5 assets together. Asset 1, 2, 3, 4, 5. All the 5 assets together, individually the assets will come to 100 rupees. Like asset 1 plus asset 2 plus asset 3, asset 4, asset 5. If I buy, the value comes to 100 lakhs. Okay. Asset 1 is 20, asset 2 is 20, asset 3 is 24, is 25, is 20. The businessman is not selling individual assets, selling all the 5 assets together. They ended up paying him 130 lakhs. I paid 30 lakhs extra. That is goodwill. That is, I see 5 assets which I bought 2020, 2020 each. Value 100, but I paid 130. 30 lakhs what I paid extra is the 6th asset. What I don't see. intangible asset, goodwill. Now, when we are checking impairment, first we should take this goodwill is there, no? 30 lakhs. This should be allocated to all the assets on a reasonable and consistent basis. 30 lakhs will be divided by 5. 6 lakh, 6 lakh, 6 lakh, 6 lakh, 6 lakh, I'll add. Each of the assets carrying amount became 26. Then, whichever asset is giving an indicator, only that asset I will check impairment. Understood? This is called as bottom-up test, where goodwill or corporate asset can be reasonably and consistently allocated. In our example of purchase of 5 assets together, when I incurred 30 lakhs extra creating goodwill, if I can allocate this 30 lakh goodwill to 5 individual assets, then reasonably and consistently, I can tell the reason why I'm allocating this much value to each of it. Consistent. The method that I follow to share goodwill to each of them this year, next year, next to next year will be same. So I will share goodwill 30 lakhs to individual assets. Check which assets is creating indicator. Asset 1 is creating indicator. Asset 1's carrying amount is 20 lakh plus 6 lakh goodwill, 26 lakh. Then I'll check the recoverable amount. If recoverable amount is less, then I will create impairment on this. If recoverable amount is more, no impairment. This test what I did is bottom up test. This test what we did is bottom up test. How to remember? Very easy. It can be allocated on reasonable and consistent basis. RCB. RCB yavattu table bottom in the topic hogutte. Bottom up test. You get what I'm trying to tell? What if there is no reasonable consistent basis? Meaning this goodwill of 30, it cannot be allocated to any of these assets. Then what do? Then this asset is there, no, which is having indicator 20 lakhs without adding goodwill. 20 lakhs itself is its carrying value. Compare it with the recoverable amount. Identify impairment loss. After you identified impairment loss and reduce the value of this asset number 1, then take asset 1, asset 2, asset 3, asset 4, asset 5. All the assets carrying amount together. So that you add goodwill also of 30. That is one bigger CGU now. That entire CGU's recoverable amount you identify. Compare to identify impairment loss. That impairment loss has to be booked again. What is this? Individual one asset you did know. That is bottom up test. You are not satisfied with that. Why? In that individual asset, we did not add goodwill. There is a chances that goodwill also can be impaired. In AS 26, when we discussed, we should check impairment for goodwill every year. So this impairment on goodwill has to be identified. So goodwill cannot be allocated to any of this. And goodwill alone, we can't do impairment. Why? Goodwill will not have cash inflows individually. No, there is no value in use. There is no net selling price to this. So what do? Goodwill belongs to all the 5 assets together. For asset number 1, do bottom up test. Then revised carrying amount after impairment loss of asset 1. Then asset 2, 3, 4, 5 together you take. Add goodwill to it. Total CGU is there, no? Larger CGU. That entire CGU's value in use and NSP you find. Compare it with recoverable amount and find impairment loss. Second time. That, my friends, is top-down test. Topic go through, no? Playoffs admele will come back to the bottom. RCB, it cannot be allocated on reasonable and consistent basis. So RCB, yes, bottom up test. Share goodwill, then impairment. If goodwill cannot be allocated without sharing goodwill, individual asset, impairment. Then add goodwill to all the assets together, then check impairment. Now the next point is, what do we do with this impairment loss? Impairment loss should be reduced from the cost of the asset and should be charged to P&L. Impairment loss should be reduced from the cost of the asset and charged to P&L. If in case there is impairment loss, once again, if in case there is impairment loss and there is revaluation reserve. See, impairment loss is 10. We have balance in revaluation reserve. Don't charge impairment loss to P&L. Adjust it against revaluation reserve. If impairment loss is greater than revaluation reserve, only then it will go to P&L. See here, impairment loss is 10. Revaluation reserve is 12. Don't transfer impairment loss of 10 to P&L. Adjust entire 10 impairment loss against revaluation reserve. And 0 will be transferred to P&L. 12 is the balance in revaluation reserve. After adjusting 10 of impairment loss, 2 will be still remaining in revaluation reserve. If impairment loss is 10, revaluation reserve is 8, then revaluation reserve will become 0. Because impairment loss is 10, we adjust against revaluation reserve 8. Excess of 2 only will be charged at P&L. You got it? So impairment loss should be transferred to P&L and also deducted from asset. Before you transfer to P&L, someone stops you. Who? Revaluation reserve. Only after you close revaluation reserve, you should transfer to P&L. For example, when you're shooting revaluation reserve in front of you, you are shooting it to P&L. Revaluation reserve will come and say, kill me before you kill P&L. So before you shoot P&L, you should kill revaluation reserve. After you kill revaluation reserve only, you shoot P&L. This is the one side. The other side is you should reduce from the cost of the asset. Before you reduce from the cost of the asset, you should reduce goodwill. You should reduce goodwill. Before you shoot your impairment loss towards asset, no, goodwill will come. If you have to kill the asset, kill me first. So first you will shoot goodwill, discount, goodwill will die. Then you will shoot the asset. That is a treatment. This is basic recognition of impairment loss. Next point that we have is reversal. At any point of time, if any of the pointers that you just identified gets reversed, indicators gets reversed, cash flows will increase, discounting rates will change, and indicators get reversed, then you reverse the impairment loss. You get what I'm trying to tell? That's the only point that you should know with regard to impairment reversal. And I hope this short revision video on accounting standard 28 was of some use to all of you people. Let's now discuss accounting standard 15, employee benefits. What do we mean by employee benefits? There's an employee who's working for you, who's given his sweat and blood, and you've taken his services. For the same, against the same thing, the organization has to compensate by paying money. This money, what the company pays for the service taken from the employee, is employee benefits. It has to be booked as an expense in the books of accounts. How much to write and when to write is the objective of the standard. Employee benefits will include all forms of considerations given by the enterprise in exchange of services rendered by employees. Who are employees? The definition of the word employees is not given by the standards. Laborers, wagers, employees, interns, directors also are considered as employees. To regard a person as an employee to the organization, three primary factors have to be seen. Factor number one, what is the nature of agreement? If the nature of agreement states that activities which are personal are to be rendered by the employee to enterprise, is an employee. Next one, if the organization compensates that employee by paying money, then we own the work that is done by that person. We are buying the service. Then that person is an employee. And the intent of the parties is to be like an employer-employee. Actually, even if they're not employer-employee, if they're intern and principal, even then, if the intention is to have that employer-employee relationship, it will be considered as employee benefits, or employee will be considered as an employee. If you work as an intern, free of cost, you don't ask for any compensation. Your college is asking you to do internship somewhere. You do intern there. You're not expecting any stipend. You're not employee. However, you make work for them. They own your work. Whatever work you do, you need to give it to them. And they're also giving you some 10,000 rupees stipend. You are considered as employee for AS 15. Will employee laws be applicable to you? No, I'm not talking about all that. I'm not talking about employee law. I'm not talking about you writing this expense in salaries, employee benefit expenses in P&L. If you make any payment to directors, no, it will come in other expenses. But still, director is considered as an employee to the company. Why? His services to the company are personal. There is an intention of having employer-employee relationship. He will be compensated for his services by the company. So, director is also an employee. If the director is an independent director or is a non-executive director, then is not considered as an employee. Otherwise, he also should be considered as employee. This is the understanding that we need to have. What are the types of employee benefits? The benefits that is given by the company for the services taken by it can be classified into four classifications. Number one, short-term employee benefit. Number two, post-employee benefit. Number three, other long-term employee benefit. And number four will be termination benefit. What are these four? Let's see the meaning individually. To begin with, short-term employee benefit. What do you mean by short-term employee benefit? Any benefit given by the company to the employee within 12 months from the end of the year of service. If you give service to the company today, let's say we are right now in the month of February 2024. As an employee, you give service to me in February 2024. If I give the money to you in March, it is short term. If I give the money to you anytime within 12 months from the end of the year, if you give me service in February, year is ending 31st of March 2024, from 31st of March 2024, 12 months. That is till 31st of March 2025. Within this period, if I'm obligated to pay, it is short term. If I'm supposed to pay you money after 31st of March 2025, it is no longer short term. That will become other long-term benefit. It can be post-employment or termination. I'll explain it to you later. See this short-term employee benefits refers to benefits which fall due within 12 months after the end of the period in which employees render the related service. And this does not include termination benefits. If you remove the employee today, within 1 month you pay him termination salary. Termination means removing from the employment, breach of the employment contract. Either when the employee by himself leaves or the employer kicks him out, both are considered as termination. If you remove them, immediately you pay the settlement. Is it short term? No. That is termination benefits. So other than termination benefits which are due to be paid within 12 months from the end of the year in which service is taken will become short term employee benefits. Let's see the numbers of it, or let's see little more detailed part of it. See this salary paid within 5th of the following month. It is short-term employee benefit. Bonus payable at the end of the quarter. Short-term employee benefit. Pension payable at the end of employment. We don't know what it is. Right now it is not short-term. Gratuity payable at the end of employment. Not short-term. Compensation on voluntary retirement. Not short-term. Silver jubilee and sabbatical leave benefit. Not short-term. You understood this? Come to the next word. The next word that we have here is post-employment benefits. What is post-employment benefits? Usually there is one kind of confusion that people will have with regard to post-employment benefits and termination benefits. Are they both same? No. Now you joined the company at the age of 25. Your retirement is at the age of 60. You work till 60. 60, you shake the hand with the employer. Employer will shake the hand with you. Both of you are very happy. They make you sit on a chair, put one shawl, give you one fruit basket, say lifetime achievement award. Thank you. You are an inspiration. Click one picture. Your family, everyone will come. Everyone will clap. Your son or daughter will give one speech, and then everyone will put happy retirement. Then you go home. Then you get money from the company after you retire, like free medical checkup, free world tour expenses, some amount of gratuity, pension every month to buy chocolate for your grandchildren. All of this is post-employment benefits. What is termination benefits? Company is not happy with your work. They will say, you are fired, get lost, don't come from tomorrow. Then they give you some benefit. That is termination. So post-employment is all happies. Termination is either you are fired or you will take the cup of coffee and then throw it on your manager face. Tago, neene itko, beda, in kelsa. And then you leave and come. That is termination benefits. Termination of the employment agreement, either initiated by the employer or by employer. Sir, what is other long-term benefits? It is not short-term. Why? It is paid beyond 12 months from the year in which service is taken. Beyond 12 months from the end of the year in which service is taken. But it is not post-employment. It is not termination. Let's see the same example what we were discussing here before. See, I told you salary and bonus payable within 12 months from the end of the year in which service is taken is short term. Pension payable at the end of employment is post-employment. Why? Employment is over. No. Post-employment. Gratuity payable at the end of the employment is again post-employment. What if the compensation is to be paid for voluntary retirement? Voluntarily you left the company and they pay. That is not post-employment, my friend. That is termination. And silver jubilee. Silver jubilee means 25 years of service. You still have service pending, but 25 years of service, they honor you and give you something. It is long-term benefit. Why? You given service not 25th year, 25 continuous years you have given service, including the service that you gave in the first year. At the end of first year, within 1 year, are we giving money? No, at the end of 24 more years, we're giving. So that becomes long-term benefit. Sabbatical leave means company allows the employee to take long leave and then go out. Don't come to company for 2 months. Why? Company wants to survive without being dependent upon the employee. Even without you, we will work. They want to prove. Or if you're doing some kitapati in the company, in order to find it, they should send you on leave. Only then they'll get to know. What if you're doing some teaming and ladding? So they give sabbatical leave. Sir, if they give leave, how is it benefit? If they give leave, how is it benefit? During that leave, you will get salary. During that leave, you will get. So you're not giving service. but you're still being paid salary. That benefit what you're getting, it is a post-employment. It is a long-term benefit. It is a long-term. There is one more beautiful concept which is on leaves. What if the leave is accumulating, leave is non-accumulating, leave is vesting, leave is non-vesting? What to write as the entry when it is each of the cases? How much expense to book? How much income? How much liability to be recorded? Is a detailed discussion. We do this for good 1 hour in our regular class, but because it is a revision video, I'm skipping this part. On this, there are no questions in ICA study material. Plus, but please do revise the concept because sometimes the question can come on this topic. Slightly less important, but can come. If I have to tell you in short, no, accumulating leave means the leave company will assign you certain number of leaves in this year. Let's say company will give you 30 leaves in 1 year. You can take 30 days of leave. So 30 days leave if you take, let's assume it is 1 month. You work for 11 months in the year. 1 month you took leave. This is other than Saturday, Sunday. Still you will get paid salary for 12 months. Why? Company will tell you can take leave up to 30 days. That is 1 month. So in a 12-month year, when you work for 11 months and took 30 days leave, still they give you 12 months salary. What if you take 45 days leave in that year? 45 days is the leave taken. 30 days leave alone. 15 days you took extra leave. For that 15 days, they cut the salary. If they cut the salary because you did not work, they did not pay. If they don't cut the salary, what's happening? You're not working, still they're giving salary. You're not working, still they're giving. So the salary that you get per annum, no, that is not for 12 months, that is for 11 months. Because you're expected to work only for 11 months. Are you understanding? If they say non-accumulating, you know what does it mean? You have leave of 30 days in this year. You take 30 days leave, good. If you don't take 30 days leave, next year, can you take more than 30 days leave? Avella illa. That year leave, that year only. That is non-accumulating. What do you mean by accumulating? You had to take 30 days leave this year. Let's say you work all 12 months. You did not take 30 days leave. Then I will say next year's 30 days leave plus this year's carried forward 30 days leave, you can take together 60 days, 2 months leave in next year. That is what leave? Accumulating leave. Next, further we have vesting and non-vesting in this. What is vesting? What is non-vesting? You carry forward this 30 days leave to next year? No. In the next year, for these 30 days, I will give you cash. I won't give you Rajat. Next year, I'll give you only 30 days leave. For 30 days, I'll give 1 month salary extra. Why? Very simple, yeah. You are supposed to work for 12 months. In that 1 month leave, technically you should work for how many months? 11 months. But you work for how many months? You work 1 month extra, no. Instead of giving 1 month leave in next year, I'll give 1 month salary. That is vesting. That is non-vesting means leave cash kododilla. You take leave. You take leave in the next period. That is this part. Here, why does the accounting come? You should remember in this year, if the employee works for 12 months instead of 11, in the next year, he works for 10 months, meaning taking 2 months leave. 1 month leave of next year, 1 month leave of this year, both is taken then. So we cannot write 12,000 salary, 12 months expense this year, 12 months expense next year. We can't write. Why? We pay 12, let's say salary is 1 lakh per month. We pay 12 lakh salary this year because he worked for 12 months. Next year he worked for 10 months, but still will pay 12 lakh. Why? 2 months leave, 1 month leave that year, 1 month leave from previous year. This is the payment. But in P&L expense is not like this. Why? Next year, employee worked for 10 months. Am I right? But you paid full 12 months. So service taken is in first year. Payment made is in second year. So what should we do? Payment first year 12 lakh. Payment second year 12 lakh. But that 1 month leave carried forward from first year to second year is there? No. That 1 month expense has to be booked in year 1. But the payment will be made in year. Expense has to be booked in year 1. Payment will be made in year. First month expense, first year expense will be 13 lakh, not 1 lakh. 1 lakh carried forward. Next year we pay 12 lakh. But second year expense is 11 lakh, not 10 lakh, not 1 lakh. This is the concept. It is little more in detail, but overview is just this much. You will be able to handle a basic question with this knowledge. Now let me get back to the next concept. You understood short-term employee benefits. Short-term employee benefits will include salary, wages, this leave, if it is to be within 1 year, and bonus, all of this. You will write the entry when it is due, not when it is paid. You will write the due entry now, payment entry, if paid in same year, same year. If paid in next year, next year. Then comes the concept of post-employment benefits. Post-employment benefits should be given by the enterprise, that is employer, to employee once the employment is over. In India, we believe that people are not smart enough to handle their post-employment life. People will come to streets because they will spend all the money that they earn on unwanted expenses that they don't know how to live their life when they don't make money. That is the mindset of the people, is what the government believes. So what the enterprises and governments do is, even if you give me 1 lakh rupees worth of employment benefits today, employment services today, I will not give you full salary. Full ಕೊಟ್ರೆ ಕುಡಿದ್ಬಿಟ್ಟು ಟೈಟ್ ಆಗ್ಬಿಟ್ಟು ದುಡ್ಡು ಉಡಾಯಿಸ್ಬಿಡ್ತೀರಾ ಅಂತ ಭಯ. So I will give you 80,000 rupees. Your 20,000 I will keep with me, or I will give it to somebody. I will go on accumulating it. The day you retire, I will give you the lump sum. Or the day you retire, when you are not coming to employment, the money that I've taken from your salary, I'll give little. This is post-employment benefit. Benefit is given by the employer or enterprise to employee post-employment. Here, two kinds of treatments are there. One, defined contribution plan. Two, defined benefit plan. What is defined contribution? What is defined benefit? Defined contribution means I am an employer or enterprise with 10 employees. And these 10 employees have joined my company at the age of 25. I need to give them 50 lakh rupees when they become 60 years old and then quit. Now, if they are 25, they'll work with me for 35 more years. 35 years later, if I have to give them 1 crore rupees each, how much to invest? I don't know. I will go to Provident Fund Organization, EPFO. What is the name of the organization? EPFO, Employee Provident Fund Organization. See the left side box. EPFO. This is company. This is employees. Employees have given me services. I go to EPFO and ask, EPFO, my employee is now 25 years old. Even he becomes 60 years old, I want to give him 1 crore rupees. How do I give? Then EPFO will tell, every month you pay me 10,000 rupees for the next 35 years. I will give him 1 crore rupees. So, who has the responsibility of paying 1 crore to employee? EPFO. What is my responsibility? Paying 10,000 every month. Where will I pay it from? Not from my pocket. I'll cut from his salary only. He gives me salary, sorry, he gives me services. I'm supposed to give him 1 lakh salary. I will cut 10,000. 10,000 I will pay to EPFO. 90,000 I will give it to him. 90,000 what I will give him? No. This is short-term employee benefit. 10,000 what I paid to EPFO. This is post-employment benefit. I keep paying them 10,000. It is EPFO's responsibility to safely invest that money. Earn 1 crore. Whenever this employee leaves my company, he will go to EPFO and EPFO will pay him 1 crore. EPFO is Employee Provident Fund Organization. This is just one example. Similar to this, you have ICICI, you have UTI, you have LIC, ICICI Bank and now. There is one more, Industrial Credit and Investment Corporation of India, ICICI, not ICC Bank. ICC Bank is different, ICICI is different. UTI is Unit Trust of India, LIC Life Insurance Corporation. They also give EPFO services. So you go to them and then give money and they give. As a company, you are throughout seeing not from the perspective of employee, but you see from the perspective of the company. From the perspective of my company, no, my liability is over the moment I give money. My liability is over the moment I give money. Khata. And making it 1 crore and paying is their responsibility. That is defined contribution. Contribution is my liability, 10,000. How will that become 1 crore? I don't care. There's another option called defined benefit plan. There's another option called defined benefit plan. What is defined benefit plan? I have a company. In my company, there are no 10 employees. There are 10,000 employees. Or let's say there are 1,000 employees. When I have, okay, 10,000, I have 10,000 employees. For each employee, if I have to pay 10,000, 10,000 into 10,000, that is the amount of money that I'll go keep with EPFO every month. If you go for a defined contribution, so much of money they would have to invest. No. Let us say I am a company which is dealing in technology, IT. What if the EPFO invests all the money that I give in my competitor? Then I am giving money against the services given by my employee to EPFO who is investing in my competitor, which is making my fall. No. So I will say I will not give money to EPFO on that. What do you want? 1 crore rupees when you retire? No. I will appoint one fund manager. Who's appointing the fund manager? Company. Company will take services from employees, cut 10,000 rupees from their salary, give it to this fund manager. This fund manager will invest the money in stock market, in bonds, in fixed deposits, in gold, in foreign currency, everything. We will handle the portfolio management. He will handle it, and he generates enough return. And whenever employee leaves, we will ask him to sell the investments. He will sell the investments. He'll give me money. That money I'll give it to my employees. Here, the company's liability is not to the extent of 10,000 every month, but company's liability is to the extent of 1 crore rupees to be paid at the end of the employment. This is defined benefit plan. In the case of defined contribution plan, how much ever money we pay, so much we'll book as expense and our liability closes. In the defined benefit plan, what the company should do is this 1 crore to be paid by the company to the employee after 35 years. 1 crore is the payable after 35. Discount 1 crore for 35 years at the expected rate. Whatever we get, that will become my present value of TBO. Defined benefit obligation 1 crore to be paid after 35 years. Internal rate that I'm expecting 10%. 1 crore rupees will be discounted for 35 years at 10%. I will arrive at some value. That is my present value of TBO. I will write this in my balance sheet liability side. How much ever I record my present value of TBO, same amount, I will take it from my cash and I'll invest in one asset. That's a planned asset which will grow to become 1 crore later. That asset is called planned assets. That asset is called, we will try to match present value of TBO with planned assets. They both grow increasing. Next year, present value of TBO increases, will increase plan assets also. One fine day, plan assets will be equal to TBO. We sell assets, receive money, clear our defined benefit obligation. You guys understand this? So what is it that we do? We will identify the amount that should be paid to our employees later. See, in this case, we need to pay to our employee 1 lakh rupees for the first year of service. And this has to be paid after 4 years. I'll record that 1 lakh at a discounted value for 3 years to arrive at today's present value of how much? Sorry, first year service cost is 1 lakh. You get what I'm trying to tell? After 3 years, I would have to pay him. Present value of TBO is like 1 lakh. I'll go on adding interest to it every year and then pay with 1,33,100 after 3 years. The defined benefit obligation is 1,33,100. For first year of service, I'm paying it after 3 years. So what is defined benefit obligation here? 1,33,100. What is the present value of DBO here? 1 lakh. And 1 lakh will become 1,33,100. I will book service cost or interest cost of 10,000, 11,000 and 12,100 in year 2 PL, year 3 PL, year 4 PL. If I have to give money to my employee at the end of year 1, I should give him 1 lakh. But I've told him I'll pay after 4 years. So 1 lakh, I'll add interest of second year, third year, fourth year and then pay. In this example, what is defined benefit obligation? 1,33,100. What is present service cost? 1 lakh. This much is interest. You understood? Second year, if he works, I'll promise him further more money. See, first year of service, here service cost is 1 lakh. With interest in year 2, year 3, year 4, it becomes this. Similarly, for second year, we'll promise him something more. I'll show it to you slightly different. See, we will tell if he works in first year, is eligible for 136,600. If he works in second year, is eligible for 1,50,200. We will go on adding interest. For the first year service cost, I'll add interest in year 2, 3, 4, 5, making it 2 lakh. The defined benefit obligation is 2 lakh rupees for each year of service. First year, if he works, is eligible for 2 lakh. But 2 lakh is not my service cost. My service cost is 136,600. Payment is 2 lakh with interest of 13,660 in year 1, 15,026 in year 2, 16,529 in year 3, 18,181 year 5, because the payment is to be made after 5 years. I will tell my employee, if you work with me for 5 years, I will give you 2 lakh rupees for each completed year of service. When? After 5 years. What if you leave the company after first year? I will give you 2 lakh. When? After 5 years. You left the company after year 1, but I'll still give you 2 lakhs after year 5. So my expense is not 2 lakh for year 1. 2 lakh is payment. Expense is present value of the 2 lakh, which is 136,600. Employee has given me sweat of what value? 1,36,600. If I pay him at the end of year 1, how much should I pay? 136,600. But when will I pay? After year 5. Because of the delay, that interest. So expense for year 1 is 136,600. Expense for year 2 is 1,50,000 service cost, 13,660 interest cost. Expense for year 3, 165,200 service cost, 15,026 plus 15,020 is service cost. This is how the employment benefit expenses will be booked for a defined obligation. Have you guys understood? Defined contribution. In P&L account, we'd have to book employee benefit expenses. In that, I should show how much is current service cost, service given by the employee to me in the current year. How much is interest cost? What is interest cost? Some current service cost will not be paid now. It will be paid post-employment. So on that outstanding amount, I will charge interest to convert present value of DBO to DBO. Present value of defined benefit obligation to defined benefit obligation journey mein, what will come? Interest. That should be written in employee benefit expenses, not in finance expenses. And actuarial gain or loss. What is actuarial gain or loss? We have plan assets. That plan assets value might not be the same. Our actuarial might tell that plan assets value is slightly more than what it is or slightly less. That differential, increase in the asset, gain, decrease in the asset, liability or loss. Same with defined benefit obligation. The DBO what we find is also based on estimate. No, we re-estimate it every year. If the liability increases, loss. If the liability decreases, gain. That should also be booked in employee benefit expenses. This is only a quick revision. Understood? Then last point is actual return. Whenever we have invested money in plan assets, we need to identify the return on those assets. I've taken services from my employees. I need to give them retirement benefits post-employment. So I deduct a portion of their salary. I invest in these assets and I sell to receive it. The rate at which I invest, the rate what I get back is difference. That difference is actual return. Actual return will be different from expected return. Simple investment account is what you should do. Debit side you should write opening balance. Then further contribution made will be debited. During the year if you sell any, you should write the credit side and then you will write the closing balance. Whatever difference arises is surplus or profit or actuarial gain. I hope you people understood that. Some questions, what they would tell is they have already given you expected return. They will tell this much percentage is already booked as return. That much money they've already booked. Identify the total return. If they have not recognized total return, difference will be the return to be recognized. That's one point to be noted. And that's it. Let's get back. And here I would show how it is to be shown in your statement of profit or loss with regard to actual return and expected return. But this is not the point. Sorry. I think lastly we have termination benefit. Termination benefit is the employee benefits to be paid when the employee is removed from the employment. When he is removed from the employment. Then one last part what I wanted to tell is multi-employer plans. What is multi-employer plans? When one employer has only 10 employees, what would he do? He would go to EPFO. But when one employer has 10,000 employees, he would make defined obligation plan, DBO, defined benefit obligation. He will maintain the fund himself. What if the employer is big, not big enough? Like I have 1,000 employees. I am too small to maintain fund myself. I am too big to go for EPFO. I don't want to go to EPFO because too much money. And I don't want to maintain fund because fund manager will ask 30 lakh rupees salary. I can't give him 30 lakh salary. What do? I'll find 4 or 5 people like me who are not big enough but big. All of us come together and together we create one employee provident fund. My company, your company, some 3 or 4 companies. Now in Tata Group, Tata Sons, Tata TCS, Tata Motors, Tesco, Telco, all of them together have one gratuity fund company. That will become multi-employer plan. This was quick revision of accounting standard 15. I hope it helps. Please do some problem practice to get better understanding on the standard. Yes. Let's now quickly revise accounting standard 29, which deals with provision, contingent liabilities, and contingent assets. To begin with, let's focus on the word provision. What do you mean by provision? Provision is a present obligation that will arise because of a past event. And this has to fulfill 2 primary conditions. 1, probable outflow. 2, reliable estimate. The sense of this definition will become much better when you start understanding contingent liability first and then come back to provision. Let me now explain what is contingent liability. Contingent liability, on the other hand, unlike provision, it is not present obligation. It is a possible obligation that arises because of a past events whose existence is confirmed on occurrence or non-occurrence of one or more future events. Meaning, if I am liable to pay money now, it is called present obligation. Possible obligation means I have to pay money, but I'm not very sure if I have to pay money. So I might or might not have to pay money. That is what we mean when we say possible. When I use the word possible obligation, I mean to say I might have to pay, I might not have to pay. I am not sure. When will I get sure? I will be sure on happening or non-happening, on occurrence or non-occurrence of one or more future events. There is something which I'm waiting to happen in the future. In the future, when that happens, I will get concrete evidence as to whether I'm supposed to pay or not. Simple, most beautiful and common example is there is a litigation case pending against me. If the judgment comes from the court and it asks me to pay, I have to pay money. If the judgment from the court says that I don't have to pay, then I don't have to pay money. So as of today, when the judgment is still due, am I obligated to pay? No. But I might have been obligated to pay. There is a very good possibility that I might be obligated to pay. So we call it possible obligation. So there is a possibility that I might have to pay, but am I 100% sure that I might have to pay? I'm not 100% sure, nor can I write it off. So there is a possibility that I might have to pay money because in the past I've given some not good service to customer or not a good product to my customer is being sold. So I might have to pay compensation. When will that be confirmed? On occurrence or non-occurrence of one or more future event, that is court judgment. So contingent liability is a possible obligation that arises from a past event whose existence is confirmed by one or more future events. Now, my legal panel will tell me, sir, we will lose the case, keep the money ready to be paid as compensation. So when my legal panel tells me that this contingent liability might actually become a liability, it has not become a liability. They're telling me that it might become a liability. At this point, I'll keep 1 lakh rupees ready to pay the compensation. That 1 lakh, when I keep it ready to pay, that becomes my provision. Provision is a contingent liability. It is a possible obligation turning into present obligation. To become present obligation, it has to fulfill two conditions. Number one, probable outflow. My legal bench is telling, no, sir, probably we will lose the case. You might have to give the money. So probable outflow, I keep the money aside readily. Reliable estimate. I can reliably estimate the money that I'm supposed to pay. Reliably estimate the money that I am supposed to pay. Meaning money measurement. I can measure it with some, proof. They're saying that this is the money that I might have to pay. Meaning my legal bench will tell, sir, you might have to pay 1 lakh rupees as compensation. So when a contingent liability fulfills the condition of probable outflow and reliable estimate, we will create provision. We will create provision. Now, contingent asset is same as contingent liability. Instead of writing possible obligation, we have to write possible asset. Contingent asset is a possible asset that will arise from past event whose existence is confirmed by occurrence or non-occurrence of one or more future uncertain uncontrollable events. Again, court judgment. I have filed a case on somebody. If that goes in my favor, I'll get compensation. Is it my asset? It is my asset when I receive. As of now, it is a possible asset. When will it become my asset? When the court judgment comes. That court judgment is future, uncertain, and it is not in my control. I hope you understood contingent asset, contingent liability, and provision. Going further, any obligation. Now, this is what the standards basically talking about. When we talk about an obligation, on the balance sheet date, we can check what is the status of this obligation. This obligation can be present obligation. This obligation can be possible obligation. When we say this obligation is present obligation, that is provision. You have to pay now. We know the value. Possible obligation means we might have to pay, we might not have to pay. That will become contingent liability. Let us say it becomes a possible obligation, meaning it is confirmed to become an obligation in the future only on occurrence or non-occurrence of one or more future events, which is not wholly in the control of the entity. If this is a very, very remote possibility of it becoming against my favor, then don't even disclose it in the footnote. Contingent liability need not be even disclosed if it is very remote. If there is not remote possibility, but there is a possibility that it can happen. chance illa alla, chance ide, it can become your liability. Then what to do? Don't call it liability. It is still contingent liability. Why? For it to become liability, it should be like some event should happen. No, court judgment. So what do we do? This will be recorded as a contingent liability in the footnotes to balance sheet. After balance sheet, I would disclose it. If in case it is a present obligation, I have already created provision. I should check for conditions. What are the conditions? I told you, no, probable outflow and reliable estimate. If these conditions are fulfilled, we create provision. If these conditions are not fulfilled, there is no need to create provision. After creating provision, at every balance sheet date, please do review. Has this provision become liability, or is the provision amount correct? Is there change in the reliable estimate? If there is change, then please create additional provision. If there is excess, please write off provision. So provision amount can be increased or decreased at the end of each balance sheet date by review. And the point of discussion is we need to make a small disclosure for the nature and amount of impact in that contingent liability or provision. Pursue the impact of this item in the balance sheet. If it is provision, it will anyways appear in the financial statements. If you record contingent liability, mention the amount in that contingent liability. If it is not possible for you to mention for some reason, mention the reason, no, why you can't mention the value. If for some reason you can't value it in terms of money, mention the reason why you can't measure it in terms of money, but still disclose that in the footnote balance sheet. And that's Accounting Standard 29.
Let's now quickly revise Accounting Standard 4, which talks about events occurring after balance sheet date. This is an exception to the concept of periodicity. What does accounting concept of periodicity say? Whatever transactions happens within the accounting period should come in that accounting period. Whatever transaction happens after accounting period should not come in this accounting period. It should come in next accounting period and next accounting period's financial statements. The exception is given in Accounting Standard 4. It says certain events which happens after the balance sheet date can also be included in this financial statement. But there are some conditions. First one, that event which is happening after balance sheet date cannot be an immaterial event. It should be significant event. However, such significant event can be favorable, can be unfavorable. We are not saying only favorable events will be adjusted. Any transaction that happens after balance sheet date, if it is significant, whether favorable or unfavorable, can be an event occurring after balance sheet date. Talking about the second condition, I told you that it happens after balance sheet date, but after balance sheet date, it should happen before financial statements are approved. Before financial statements are approved. Financial statements will be approved by the approving authority. In the case of limited liability partnership, it is designated partner. In the case of HUF, it is Karta. In the case of company, it is board of directors. So any event which is significant, whether favorable or unfavorable, happening after balance sheet date but before financial statements are approved, it is called as event occurring after balance sheet date. Not all the events occurring after balance sheet date are to be adjusted. Certain items, though it is event occurring after balance sheet date, though it is significant, it will still belong to next year. For it to be included in current year financial statement, in spite of it is happening after that, it has to fulfill two conditions. How many conditions? Two. What are they? Number one, condition should be existing on the balance sheet date. On 31st of March, when I am preparing financial statement, a condition relating to such event occurring after balance sheet date should be existing. Then we can record it completely here, no? What is it happening after? After the balance sheet date, we get additional evidence about the transaction which is already existing on the balance sheet date. For example, on the balance sheet date, we have created provision for bad debts against a customer who owes us money and is gone through deep depression because of some loss, because of earthquake, fire or something. So before 31st March, we have sold goods, is our debtor, he's incurred huge losses and we've created provision. So there is a condition existing. After the balance sheet date, that is after 31st March, before 31st of July when the financial statements are approved, what happened? He declared himself insolvent. So he declared himself insolvent after 31st March. It is a next year transaction. It should appear as a bad debt in the next year. But EOABD AS4 says on 31st of March, you know that he might become bad debt. You had created provision. After 31st March, you got additional evidence. You adjust it as on 31st of March. So we need to make adjustment. How? Will we book bad debts entry? No. We'll make provision for 100% of debtors. Bad debt entry will be passed later. Here we'll write P&L to provision. Later we'll write bad debt to provision. Are you getting it? Similarly,
Similarly, let's say the cashier has stolen the cash before 31st March. So the cash suspense is there as on 31st March. After 31st March, before 31st July or 30th June, when the financial statements are approved, we got to know that the cash was stolen by cashier. So condition was existing on the balance sheet date. Event occurring after balance sheet date gave us additional evidence. So that cash stolen or defecated by cashier will not be booked as expense in next year. It will be booked as expense in this year in my P&L all by itself. Are you getting it? So if the event occurring after the balance sheet date is a significant event, whether favorable or unfavorable, if it is happening after balance sheet date but before financial statements are approved, it is an event occurring after balance sheet date. If the condition is existing on the balance sheet date and event occurring after balance sheet date gives additional evidence, then it has to be adjusted into current year financial statements. We will not wait to record it in next year. Got this? However, if the additional evidence comes after balance sheet date, if it is significant but not adjusting event, then what can we do? We can disclose it in our director's report. We can disclose it in our. Another important point to be remembered is, let us say there is no condition existing in balance sheet date, then it will not become adjusting event, no, because two conditions and both the conditions have to be fulfilled. If there is no condition existing on balance sheet date, only there is additional evidence or something happened after balance sheet date, it is actually not an adjusting event. It belongs to next financial year. But if the transaction or if that event what is happening after balance sheet date, it raises a question mark on the fundamental accounting assumption of going concern, then the financial statements have to be redrafted at fair value. Then that value will be recorded 0. For example, we have lost all our inventory on 15th of April because of a fire accident. It is an event occurring after balance sheet date because the fire accident happened on 15th April. Year ending is 31st March. Financial statements are approved on 31st of July. So it's happening between those two dates, event occurring after balance sheet date. As on 31st of March, did I know that fire will happen? If I would have known, I would have put fireproof jacket on that inventory. So I didn't know that the fire accident will happen. So it is an event occurring after balance sheet date, yes, but the conditions are not existing on balance sheet date. It will become non-adjusting event. So there is actually no need of adjustment. We should do only disclosure in board report. However, director's report. However, if all my inventory is burnt, there is no insurance policy also, this might lead to shutting down of my business. If they give such information like major fire accident, almost all the goods are burnt, there is no insurance claim. If they give information like this, then we need to check whether substratum of going concern, which is the fundamental accounting assumption, is it valid, needs to be checked. If the fundamental accounting assumption of going concern is valid, then no, not adjusting at all. Why? Event is occurring after balance sheet date. Condition is not existing on balance sheet date. No problem. Write it as loss in next year. However, if going concern is not there, our business might not see next balance sheet date. Then, though it is event occurring after balance sheet date, for which condition is not existing on balance sheet date, making it a non-adjusting event based on conditions, still we would have to redraft our entire financial statements because there is no going concern. We have to write all the assets at its fair value, disposable value, all the liabilities at its settlement value. And I'm doing it. This inventory will become 0 rupees in my books. Why? Inventory is not there, no. So how can I have NRV of that inventory? 0. So it is like I'm adjusting. That's what is told in Accounting Standard 4. Come on guys, let's quickly revise Accounting Standard 5, which talks about net profit or loss for the period, prior period items and changes in accounting policies. You won't get marks for writing the name of the standard right, though it feels like you should be given one. The objective of the standard is that financial statements will be usually prepared based on uniformity and to ensure that you can compare the current year financial statements with the previous years. That is, uniformity and comparability are the utmost priorities for the user when he looks at financial statements. And in doing this, Accounting Standard 5 will classify certain items separately and ask us to disclose them so that the user, when he takes the decision, his decision is not incorrect. Now, what are we talking about? We're talking about certain items from our profit and loss statement. The scope of the standard says that we need to identify ordinary items, extraordinary items, prior period items, exceptional items, changes in accounting policies and changes in accounting estimates separately. Ordinary items will continue to be there in statement, whereas certain ordinary items which are of exceptional nature
or which are prior period items, along with extraordinary items which are not ordinary, and change in policy and estimates needs separate disclosure. That, my friends, is the scope of the standard. What is excluded from accounting standard 5 is tax impact on all of these extraordinary items, exceptional items, etc. So don't have to look at accounting standard 5 for tax impact. Go to accounting standard 22. Talking about ordinary items. What are ordinary items? These are activities which are undertaken as a part of the business in the ordinary course, or for furtherance of business, continuing the business, or incidental to business. Every event and every transactions that happens as a part of the business, furtherance of business, or incidental to business is ordinary activity. By default, ordinary activities need no separate disclosure. But there are two ordinary activities or items which need separate disclosure. What are they? One is prior period item, other one is exceptional item. What is a prior period item? An item will be considered as a prior period item which appears in the current year because of an error or omission in previous year. It is omitted in the last year or recorded incorrectly in the last year. We identified that error or omission. We are rectifying it in current year. So that item which appears in current year P&L is called as prior period item. And this prior period item has to be disclosed separately. Not just prior period item, exceptional item, extraordinary item. All the three have to be disclosed separately. I'll come to this point later. For now, we know what is prior period. Prior period is an ordinary item, but it is error of previous year appearing in current year by way of rectification. So it needs separate disclosure. Then there is an item called ordinary item of special nature. We use the word exceptional item, but the word exceptional is not as per accounting standard 5. Exceptional item is the name given in schedule 3, but that represents this ordinary item of special nature, which we have inculcated as a name in this chart. What are exceptional items or ordinary items with special nature? These are ordinary items which require separate disclosure. How do we get to know? Based on size, incidence and nature, we identify their relevance for decision making. So these items, though they are ordinary, because their size is huge, because the incidence of this transaction is different, because of the nature of the transaction is different, it has to be disclosed separately. Once again, along with prior period items, exceptional items which are though ordinary need separate disclosure for its nature and amount so that we can perceive the impact of these items on P&L. Then comes extraordinary items. Extraordinary items are items which are not ordinary in nature. Usually ordinary items are part of business, furtherance of business, incidental to business. Extraordinary items are distinct from the normal operations. They are very far. They are not coinciding with your normal operations. So what are extraordinary activities? Those are events and transactions that are distinct from the ordinary activities of the business, or they are distinct from the ordinary items of the business. They are not in the normal nature of business. They are not in the normal transactions category. Earthquake, enemy attack, hurricane, thunderstorm, all of these are extraordinary items. Are you getting it? Then we go into the discussion on disclosure. Like I've been mentioning throughout, prior period items, exceptional items and extraordinary items need separate disclosure for their nature and amount to perceive the impact of these items on our P&L. Just to give example, rent, salary, purchase, everything is ordinary. Prior period item, rent of last year, not recorded last year. Purchase of last year, not recorded last year. Sale of last year, not recorded last year. Identified and rectified in current year. What about special items, exceptional items? You make the sale and earn the money, but you give huge consideration, like Dolly Chaiwala receiving 10 lakh rupees ransom from Bill Gates for sale of tea, but that money is not going to happen every year. That is special nature. Creation of provision, ordinary item. Are you getting it? Reversal of provision, exceptional item. Bad debts, ordinary item. Bad debt forgotten to be recorded in previous year. Prior period item in the current year when you record the same. Understood? Same Dolly Chaiwala, if he receives money for being the ambassador of Microsoft, that is extraordinary item. Money received for sale of tea, ordinary but exceptional based on size, incidence, nature. Last part of the standard is accounting estimate and accounting policy. Accounting estimate is different from accounting policy. We have discussed measurement principles in framework for financial statements. In framework for financial statements, we discussed that a specific item can be measured using historical cost, realizable value, present cost or current cost. If these four methods whatever are there, all of them fail and we cannot value an item based on the valuation principles, then we do it based on an estimate. How do you make estimate? Estimate is made based on the past experience and present situation. And there are certain situations in which this will be changed. When will we change it? We'll change it when we have more experience and we have better understanding. Then our old estimate is no more valid and then we'll replace our old estimate with new estimate. Such change is called as change in accounting estimate. Such change in estimate is not a prior period item. It's not our mistake and moreover it's not an accounting policy change also. So whenever there is change in accounting estimate, the impact on the financial statement should be prospective. You have to change it from now. And for change in accounting estimate, you have to make disclosures in your financial statements with regard to nature and amount to perceive the impact of this change in estimate in financial statements. However, due to some reason, if you are not able to identify the monetary value of such change, disclose the fact that you cannot identify the monetary value. Got it? This is change in accounting policy, estimate. This is different from change in accounting estimate, change in accounting policy. What is change in accounting policy? Firstly, accounting policy meaning is it is significant accounting policies or principles and methods of applying those principles in preparation of financial statements. We have learned this in Introduction to Accounting Standards. We have learned this in Accounting Standard 1 also. The same word comes. What is it? Significant accounting policies and methods of applying those policies in preparation of financial statements. Now, what is the reason for change in accounting policies? Actually, accounting policies should not be changed. The fundamental accounting assumption what we read in AS1, going concern accrual ಆದ್ಮೇಲೆ ಬರುತ್ತಲ್ಲ, consistency says that accounting policy should be consistent from one period to another period. We can't change. However, there is an exception given in AS1. That is the only reason why we can change our accounting policies. What is it? The reasons can be statute, law is asking us to change. Next one, accounting standard has changed, which is requiring us to change. Number 3, there is appropriate presentation possible by the change. If you follow the old policy, it is incorrect presentation. If you switch to new policy, new policy is giving you better presentation or appropriate, then what should you do? You have to change. That is the reason for change. Unlike change in estimate, when you change estimate, what do you give? Prospective effect. When you change accounting policy, you should give retrospective effect. You should change it from the beginning. In fact, when we discussed accounting standard 25, if you remember, if there is change in accounting policy in quarter 3, you have to redraft your interim financial reports for quarter 1 and quarter 2 also. We've discussed that. Lastly, whenever there is change in the accounting policy, check about its materiality. If in case it is material, disclose the change in accounting policy, reason for such change in accounting policy, financial impact if any arising because of such change in the financial statement, because that will have an impact on the financial statements, and to perceive the impact of such item on the financial statements for the user's decision making, it has to be disclosed separately. Got it?
Come on guys, let's now quickly revise Accounting Standard 11, which talks about effects of changes in foreign exchange rates. There are 3 parts in Accounting Standard 11. Part 1 which deals with foreign currency transactions, Part 2 which deals with foreign operations, Part 3 which deals with forward exchange contracts. Let's begin with Part 1 which deals with foreign currency transactions. Before that, let me also quickly tell you what are the parts against which Accounting Standard 11 should not be referred. You will never refer Accounting Standard 11 for identifying foreign currency cash inflows or foreign currency cash outflows for cash flow statement. Why? Regarding to cash flow statement, we have a specific standard called Accounting Standard 3. So you should refer AS3 and you should not refer Accounting Standard 11. And foreign currency difference, to the extent it will be regarded as borrowing cost, has to be treated as borrowing cost as per Accounting Standard 16. AS16 will specifically cover it. So that is again not covered under Accounting Standard 11. Lastly, the most important point is foreign currency effective rate changes, whatever this AS11 is there, no. This is applied in converting foreign currency to home currency. This is not applied in converting home currency statements to foreign currency. So we'll apply AS11 in converting financial statements which are there in foreign currency to reporting or home currency. We will not apply AS11 in order to determine the financial statements which is prepared in home to foreign. It's not home to foreign. It is foreign to home. It is foreign to reporting currency. I hope you will got till here. Going ahead, the first part of the standard, which is what we're talking about in foreign currency transactions. What is a foreign currency transaction? It's a transaction which is denominated in foreign currency or which is to be settled in the future in foreign currency. It can be receivable, it can be payable, it can be income, it can be expense. It can be purchase or sale of goods, acquiring or disposal of assets, rendering or availing of services, borrowing or lending of money, or it can also include forward exchange contracts. What's forward exchange contracts? We'll come back to it slightly later. This transactions, what we call as foreign currency transactions, has to be dealt with in three stages. Stage 1, initial recognition. Stage 2, valuation at balance sheet date. Stage 3, treatment of exchange difference. Stage 1, initial recognition. The day when we do the transaction, we have to record both the aspects of the transaction at the transaction date spot rate, the exchange rate that is prevailing between two currencies on the date of transaction is the rate at which we'll record both the aspects of the transaction. Let's say you buy inventory. Inventory in the form of purchase account debit, creditors account credit, both should be based on the exchange rate prevailing on the date of purchase. On the balance sheet date, we might have to restate certain items. Restate means item is there, but it's there at the rate which was there on the date of transaction. We need to give it a new value. That is the value that is there on the closing date. Should we do it for all items? Answer is no. This is done, restatement, only for assets and liabilities, expenses and incomes, which are originally recorded at the rate prevailing on the date of the transaction. That is spot rate will remain at that rate. We will not change the value. However, on the balance sheet date, we will consider assets and liabilities because they were recorded on one date. Their value is not yet over. It's there in balance sheet and it will come to next year. So these assets and liabilities, we will ask ourselves whether this asset or liability, is it monetary item or is it non-monetary item? What do you mean by monetary item? Monetary item is money held or assets and liabilities which can be expressed in fixed or determinable amounts of money. If it can be expressed in fixed or determinable amounts of money, monetary. What is non-monetary? Any item which is not monetary is non-monetary. If it is other than monetary, it is non-monetary. All the monetary items which were originally recorded at spot rate, that is transaction rate, should be revised to closing rate. Should be revised to, sir, what if the item is non-monetary? Non-monetary items by default should not be restated. They will be recorded at the transaction rate. It will remain at transaction rate. Monetary items on the other hand are converted to closing rate, restated to closing rate. However, there are some special non-monetary items like inventory. Sometimes we record inventory at cost, sometimes we record inventory at NRV. This is decided based on para 5 of AS2. We take whichever is less. If cost or NRV, whichever is less, turns out to be cost. Inventory is a non-monetary item. It should be continued to record at spot rate from the date of transaction. However, if the same inventory which is non-monetary item, it is not recorded historical cost, it is recorded NRV, which is lesser than cost. Then this NRV is picked on the last date of the year. That last date, whatever is the prevailing exchange rate, like closing rate, that will be the value considered. Let me repeat. If the inventory is recorded historical rate, historical cost, then historical rate. If inventory is valued at NRV, then NRV dates exchange rate, closing rate. Not just for NRV, but any other item other than inventory also. If it is valued at fair value, then that fair value's estimate date exchange rate will be considered for identifying the value. In short, monetary item closing rate, non-monetary item by default original transaction date rate. If the monetary item is recorded at fair value or NRV, then that fair value date rate will be considered. Contingent liability should be recorded at closing rate. In this restatement of monetary items and some non-monetary items, if in case we increase the value of the asset or decrease the value of a liability, that will result in exchange gain. If we have decreased the value of the asset or increase the value of the liability, it will result in exchange loss. This exchange gain or exchange loss by default should be transferred to P&L. Gain will be credited to P&L, loss will be debited to P&L. This is general by default case. Foreign exchange difference should go to P&L. However, there is a special case. This is an option given under para 46 and 46A of for para 46 and 46A of Accounting Standard 11. This paragraph came into picture only from 31st of March 2009. You can scan that QR to read the official notification issued by MCA. So what this notification says is, it gives an option to the company. If in case they have a foreign currency monetary item in the form of long-term loan, they have a foreign currency monetary item in the form of long-term loan or borrowing. That borrowing was recorded at one rate. At the year end, rate increased. When the rate increased, the liability or the loan will be restated. That increased amount will be charged to P&L by default. If you don't avail the option under para 46A, you will anyways charge it to P&L. Para 46A gives you an option. Instead of charging it to P&L, you can add it to the cost of your asset. If you add it to the cost of your asset, the asset should be depreciable asset. And that increased cost of the asset will be depreciated over the remaining useful life. This is if you choose the option and you have a depreciable asset. What if you want to take the option? You don't want to charge the foreign exchange difference to P&L, but very unfortunately, you don't have a depreciable asset. Then what to do? It will be returned to one dummy account called as FCMITDA, FICMITDA, Foreign Currency Monetary Item Translation Difference Account. The money will be kept there, and from FCMITDA it will be transferred to P&L, not immediately, but it will be deferred over the loan period, little every year. Why do we take this para 46A option? This is to ensure that there is no sudden impact of foreign exchange difference on P&L, converting a profitable P&L into loss-making company. To ensure that that doesn't happen, we've been given an option to add it to the cost of depreciable asset. If that doesn't exist, FCMITDA, and from there to P&L, little every year. This is with regard to foreign currency transaction. Next part 2 is foreign operation. What do you mean by foreign operation? You have a branch, you have an associate, you have a subsidiary, you have a joint venture outside the geographical boundaries of India. And that entity which is there outside India, it has already prepared financial statements in that foreign currency. Balance sheet, P&L, cash flow statement, everything is there in dollars. Now, in India, you need to incorporate or consolidate that foreign operations financial statements. But the trial balance is there in dollars. You want the trial balance in rupees. So you convert the trial balance which is there in dollars to rupees. That's what we mean by translation of foreign operations. The question here is, at what exchange rate should we convert dollars to rupees? The answer is not so simple. We cannot apply one rate for everything. We have to categorize the entity, that is foreign operation, into two. One, integral foreign operation. Two, non-integral foreign operation. Based on this classification, we are going to decide what rate to apply. How do we decide whether it is integral or non-integral? If the foreign operation is extension of Indian operations, it is integral. If the foreign operation is not extension of Indian operations, it is non-integral. I'll give you better understanding. If the foreign operation has significant freedom, it is not integral. It has its own way of doing things. If the foreign operation can pay the expenses on its own, if the foreign operation can collect the sale consideration in foreign currency on its own, if the foreign operation can decide at what price to sell on its own, if the foreign operation is not dependent upon India for money, it can take foreign currency loan and then it can do its business. Basically, an independent foreign business is non-integral foreign operation. And dependent foreign operation, like it is dependent upon head office for everything. It has huge number of transactions with head office. It borrows money from head office. It takes raw material from head office. Head office pays expense on behalf of the branch. In that case, the foreign branch is integral. It is extended part of Indian operations. If it can work independently like a separate company, it is non-integral. So why do we do this classification? If it is an integral foreign operation, then the transactions relating to assets, liabilities, expenses, incomes, all the items in trial balance are converted to rupees just like foreign currency transaction. Sir, what do we mean when we say foreign currency transaction? Simple. Monetary items at closing rate, non-monetary items at transaction. Sorry, monetary items at closing rate, non-monetary items at transaction rate. Expenses and incomes, we should apply actual. If actual is not available, we'll apply average. I'll repeat, monetary items, closing, non-monetary items, transaction rate. Expenses and incomes, we should apply actual. If not available, average. That is if it is integral. If it is non-integral, what is going to change? We'll transfer items whether monetary or non-monetary at closing rate. Non-monetary items which would have been transferred at transaction rate in integral are converted at closing rate in non-integral. And the next point of difference is, after we convert that dollar trial balance to rupee trial balance, that new trial balance will not tally. If in case it is integral foreign operation, that exchange difference will be transferred to P&L. Why? It is like my own extended operations. Difference in trial balance of integral foreign operation will be transferred to P&L. However, if it is a non-integral foreign operation, difference in trial balance which will arise will not be transferred to P&L. Instead, it will be kept in foreign currency translation reserve account. That will stay there till the time the foreign operation is closed. The day the foreign operation gets closed, that day this will get transferred to P&L or reserve. I hope you all got this. Let's go to the last part. Before that, one small thing. PPE as well as its depreciation should be recorded at purchase date rate. Inventory should be usually recorded at actual. If actual is not available, opening stock at opening rate, closing stock at closing rate. If actual is available, should go by actual. But usually actual will not be available. Don't worry. Last one, forward exchange contract. What is forward exchange contract? It is contract between two parties. It is contract between two parties to buy or sell two currencies on a future date at an agreed rate. Today, I and you will sign a document saying that I will buy certain number of dollars from you after 3 months for a rate that we agree today. That is forward contract. How to do accounting for forward contract? Depends upon the purpose for which forward contract is entered into. A person can enter into forward contract for two reasons. Number one, to hedge the money market, to hedge his risk. Second option is to do speculation. If I say hedging, it basically means that I have a foreign currency exposure. I have a liability to pay after 3 months, or I have an asset to receive after 3 months, and I am exposed to that foreign currency risk. I want certainty. So I will ask a dealer, at what rate will you give me dollars after 3 months? He agrees. I am entering into a contract here to buy dollars because I need to pay someone. This is for hedging the risk. In this case, out of the three rates which are available, which is transaction date spot rate, forward contract rate, and settlement rate, if the contract is for hedging, I will consider spot rate and forward contract rate. I'll ignore settlement rate. I'll consider transaction date spot rate and forward rate. I will ignore settlement rate. Difference between transaction rate date spot rate and forward contract rate will be considered as premium or discount. If it is more, it is premium. If the forward contract rate is more than spot, it is premium. If forward contract rate is less than spot, it is discount. That spot rate and forward contract rate difference is identified per dollar. Multiply it with the total contract value. You will get total forward contract premium. That has to be transferred to P&L over the forward contract period, not on any specific date, not on the transaction date, not on the year end, not on the settlement date. It will be over the forward contract period. If the forward contract's entire period is in one accounting year, full premium or discount will go to that year. If forward contract is lying between 2 years, proportionately based on the time will transfer to P&L over both the years. This is if the forward contract is entered for the purpose of hedging the risk. Second one is forward contract will be entered into for speculation purpose. When I say speculation, I have no foreign currency payable. I am not a trader who's buying goods or selling goods. To me, business itself is money. I am entering into a contract with a forward exchange dealer or foreign exchange dealer with an intention to make profit because of foreign currency fluctuations. So in this case, we will ignore the transaction date spot rate. We will only consider the forward contract rate and settlement date spot rate. Between the forward contract rate and the settlement date spot rate or settlement rate, difference whatever is there, that will become a profit or loss. That will be booked only on the date of settlement. We are not going to record it early. So for a hedge transaction, we'll take difference between spot rate and forward rate. For a speculation transaction, we take difference between forward rate and settlement rate. In hedge transaction, we'll book forward contract premium or discount over the contract period. In a speculation transaction, we ignore forward contract premium. We don't write it over the contract period. All the entries are written only on the settlement date. And the settlement date profit or loss is determined as difference between forward rate and settlement rate. If the settlement rate and forward rate are different, that will be profit or loss. And where will it be transferred to? And which date will we write it on? Settlement date. And this covers your accounting standard 11.
Let's quickly revise accounting standard 22, which talks about taxes on income. Though the standard talks about taxes on income, we are not going to discuss about indirect taxes in this standard. All we're going to discuss is only and only about direct taxes. The way we compute tax amount that should be paid as per Income Tax Act 1961 is also told under Income Tax 1961. So the income as per books of accounts, which is prepared as per Accounting Standards and Companies Act, is not the taxable income. How to determine taxable profit on which tax has to be paid is given by Income Tax Act 1961. So the taxable profit, which is computed as per Income Tax Act 1961 multiplied by tax percentage, will give us current tax. Current tax is the amount that should be paid. On the other hand, amount that is determined as profit as per P&L account, that is based on accounting standards, is the amount on which we apply tax percentage to determine tax expense. In short, tax expense is net profit as per P&L account multiplied by tax percentage. Taxable profit multiplied by tax percentage is current tax. Tax expense, which is computed on accounting profit, is the amount of expense. Current tax, which is computed as taxable income multiplied by tax percentage, is the amount to be paid. These won't be same, they will be different. The reason for the difference between taxable income and accounting income, which will lead to difference between tax expense and current tax, can be categorized into two. One, permanent difference. Second one, temporary difference. Permanent difference is the difference which will arise in one period, which will not get reversed in the subsequent year. On the other hand, temporary difference is a difference which will arise in one accounting period and it will get reversed in another accounting period. To give an example, depreciation. Depreciation under accounting can be done under WDV, SLM or production units method. On the other hand, under tax system, unless it is an electricity distribution or manufacturing entity, we have to follow WDV. Because the method can be different, the amount of depreciation will be different between taxation and accounting. Because the expenses by way of depreciation is different, profits as per tax records, profits as per accounting records will be different. When these profits are different, on this the tax amount what we compute will also be different. So the tax paid and tax expense will be different. This is only short term difference. This will get reversed in the subsequent years because over the entire useful life of the asset, we are going to charge a finite amount of depreciation. Depreciation will be same throughout the life. It might be charged little less in 1 year, little more in 1 year, but it cannot exceed the cost, it cannot be less than the cost. So that's the reason we call depreciation as timing difference. Or another expenditure which is temporary difference is preliminary expenses, which is regulated by section 35D of Income Tax Act 1961. As per accounts, if I incur any preliminary expenditure, I will charge it to my P&L account in very first year. Entire 50,000 what I have incurred as preliminary expense is expense in year 1. However, as per tax, only 10,000, that is 1/5 of that 50,000 is allowed as expense every year. So in accounts, I charge 50,000 to my P&L account in 1 year. In tax, I write 10, 10, 10 as expense over 5 years. Because of which, profits under each of the years will be different. This is temporary difference. Now what is permanent difference? Example can be something like 40A2 or 40A3 or 35 scientific research. 40A2, if you make excessive payments, like you have appointed a clerk who happens to be your relative, he is a person with skill set which deserves salary of 15,000. Let's say you give him salary of 20,000. You made excessive payment of 5,000. As per accounts, we don't care about excessive expense or excessive payment. 20,000 per month salary will be our expense. However, as per tax, only 15,000 per month is allowed as an expenditure. 5,000 rupees, which is an expense paid to the employee in excess of his skill and caliber, is disallowed as an expenditure, and this is permanent disallowance. Similarly, similar to this is 40A3, wherein the cash is paid for an amount exceeding 10,000. Under tax it is not an expense because it is cash payment. Under account it's still an expense because we don't care about tax provisions when we start booking our expense in accounts. Because of these differences, profits will be different as per accounts and tax. On that, the tax that we compute also will be different. Between these tax differences, current tax and then tax provision, tax expense as per accounts and current tax payment as per tax, whatever difference arises, we can create deferred tax asset or we can create deferred tax liability only if the difference arising is temporary difference. If the difference arising is permanent difference, there is no possibility of creating deferred tax asset or liability. Whatever is our current tax as per income tax will be accepted to be tax expense and it will be charged to P&L account. However, if the difference is because of temporary difference, we arise the difference arising between our current tax to be paid and tax expense will be booked as deferred tax. Tax expense, what we charge on accounting profit, is what is paid this year, current tax, plus what is deferred and to be paid in later years. So by this we can conclude that there is a formula for determining deferred tax which goes like tax expense is equal to current tax plus deferred tax. Tax expense, what will be charged to P&L account, can be paid this year by way of current tax or can be deferred to be paid in the later years, that is deferred tax. If in case in this formula we substitute our current tax and tax expense, we can find deferred tax liability or deferred tax asset. After substituting tax expense and current tax, if deferred tax happens to become positive, that means there is further expense to be booked beyond our current tax payment, there is further expense to be booked. Such an expenditure, it is not current tax because we are not paying it now, we would have to end up paying it later, meaning our tax expense is much more than current tax and that would lead to our deferred tax liability. Tax on accounting profits is more than tax on taxable profits. Tax expense is more than current tax and we create provision for this amount, we pay this amount. To the extent we don't pay now, we would have to pay later. It is some money that we are saving now but we would have to pay later. So right now it is an expense which is not paid, which will lead to deferred tax liability. On the other hand, if our tax expense is less and we end up actually paying more, that excess amount paid will become our deferred tax asset. If in case in this tax expense is equal to current tax plus deferred tax formula, when we find deferred tax by substituting tax expense and current tax, if we get deferred taxes deduction, that means out of the amount that we have paid as current tax, expense is much lesser. Such a decrease in the amount is the money that we have paid now which we will save later years, in the later years. So that would lead rise to deferred tax asset. In short, the formula is tax expense is equal to current tax plus deferred tax. In this, if the deferred tax resulting is positive, it is deferred tax liability. If the deferred tax resulting is minus, then it is deferred tax asset. The next thing that I would want you to note is there is another way of remembering this entire logic. It is if the tax expense is the expense that is computed based on accounting profit, tax payment is the payment that is determined based on the taxable profit. If in case our expense is more than payment, I mean to say tax expense is greater than current tax, what is happening? Expense is more, payment is less, we have to further pay, that is deferred tax liability. If in case our expense is less, that is tax expense is less, whereas current tax that we have paid as per tax provisions is more, that will become deferred tax asset. Obvious, isn't it? When the expense is more than payment, outstanding expense is liability. When the expense is less but the payment is more, it becomes prepaid expense, that is our asset. A beautiful shortcut to remember the entire thing that we've learned so far is YEA, tell. YEA is YEA, tell is TEL, YEA. If accounting expense is more, it is asset. If tax expense is more, it is liability. YEA, accounts expense, if it is more, it is asset. If tax expense is more, it is liability, and this will solve a lot of your problems. Then deferred tax asset recognition should be done little wisely. You would have to be prudent, you would have to make a prudent understanding of the business scenario and then record it, because assets cannot be overstated. You would have read this in accounting standard 1, which talks about prudence when you're picking your accounting policy. Prudence says that we cannot overstate our profits and assets. And whenever you record deferred tax asset, it is an asset, it is a resource which is going to give you future economic benefit for the amount that you paid over and above your current tax, over and above your tax expense in the current year. You will create deferred tax asset only when there is a reasonable certainty that in the later year, the situation will reverse and we can adjust this deferred tax and only pay the lesser amount. Are you guys getting this? Right now our accounting expense is more, so we are creating deferred tax asset. In the later year, accounting expense should be less, that is tax expense should be more, for the reason of creating deferred tax liability. If you have created deferred tax asset in year 1, in year 2 we don't create deferred tax liability, we will reverse the deferred tax asset previously created. If there is a possibility in the future that accounting expense which was more in year 1 will become less in year 2, only then we would have to create deferred tax asset. If not, you should not create deferred tax asset. We call this reasonable certainty. However, if in an organization there is huge unabsorbed depreciation or huge accumulated losses which can be carried forward, what happens in this case is, in the future years, even if you make profits, that profits will be adjusted against unabsorbed depreciation, that profits will be adjusted against the carry forwarded losses, because of which the taxable profit becomes less and the payment becomes less, which will never give rise to scenario of utilizing deferred tax asset. So if an organization has huge accumulated losses or huge unabsorbed depreciation, then before creation of deferred tax asset, don't just check for reasonable certainty, check for virtual certainty, meaning there should be proof and concrete evidence that the deferred tax asset what you are creating in the current year will get reversed. I repeat, deferred tax asset creation is subject to prudence. It can be created only if you expect reversal of deferred tax asset in the later year. When you are creating deferred tax asset, please check for reasonable certainty that there is a possibility of reversal. However, if there is huge accumulated losses or unabsorbed depreciation, reasonable certainty is not sufficient. You have to check virtual certainty, that is proof with evidence. That's with regard to deferred tax asset recognition. So what would be the accounting entry whenever we are trying to account for deferred tax? Initially, whenever we take that expert's tax computation, to that extent we'll write tax expense account debit to provision for tax. When we write tax expense account debit to provision for tax, we are only going to debit the current tax amount. Current tax amount is the amount that should be paid to income tax department, and I am crediting the same with my provision. After I make this provision only to the extent of current tax, that is taxable income multiplied by tax percentage, I will compare this taxable income with my accounting income. Accounting income into tax percentage, when I do, what I arrive at is the tax expense that I should be debited to P&L. If the tax expense what I compute as per accounting profit is more than the current tax, then I would have to create further expense. So I debit my tax expense account and credit deferred tax liability. But though I increase my expense by debiting tax expense, payment will be only to the extent of current tax. So to the extent I won't pay, it will become deferred tax liability. On the other hand, if my tax expense, that is on accounting profit, happens to be lesser than current tax, then what should I be doing? I should decrease my tax expense. Current tax what is debited is the tax that I pay, but my accounting expense is less. I should decrease this expense. In order to decrease this expense, I will credit my tax expense and debit deferred tax. So my payment is more than the expense as per P&L. Over here, what is happening? The expense is more than the payment, so it is deferred tax liability. And next, we need to set off our current tax and deferred tax. If it is legally enforceable that we can set off, it is arising because of the same purpose, then I will do set off. If not, if legally enforceable right to set off exists, then I will do set off. If not, I won't be doing any set off. Deferred tax asset and deferred tax liability, if it is computed under the same law for the same item, we can do setting off. If not, we cannot be doing the set off provision. Then let's talk about the minimum alternate tax and normal tax. Minimum alternate tax. See, with regard to deferred tax computation, don't ever worry about minimum alternate tax. First, finish off your entire deferred tax asset, deferred tax liability computations. Only when you are done with your deferred tax asset, deferred tax liability computation, then start with MAT. because the standard 22 says that don't apply MAT in computation of deferred tax. So finish off your deferred tax, then start with MAT. MAT is regulated by section 115 JB of Income Tax Act 1961. As per the provisions of section 115 JB, we compute book profit for the purpose of MAT. On this book profit for the purpose of MAT, which you actually don't have to compute, will be given to us in the question. We'll apply MAT rate. MAT rate will be lesser than the normal tax rate because MAT profit will be more than the normal taxable income. So MAT rate will be around 10%. Book profit will be almost equal to accounting profit. So let's get back minimum alternate tax. So we'll apply the MAT rate on the book profit as given under section 115 JB. On that book profit, when we apply MAT rate, we will arrive at minimum alternate tax. As the name says, it is the minimum money that should be paid in alternate way other than the taxable income. Meaning what? If the taxable income multiplied by tax rate, whatever we find as per normal income tax rates, if it is less than the MAT, then we should pay MAT. If the taxable income multiplied by tax rate, what we determine as per normal tax provisions, is greater than the MAT amount, then we pay normal tax. The problem doesn't exist when we pay taxable income multiplied by tax rate, that is tax as per normal rates, is greater than MAT, then there is no problem. If the taxable income multiplied by tax rate is lesser than MAT, then this amount what you are paying in excess of the normal taxable income into tax rate, that amount is allowed to us as MAT credit, minimum alternate tax credit. And in the later year, when the taxable income multiplied by tax rate as per normal tax rate exceeds MAT, then minimum payment will be this much. To this extent, difference between these two, whatever MAT credit you have availed previously can be utilized and you can pay only MAT. Let us say MAT is 100, normal tax is 90. We have to pay 90 normally, but we paid MAT of 100. So 10 rupees what we paid in excess of tax, normal tax, will be MAT credit. In the later year, if normal tax becomes 15, normal tax becomes 15 and our MAT is 10, that 5 what we are paying in excess of minimum money, that can be utilized from the MAT that we have already paid. So though normal tax is 15 and MAT is 10, I won't pay 15, I'll pay 10. 5 of MAT whatever is available will be, whatever was credited previously will be utilized. If MAT is over, then we would have to end up paying the normal taxable income. And this is with regard to our minimum alternate tax in comparison with normal tax. The journal entry will be provision for tax will be debited, MAT credit when you're creating it, you're debiting it, and then you credit bank. MAT credit is like asset. Later when you utilize MAT credit, you will be crediting the MAT credit amount. Got that? Then if MAT credit is greater than normal MAT, this is what I was just trying to tell you people. And MAT has to be created only when there is a MAT credit can be availed, only when there is a reasonable certainty that it will reverse in the future year. If you think, see, this is your tax, normal tax, this is MAT. Right now, what your normal tax is less and MAT is more. You end up paying MAT. This MAT will become your expense unless until there is this scenario, whereas your taxable income will exceed MAT in the later years. If you expect taxable income and normal tax to exceed MAT, where you can avail your MAT credit, if that scenario is possible, you will avail MAT credit. If the possible scenario is this and you never expect the situation to go this way, then don't create MAT credit. Book the entire amount of tax that you pay as your expense. So don't book any MAT credit. Again, prudent estimate is what we are trying to do. And the last point is with regard to tax holiday. In the case of startups, a special feature is allowed by the Income Tax Act of 1961, which says that a startup need not pay tax for 5 years in the first 10 years. So when tax holiday period is allowed to any of a startup or any entity, then they need to recognize their deferred tax liability only and only if it will get reversed beyond that tax holiday period. If that deferred tax liability is getting created during tax holiday and it is getting reversed during tax holiday, then there is no point in creating. No, tax holiday period you don't pay any tax. If deferred tax liability is getting created during tax holiday period and it gets reversed beyond tax holiday period, only then you need to create deferred tax liability. So this is the point that I want you to note with regard to deferred tax liability along with tax holiday. I hope you understood this quick revision of Accounting Standard 22, Taxes on Income.
Welcome to quick revision of Accounting Standard 7, Construction Contract. Though the name of this standard is construction contracts, I personally believe this should have been named as revenue from construction contract, because what the standard tells us is the contract which runs over more than 1 year. You need to understand how much revenue to recognize in each of that year, how much expense to recognize in each of that year, so that you will identify how much profit is to be recognized from this contract in each of the year. And this is the objective of the standard. This standard is applicable to all of them who are contractors and who are into the business of construction. Then comes the definition or meaning of the word construction contract. Construction contracts are contracts which are specifically negotiated for one single asset construction or combination of assets construction, which are interrelated or interdependent based on design, technology or function. And these construction contracts need not include material in all the cases. If in case you are giving only architectural service, which is a service contract, that is also part of construction contract, that is also regarded as construction contract. And construction doesn't just mean building ground floor, first floor, second floor. Sometimes demolition of that or the ground which is dug up, if you are restoring that, that is also regarded as construction. Construction contract includes service contracts. It will include contract for destruction or restoration of assets or restoration of environment, like restoration of a mining site to ground level. Understood? Then what are the types of construction contracts that we have? Based on the revenue, construction contracts are two types. One, fixed price contract. Second one, cost plus contract. Under fixed price contract, as the name says, the price is locked. The contractor is supposed to receive a fixed price. Contract is supposed to pay a fixed price. However, it is subject to escalation clause. Lot of things after entering into the contract, before you complete the contract, will change. So they can enter into an escalation clause which states that if the total cost goes up by more than 5%, revenue can be increased by 5%. So that clause which will trigger the increase in the revenue on happening of certain things is called as escalation clause, and this will be there in fixed price contract. Because of uncertainty involved, if the contractor is not able to quote the fixed price, that will almost lead to a point where they cannot enter into an agreement at all. That's where the savior comes, which is called as cost plus contract. In cost plus contract, contractor and contractee agrees upon an agreed percentage, which is the profit what the contractor will make over and above the cost. So as and when the cost is incurred, it will be total. On that cost will apply one percentage. That percentage is the profit, which when it is added to the contract cost incurred will become the contract revenue. And such contracts are called as cost plus contracts. You can have a combination of both also when it is agreed between contractor and contractee. As I mentioned some time ago, the recognition of profit or loss is the objective of AS7. It will tell us how to recognize revenue, how to recognize expense. From revenue, when we deduct expense, we will get the profit. Recognized revenue minus recognized expense will be the profit to be recognized. However, there is a small extra point to be noted against this, that is para 35. I'll discuss that slightly later in the same video. Now it's time to understand what do we mean when we say contract revenue and what do we mean when we say contract expense. Contract revenue, the money that the contractor will receive from the contractee for the construction, has to be recognized when it fulfills two important conditions. Number one, when there is reliable measurement. Number two, when there is probable result. Only when these two conditions are fulfilled, the contractor should recognize the revenue. Otherwise, he doesn't. What do you mean by reliable measurement? We'll discuss that later. For now, how do we determine what percentage of the contract is complete? Is done by way of cost incurred method. So the method that we're going to use throughout our CA intermediate discussion of AS7 is called as percentage completion method. We don't follow total cost method. You might get some questions wherein they might say that the contractor wants to follow total contract cost. That is not allowed. We follow percentage completion. Every completed year, we determine what percentage of the contract is complete, and that percentage of the contract revenue will be recognized in P&L. And that percentage of contract cost is also recognized. So we'll identify that percentage of contract profit in contract PL. I hope you're getting it. How do we determine that percentage? We take cost incurred divided by cost incurred plus to be incurred. That is total cost. Cost incurred divided by total cost will give us percentage complete. There are a couple of other methods which I'll refer slightly later, but they are not supposed to be followed in exam preparation. Then contract revenue, what does it mean? It will include such revenue what the contractor and contractee has agreed upon in the agreement. Over and above this, there are certain things that you should know. Variations, claims, incentives, penalties. Variation, other than the scope that is decided in the agreement, if the contractor gives extra service or if the contractee asks the services to be brought down, to the extent they are going out of the scope, contract revenue will be altered. Variation can be upside, variation can be downside. Contract is for construction of 4 floors. Contractee might ask the contractor to build 1 more floor, or contractee might ask the contractor to build 1 floor less. If you have to build 1 more floor, contractor will add the revenue. If you have to build 1 floor less, contractee will ask for decrease. That plus or minus is what we call as variation, which is arising because of change in the scope. Next one is claim. What do you mean by claim? If in case contractor incurs the expenses over and above what is supposed to be incurred in the agreement, for such expenditure, contractor will take reimbursement from contractee. That reimbursement of the expense incurred by the contractor, which is taken from the contractee, should be added to the contract revenue as per agreement. After that, we have something called incentive. If the contractor gives the performance beyond the standard set as per agreement, I finish the construction before time, or I give the service more than the service level I promised, so you will be happy as a contractee, so you give me incentive. Such additional consideration received by the contractor for better performance, maybe time or maybe quality. Either of it, if it is becoming better, contractee gives additional consideration that will be included in contract revenue, and that's called as incentive. Finally, we have penalty. As a contractor, if I don't finish it in time, if I delay completion, or because of me you are paying some fine, or because of me you are facing some loss because the quality of performance is low, you will charge me some penalty. You will deduct a portion of my consideration and give me only the balance. That portion what you deduct is called penalty. So the contract revenue that should be treated by the contractor as his revenue is revenue as per agreement plus or minus variation plus claim plus incentive minus penalty. And this is what we mean when we say revenue. What do we mean by contract expense? As a contractor, we directly incur some expenditure for construction, that is contract cost. We indirectly incur some, meaning we have incurred some joint expenditure for several contracts together. One engineer who works in 3 construction sites, so that one engineer's salary is to be allocated to all the 3 construction sites proportionately. If I allocate, that allocated cost also becomes part of my construction cost. Thirdly, any other cost. Let's say I have one machine which I'm using for all the construction sites together. Based on the time usage, I'll allocate that overhead expenditure, that is depreciation on that machine or repairs and maintenance of that machine. That also becomes part of my contract expense. Are you getting it? However, if that asset that we have, which is charged to depreciation, is idle, meaning that asset is not used in construction site, then the depreciation cannot be added to the contract expense. Similarly, if there is general administration expenditure, selling and overhead expenditure, research and development expenditure, all of this should not be included in the contract cost. They should be straight away written to P&L. It will not go to contract PL. It will go to general P&L straight away. And then the part is, before you get the contract, if you have incurred some expenditure, it is called as cost incurred to secure the contract, and it can be included into the cost of the contract but need not be. The basic thumb rule is, before you get the contract, if you incur expenditure, that should go to P&L. However, paragraph 20 of Accounting Standard 7 gives a very beautiful situation, because of which we can include some cost incurred before the contract into the cost of the contract. To do that, it has to fulfill 3 important conditions, IMP. I. What is I? Identifiable. You should be able to identify that expenditure to be related to this contract specifically. Second point, that cost should be measurable in terms of money. Third point, probability of getting the contract should increase because of this expenditure. In such cases, this expenditure what is incurred even before you get the contract need not be transferred to profit and loss. It will be kept with you and added to the cost of the contract. Am I right? After this, we'll discuss how to recognize the revenue. I told you revenue has to be recognized when there is reliable measurement and probable result. Now the point is, if the revenue can be reliably estimated, then we will recognize based on percentage completion method. However, if the revenue cannot be reliably estimated, cost will anyways be recognized when it is incurred. Revenue recognition will be postponed till the time you have reasonable certainty or reliable measurement. Only on the day when you get reliable measurement, you will recognize the revenue, otherwise no. To summarize this recognition of revenue in one shot, cost will be recognized the moment it is incurred. Revenue will be recognized only when there is reasonable certainty or reliable measurement of the revenue. The question that comes next is, how do we get to know whether there is reliable measurement or not? How do we get to know? Very simple. Reliable measurement has to be made based on cost incurred and cost to be incurred. When you get cost already incurred, that will be known, plus cost to be incurred, if you know, you get total cost. When you get total cost, you will find percentage of completion. When you find percentage of completion, you will multiply it with total contract revenue to find the contract revenue to be recognized. If in case you cannot identify cost to be incurred, you cannot find total cost. When you cannot find total cost, you cannot find percentage. When you cannot find percentage, you cannot identify revenue to be recognized in the year. In that case, what do? There is no reliable measurement. It cannot be estimated with certainty. Then we recognize our expense to P&L, but revenue will be postponed till the time there is reasonable certainty. This is how it works with fixed price contract. Under cost plus contract, there is one more thing that you should know. What is that percentage of profit that you should add to the cost? Only when you know cost incurred, to be incurred, you will find percentage. Only when you know that percentage of agreed value over and above cost, then you will be able to recognize contract revenue to be recognized in the current year. Otherwise, no. Then the point is stage of completion. I told you stage of completion is computed under three methods. One is cost incurred to total cost, what we follow. The other method is survey method. Next one is physical proportion method. We don't follow survey method and physical proportion method. That is work certified thing. We go by cost method. That is cost incurred divided by total cost multiplied by 100. Then comes the most important part of the standard, which is para 35 of accounting standard 7. Para 35 states that at any point of time, if the total contract cost exceeds total contract revenue, then you are going to make loss, no, in total. Total contract cost is greater than total contract revenue. Entire loss should be recognized, irrespective of the fact whether a contract is begun, irrespective of the stage of completion, irrespective of the profit from other contracts. Contract revenue is recognized based on PCM. Contract cost is recognized based on PCM. If there is loss that comes in P&L will be percentage only. But you should write total loss. If you write total loss, to the extent loss is not yet incurred, because the contract is not yet complete, will be called as provision. What you have to do is open contract PL, PCM percentage multiplied by total revenue, write credit side. Contract cost incurred or total contract cost into percentage, you write debit side. Don't write proportion loss. Write total loss from the total contract revenue and total contract cost on the credit side. Find provision as balancing figure on the debit. I hope you got it. If in case there is any cost incurred relating to future activity, we have paid the expense but benefit is not taken. I bought material for 25,000. Material used in construction is 20,000. 5,000 worth of material purchased but not used will be transferred to next year. So in the next accounting year, we will recognize that 5,000 as expense. In the current year, that 5,000 will become asset. So to the extent cost is incurred but benefit is not consumed, will be postponed to next year only if it is probably recoverable in the next year. That's with regard to cost relating to future activity. Then we have uncollectible revenue. If we think that we might not receive the revenue at the time of giving the construction service, we will not recognize the revenue only. Why? There is no probable result. We think our contractee will not give us money, we will not book income. However, at the time of giving the service, there is reliable measurement and probable result. So you recognize the revenue. After that, you got to know that contractee will no longer pay you the money. What will you do in that case? Then revenue which is already recognized will be reversed. And then we have combining and segregating contracts. See, if negotiation can be done separately, cost and revenue can be identified separately, profit can be determined separately, then they have to be treated as two separate contracts, not as a single contract.
But these two assets will be treated as a single contract when what we discussed in definition is important. By design, technology or function, they are interrelated or interdependent. Understood? Then the estimate keeps changing. We estimated some amount to be the total cost in year 1. That need not be the same. That can change in year 2. That can change in year 3. Both upwards as well as downwards. When that changes, then the amount of expenditure to be recognized will change. Percentage of completion will change, as well as revenue to be recognized will change. Whenever this happens, it is change in accounting estimate, not a prior period item, not a change in accounting policy. More of this you will read in accounting standard 5. Disclosure requirements. Whenever you are running a contract, you need to tell what percentage of the contract is complete, what percentage of revenue is booked, how are you recognizing that percentage basis, and how much money have you received, how much money is yet to be received, how much money have you received excess. All of these have to be disclosed. If in case you have collected the money before completion of the contract, it is called advance. If the service is given but the contractor has not paid us the money, keeping it with him because he wants to check the work, it is called retention. And finally, you have raised the billings before the completion of the contract, that bill is called as progressive billings. And lastly, the questions can come asking you to determine asset or liability. Asset or liability is determined like this from the customer. You have to recover the cost incurred plus profit from your customer. If there is loss, that loss will not be reimbursed by the customer. So you take cost incurred, add the profit recognized, deduct the loss recognized. When you do cost incurred plus profit recognized minus loss recognized, you will get the amount to be charged. If the amount to be charged is more than the billing made, you have collected extra liability. If the amount to be charged is less but the billing made is more, then you have a liability, you charged more. If the amount to be charged is more but amount of the billing done is less, it is asset. This can be done slightly differently. Mathematics, what to do? Take cost incurred, add recognized profit, deduct recognized losses. From this, if you deduct progressive billings, the resulting number, if it is positive, it is asset. If it is negative, it is liability. Once again, expense incurred plus recognized profit minus recognized loss minus progressive billings. If the resulting number is positive, it is asset. Negative number, liability. So amount due to customers is liability. Amount due from customers turns out to be your asset. And this is accounting standard 7.
Come on guys, let's now quickly revise our accounting standard 9, which talks about revenue recognition. Accounting standard 9 talks about two things. One, timing. Number 2, criteria for recognition of revenue. When to recognize and when what criteria is fulfilled should we recognize the revenue. And this particular standard of accounting standard 9 is not applicable in following cases. One, to recognize revenue with regard to construction contracts because it is already regulated by A7. And it is not applicable again in recognition of revenue from leases because we have accounting standard 19 against it. And also when we are receiving grant from the government, we don't have to apply accounting standard 9 because accounting standard 12 specifically covers how to recognize government grant. And insurance contracts are not covered under accounting standards only. So for recognition of revenue on insurance contracts, again we won't apply accounting standard 9. There the revenue recognition will happen on accrual basis, actuarial basis. So actuarial science, whoever would have heard of, they will give you the basis based on which you can recognize your revenue, considering the risk involved in insurance contracts. What does the word revenue mean? Revenue includes inflow of cash if you received cash, or sometimes you have not yet received but you are about to receive, receivable. And it need not be cash, it can be non-cash consideration as well. So revenue is cash received or receivable or non-cash consideration arising because of or arising from sale of goods, rendering of services, or other items like royalty, interest, and dividend. So if you have sold goods, when to write the sale entry? On fulfillment of what criteria should you write the sale entry? If you are rendering services, when and at what point of time should you decide to write the service receipt entry? And when should we record interest income? When should we record royalty income? When should we record dividend income? Is the things that is covered under this standard, and that should arise from the ordinary course of operation. Got it? Then what are the exclusions from revenue? See, the sale of PPE is covered under AS 10. That is not covered under accounting standard 9.
derecognition, disposal, we've related there. Next thing is liability settled against or restated below carrying amount. Let's say you have a liability, you owe money to someone, because you didn't pay the money to them, they come to your shop, they take your inventory and go. That's not sale. For recognizing sale entry there, we will not learn from accounting standard 9. Or if in case you reduce the value of the inventory because NRV is lesser than the cost, that is not sale again. That is again not covered under accounting standard 9. Or forex rate changes or translation differences are treated as per S11 and not here. Let's say you sold goods for $1,000 when the exchange rate is 80. So you rate debtors to sales 80. At a later date, then the exchange rate goes to 85 rupees per dollar. So for the same sale, which you had recorded at $1,000 into 80, now it should be restated for the receivable $1,000 into 85 because debtors is a monetary item. Such restatement what you do, which will increase your receivable by some 5,000 or 500, whatever that profit that will arise, that is not AS9 regulated revenue. That is as per accounting standard 11. It will go to FEDA, foreign exchange difference account, and from there to P&L account. That is not regulated by AS9. AS9 will not tell the timing and criteria to recognize that revenue. Understood? Talking about specific items in AS9, like I told you, the first part is sale of goods, second part is rendering of services, third one is interest, royalty, and dividend. When do you recognize revenue from sale? You recognize revenue from sale when it fulfills the following conditions, that is transfer of risk, reward, and effective control. Risk, who has the responsibility if the asset goes into damage or if that item goes into damage. Reward, who has the right to utilize that product. Effective control is nothing but possession. So when you transfer risk, reward, and effective control, you can recognize the revenue by rating sale entry provided there is no significant uncertainty in consideration. You don't have any doubt about receipt of consideration. You are confident that you will receive consideration, or you are not doubtful about not receiving consideration. So 2 points. Number 1, a transfer of risk, reward, and effective control. Number 2, no significant uncertainty involved with regard to consideration. When both the conditions are tick, we will recognize revenue. Got it? This is general rule. But over a period of time, due to development in the modern way of doing business, a lot of things have changed. Now, customized orders will be taken. Products will be made on the order of the customer. When the product is made on the order of the customer, that is special order, revenue will be recognized when the goods are ready. Certain cases, sale is over when it is installed. In such case, revenue will be recognized when the product is installed at the customer's location. Certain items which are based on technology, installation is not sufficient. You need to check its functioning and technical issues just to be checked, and you need to certify that it is fit for use. In such case, revenue will be recognized when the installation is done and inspection is done at buyer's approval. Got it? If the goods are sent on return or approval basis, then the revenue should be recognized when the goods are accepted or when the time to return has lapsed, whichever is early. Revenue will not be recognized when the goods are given on return or approval basis. Revenue will be recognized when the goods are accepted by the receiver or time to return has lapsed, whichever is earlier. Then the last one is, what if the buyer requests delayed delivery? You are ready to deliver the goods, you are about to give it to him. Suddenly he says, hey, wait, deliver it to me after a week. Then what to do? Because the goods are ready for delivery and it is a customer who's asking for delay, you have to book the revenue on the day it is ready and the day you are ready to deliver, not on the day of actual delivery. Only in the case where customer has requested for delayed delivery. By this we are done with recognition of revenue on sale of goods. Next we'll discuss recognition of revenue on service. See, on service, no, whenever right to receive is established, whenever service is complete, we need to recognize revenue. But in the modern day business, what they've done is they've mixed more than one service together. Artificially it's bundled. In that case, what do? If it is single service, when that service is complete, we'll recognize revenue. When it involves more than one service along bundled, proportionately, say let's say 5 services together, the revenue is charged. 2 services are complete, 3 are pending. Against 2 services, proportionate amount will be transferred to revenue. Against the balance 3 services, even if the money is collected, it will remain as advance, it will not be treated as revenue. Did you understand? However, in certain special cases, you require client approval for saying that the service is done. If the client doesn't say yes, the service is actually not complete. In that case, we will wait for the client approval and then we will call it done and then we'll recognize revenue. Because
Right to receive is established only after. We have another case wherein subject to specific task. See, specific task when it is complete, only then the service is complete. In that case, till the time that service is completed, till the time the task is not completed, we will not recognize revenue. We have the right to receive the money only on the completion of such task. On that date when the task is complete, we will recognize the revenue. Understood? Then comes our special items, which is interest, royalty, and discount. Interest is recorded on time basis. Let's say interest is paid bi-annually, once in 6 months, on 30th of September and 31st December. We received on 31st December the interest income. Let's say on debentures. We are an investor. January, February, March, 3 months we have held the debentures. Interest will be received on 30th June. On 31st March, for these 3 months, you record accrued interest entry. That is, we have the right to receive the entry, but it will be received after 6 months. That is another 3 months from 31st March. So interest will be recognized on time basis. And how do we record royalty? On accrual basis, subject to terms of the agreement. We don't have much of royalty in CA Inter, but it will be subjected to short workings recovery allowed, we call it recouped allowed, recouped not allowed, fixed to floating, several things. So based on the contract, we will decide how much revenue to be recognized. We don't have those calculation here in CA Inter. Then dividend. Dividend, we will recognize the dividend income not when it is proposed, only when it is declared. So declaration of the dividend is the trigger for recognition of income. As an investor, I would recognize my dividend income when I have the right to receive, that is on declaration of dividend. And the last point that you should note is recognition of revenue is subject to these basic things. Also, what we need to check is there significant certainty of collection of consideration? I've given the product, I've transferred the risk, I've transferred the ownership, I've done everything, but there is significant uncertainty about collection of consideration. Then I should not recognize revenue. I should wait till the date I have significant right to significant certainty. So though everything else is done, if there is no significant certainty of collecting consideration, wait till the date of significant certainty. On that date you recognize revenue. Second possible scenario is, what if you assumed significant certainty and booked the revenue, later that uncertainty happened, now there is no certainty, then what to do? Whatever revenue what you already booked to P&L cannot be taken out, but you create provision to ensure, to say that there will be bad debts. Are you guys getting it? There are a couple of disclosure requirements. You need to tell what is your accounting policy for recognizing revenue, and if there is any change arising in accounting policy with regarding to recognizing the revenue, you also have to state that there is change in the accounting policy for recognition of revenue. Got it? And that's accounting standard 9, revenue recognition.
Let's now revise quickly accounting standard 12, government grants. This is chapter 9, unit 1 of our syllabus. When we talk about government grant, what do we mean when we say government? Government includes state government, central government agencies, local, national or international bodies also. If any trust gives you grant, if any society or club or a company gives any other person a grant, no, that is not covered under AS 12. To be calling it a government grant, it should come from government. What do we mean by grant? Grant basically refers to any assistance or any cash or kind which is given by the government to help that entity reach better heights, because the government believes that this company is doing a very good job. They're working for economical upliftment or fighting against the social evil, creating employment opportunity, having a positive impact on the economy, decreasing the country's dependency on the foreign countries or any of this. If the government believes so, then they will give them this assistance or anything. So the scope of this standard is it includes grants or assistance. Both are meaning the same from the government entities, which can be both of capital or revenue in nature. Capital in nature means the grant which is received from the government, the economic benefit is derived from the company of that grant for a period longer than a year. It is called revenue grant when the company takes the benefit of it within the same accounting period, within a short term of period. If it is the benefit of the grant received is short term, it is revenue grant. If the government is going to give the grant to you and you are going to take benefit of it for a period longer than the year, beyond a year, then it will be called as capital grant. And this will specifically exclude trading with government. If in case you sell the goods to government gives you money, or tax holiday, which we'll discuss under AS 22, or if there is any tax exemption in the form of income tax, GST, if it's given, or government contributes to the company as a shareholder, all of these are not considered as government grant. Government grant will include assistance in cash or in kind,
For the compliance, government doesn't give the grant straight away just like that. Government would require you to comply with certain conditions. That conditions might have been fulfilled in the past, or government might ask you to fulfill those conditions in the future. Certain times when you open the industry in backward area, they give land free to you. All of that past consideration. When you open hospital, if they give you consideration, grant, that is because of past compliance. Certain times in manufacturing entities, they will tell, we will give you grant provided you manufacture these many units, you create these many jobs, you import these many, you export these much of units. So they'll tell all of these kind of conditions. Those conditions can be future based conditions, and this will exclude anything which cannot be reasonably valued, or anything which cannot be distinguished from the normal trading. To be calling an item as grant, you should be able to find its value separately, and you should be able to distinguish from normal trading, meaning like buying and selling with government. Because lot of manufacturing entities, the units that they manufacture is bought by government. Just because government buys it, it can't become government grant. For the purpose of our understanding, we will come back, we'll discuss the accounting grant into two categories. One, first approach is called as the capital approach. Second one is called as the income approach. Capital approach, whatever grant is received will be taken to balance sheet, kept under reserves and surplus. Under income approach, that grant what is received will be taken to P&L account. That P&L account might be 1 year P&L, sometimes more than 1 year P&L account also, if the grant is relating to more than one accounting period. This grant which is recognized, it should be recognized only on fulfillment of two conditions. Number one, reasonable assurance. Number two, ultimate receipt. Only when you believe that you have fulfilled the conditions laid down by the government, or you have full belief that you will fulfill the conditions, and you have reasonable guarantee that the government will give you money against this. There is ultimate receipt of money. Only after fulfillment of both of these conditions, you have to recognize the receipt. I repeat, number one, there should be reasonable assurance that you will be fulfilling the conditions. Second one, there should be belief that you will eventually collect this money from the government. Only on fulfillment of both of these conditions, we will recognize the government grant in our books of accounts. Talking about types of government grant, we can categorize the grant into two categories. One, non-monetary grant. Two, monetary grant. What is non-monetary? What is monetary? Non-monetary is government giving you land free or any asset free of cost, or giving you any asset at concessional price. That is example of non-monetary grant. What is monetary grant? Government will tell, I cannot give you the asset free. You buy the asset, I will reimburse the cost that you paid for the asset. Sometimes full, sometimes partly. If the government says you don't have to pay electricity bill, I will pay electricity bill on your behalf to electricity department. That is non-monetary grant. If the government says you pay electricity bill, show me the bill, I will pay the money back to you. That is monetary grant. So if the grant is received in cash, then it is monetary. If it is not received in cash, it is non-monetary. In short, example for non-monetary grant is only one, asset received free of cost. Two, asset received at concessional cost. Monetary grant is, it is cost reimbursed by the government against a specific asset, revenue expense reimbursed by the government, or promoter's contribution made by the government. When we talk about accounting, if it is a non-monetary grant, that is asset received at concessional price, record such asset at concessional price. Let's say the cost of the asset is 1 crore. Government has given the land to you at 10 lakh rupees. Record that land what you received at 10 lakh, the price that you paid. That is concessional price. Next point that we have is, what if the asset is received free of cost? If in case you receive the asset free of cost, then there is no money paid. If you are trying to write journal entry, you don't know what value to write the journal entry at. Can you skip the journal entry? No. Because if in case you skip the journal entry, asset will not show up in the balance sheet. So to show such asset in the balance sheet, you record the asset at nominal value. You will record the asset at nominal value. I'll repeat, when the asset is received free of cost, you debit the asset account at nominal value. Credit will be given to which account? You cannot credit cash because you did not pay cash. So you will be crediting an account depending upon the fact whether the asset is depreciable asset or non-depreciable asset. If the asset that we got is a depreciable asset, credit provision for depreciation account. If the asset that you got is a non-depreciable asset, then you will not credit provision for depreciation. Instead, you will credit government grant account. You will credit which account? Government grant account. This government grant, like capital reserve, will appear in reserves and surplus. It will be staying there only till the time the asset is there. You got that? If the asset is received at a received concessional price, record the asset at concessional price. If the asset is received at free of cost, then record the asset at what value? Nominal value. And credit will be given to
provision for depreciation if it is a depreciable asset. If it is a non-depreciable asset, we will not credit provision for depreciation. We will credit government grant. I hope everyone got this. The next point to notice, once you record the asset at nominal value, there will be no further depreciation charged. You can never charge any other depreciation against that asset. If the grant received is monetary grant, like you purchased the asset by paying full 1 crore rupees from somebody, government told take 20 lakhs government grant. When the government gives grants that way, so the entity has two options. Option number one, reduced cost approach. Option number two, deferred income approach. What is reduced cost approach? Under reduced cost approach, let's say you bought the asset for 1 crore, government reimburses 20 lakhs. You have first recorded the asset at 1 crore, asset account debit to bank 1 crore, 1 crore. When the government grant is received, you reduce the 20 lakh rupees of government grant received from the cost of the asset, bringing down the cost to 80 lakhs, and further depreciation from now will be charged, keeping 80 lakh as the base and not 1 crore. This is reduced cost approach. The alternative approach is also available. That is called as deferred income approach. What do you do under deferred income approach? Under deferred income approach, if I keep the same example, an asset is purchased for rupees 1 crore, government is giving me 20 lakh as government grant. 20 lakh government grant, what the government gives me, I am not going to reduce it from the cost of the asset. Instead of reducing it from the asset side, I'll keep it on the liability side under reserves and surplus as DGG, deferred government grant 20 lakh. This DGG 20 lakh what I've kept will be amortized to P&L account over the remaining useful life of the asset in the pattern of depreciation. I repeat, first approach is where you reduce the cost of 20 lakh from the asset value of 1 crore. Asset will be valued at 80 lakh and depreciated over the remaining useful life. That is reduced cost approach. Under deferred income approach, 20 lakh government grant received will be reduced from the cost of the asset 1 crore, making the cost of the asset, asset value will be at 1 crore. 20 lakh rupees grant received will be kept it in DGG, deferred government grant account. As and when you depreciate this 1 crore, let's say over 10 years with zero scrap value, or 10 lakh every year, this 20 lakh will also be transferred to P&L account over 10 years. That is in the same pattern, 2 lakh each year. This is deferred income approach. Which one is correct? Both of them are absolutely same. It is the choice of the entity. Remember that deferred income approach should be transferred. Under deferred income approach, grant should be transferred to P&L over the remaining useful life in the ratio of depreciation. Going to non-depreciable asset. If in case you have a non-depreciable asset, you purchased some land and government gave the money back to you, then what do? Very, very simple. If the conditions has been already met, then that grant received will be returned to capital reserve. Why? You cannot reduce the cost of the asset in that case. If in case the conditions are not met, keep that money and then, if conditions are already met, you will do that. If the conditions are to be met in the future, then based on the fulfillment of conditions, you will go on recognizing that grant amount to P&L account over the period during which you will fulfill the conditions. If the conditions have been already fulfilled, entire grant received will be recorded to capital reserve. It will remain there. That capital reserve is not eligible for declaration of dividend, not eligible for bonus issue, not eligible for anything. It will stay there. It is for a specific purpose. And if the conditions are to be met in the future, as and when you fulfill the condition, that grant will be recognized to P&L. Got that? If it is against revenue expense, two options. Either reduce it from the expense or take that grant straight away to P&L account credit side as income. Last one, what if the government grant is received from the government as promoter's contribution? Meaning at the time of beginning of the business, a percentage of capital is given by the government. Percentage of project capital or percentage of budget, percentage of capital outlay. This is the language that they'll use. Such amount received should be returned to capital reserve. It will stay there only forever till the time the business is there. It will stay in capital reserve. I hope you understood. This is for receipt of government grant. For some reason, if in case you have failed to comply the conditions what you thought you will fulfill, if the government thinks that you are not eligible anymore, government can ask you to pay the grant which they had given back to government. When the government asks you to pay the government grant back, it is called refund of government grant. This refund of government grant is an extraordinary item as per accounting standard 5. You can refer AS5 revision to understand what is extraordinary item and what will be the entry for this refund. Entry for refund depends upon what was the entry that we had written in the past. In the past, if it was reduced from the cost of the asset, now we should add it back to the cost of the asset. In the past, if we had treated it as deferred income, the balance in deferred income will be reversed by paying the government back the money. Let's say we had received 20 lakh of government grant. I had reduced 20 lakh from the cost of the asset 1 crore, making it 80. That 80 is depreciated for 3-4 years. Now it is come to about 55 lakhs. Now the government is asking me to refund entire 20 lakh. Now somewhere my asset is 55. When I had received the grant, I had reduced it from the cost of the asset. Now I add this 20 lakh back to the cost of the asset, increasing it to a new amount. Alternatively, if I had followed deferred income approach, asset value would have been 1 crore. Deferred government grant would be 20 lakh. This little is transferred to P&L. If entire 20 lakh is there in DGG and I'm refunding entire 20, debit deferred government grant, credit bank entire 20 lakh over. What if little part of this deferred government grant is already transferred to PL, because of which only 15 lakh is available in deferred government grant, but I am supposed to refund 20 lakh. What would we do in that case? Deferred government grant should be debited by 15 lakh funds available. Bank account should be credited by 20 lakh. Difference of 5 lakh should be debited to P&L because from deferred government grant that 5 lakh had gone to P&L. Now we're taking it back from P&L and transferring it to refund back to government. Understood? If it was previously against a non-depreciable asset, you would have credited to capital reserve. Now debit capital reserve, credit bank and then pay. Same would be the entry in the case of promoter's contribution also. However, if it was against revenue expense, would have previously reduced the expense, now increase the expense back. Or previously, if you would have booked as expense, I'm going to say that deferred government grant, this revenue expense grant received was booked as income. Now this refund, you book it as expense. You charge it as additional expense or reverse the income, as the case may be. Whenever you follow any of the approaches, when the choice is given to you, do mention in the accounting as to what is the approach followed by the entity based on the options available and what is the nature and extent to which grant is recognized, what is the nature and extent to which grant is deferred, or why is it not recognized as income? Is it because the conditions have been not fulfilled? All such requirements have to be disclosed. These are disclosure requirements, and that's accounting standard 12.
Can we quickly revise what we've discussed so far in amalgamation? Amalgamation in practical sense is divided into several classifications like amalgamation, absorption and external reconstruction. However, for the purpose of accounting under accounting standard 14, amalgamation is classified into two categories. One is amalgamation nature of merger, two amalgamation nature of purchase. Merger purchase classification is done based on AS14. For AS14, based on AS14. AS14 gives us 5 conditions. If all of the 5 conditions are satisfied, it is merger. Even if one among 5 is not satisfied, it is purchase. Shall we quickly see what are these 5 conditions? Condition number 1 says that all the assets and liabilities of transferor company should be taken over by transferee company, and this will include reserves and surplus. After condition number 1, let's quickly see condition number 5, which is continuation of 1, which says that all assets of transferor should be taken over by transferee at book value. We cannot take it over at agreed value. However, there are exceptions. If you are changing the value of the asset for bringing in uniformity in accounting policies, then okay. Otherwise, if there is change in the value of the asset, it will become amalgamation in the nature of purchase. Got it? Then condition number 2 says that minimum 90% of the shareholders of transferor company should continue to be equity shareholders in transferee company. Exception is for the shares held by transferor directly by itself or through its subsidiaries in the transferee company. You get that? So in the transferor company. The next thing that we need to notice, how is the second condition fulfilled? The second condition is fulfilled because by issuing purchase consideration to equity shareholders of transferor company by way of equity shares in transferee company. This also has an exception. For fractional part, if in case you give cash, it's okay. For other than fractional part, if you give cash, it will turn into amalgamation nature of purchase. Then we have fourth condition, which we are not going to look into in the problems that we're solving. That is, business of the transferor company should be continued by transferee company. If all of these 5 conditions are satisfied, then in the books of transferee company, we are going to follow pooling of interest method. However, even if one among these 5 conditions is not satisfied, it will turn into amalgamation nature of purchase, and we are going to follow purchase method. Accounting standard 14 doesn't recommend any accounting for transferor company. There we follow dissolution, liquidation or realization approach as per generally accepted accounting principles. Shall we now quickly see what are the accounting entries in the books of transferee under pooling of interest method as well as purchase method. Under pooling of interest method and purchase method, remember the story. First the box is received, then the box will be unlocked, assets and liabilities will pop out, then we pay the money, then the box will be kicked, we pay the money to liquidators, then the assets which are there below will be arranged after considering DRUMS, drums. It will be drum if it is merger, it will be drums if it is purchase. Let's discuss the entries quickly. The first entry, the box is received from the liquidators. When the box is received from the liquidators, that box is called as business purchase. So we write the entry as business purchase account debit to, very good, liquidators of transferor company account. Then we will open this box. When we open this box, from this box will pop out all the assets and liabilities. So assets account debit, liabilities account credit, and will also credit business purchase account. If it is amalgamation in the nature of merger, we are going to write all the assets and liabilities including reserves and surplus at book value. And difference between debit and credit will not be written to goodwill or capital reserve, instead it will be written to reserves and surplus. However, if it is amalgamation in the nature of purchase, we will not write all assets and liabilities. We are going to write only such assets and liabilities which are taken over at agreed value, and we will never write reserves and surplus in this case. If there is difference between debit and credit, debit will be goodwill, credit will be capital reserve. Capital reserve and goodwill both will not coexist in balance sheet. We will net it off at the end. This is the difference between pooling of interest method and purchase method. So we opened the box, we've taken the assets, we've taken the liabilities, we've kicked the box. Now liquidator who got the box is waiting. Let's pay the consideration to him. When you pay the consideration to him, the entry is, we would write the entry as liquidator of transferor company account debit, and we would give them equity shares, preference shares, debentures, cash. We can issue them at premium or at discount. If there is premium, we will credit security premium. If it is discount, we will debit it. Same will be the entry whether it is amalgamation nature of merger or purchase. Both the cases it is same to same. So we paid the PC also to them. Then what should we do? DRUMS. S won't come if it is purchase, merger. What is D? Debenture. Debentures of transferor company will be taken over by us in our business purchase entry. Those debentures are no more valid. The reason being that company itself is shut down. How can the debentures be functional? So we'll cancel the debentures. We do this by debiting debentures in transferor company account debit. Credit, we can give them debentures in our company. We can give them equity shares, preference shares, cash. Whatever we give, we credit it. If there is premium, we credit. If there is discount, we debit. So entry is debentures in transferor company account debit to equity share capital to preference share capital to debenture to security premium. If there is discount on issue, debit. You get that? This is the entry. Same would be there. Whether it is merger or purchase, there would be no difference. D over, then R. Realization expenses. These realization expenses should be actually incurred by transferor. But if they don't pay, we pay it on their behalf. When we pay, usually we write expense to cash. Here we can't write expense to cash because it is not our expense. If it is merger, their reserves will become ours. We're paying it out of their reserves to them. So we write reserves and surplus to cash. However, if it is purchase, we don't take over their reserves. So what we pay to them is out of goodwill. We are not getting any benefit out of it. Or even if you get, it's not tangible. So if it is amalgamation in the nature of purchase, entry for realization expense paid will be goodwill account debit to cash. If it is amalgamation nature of merger, we write reserve account debit to cash. Understood? D over R over UMS. U, unrealized profit. Unrealized profit arises because one has sold goods to another. Transferor has sold goods to transferee, or transferee has sold goods to transferor, and these goods have been not sold to outsiders. They have retained with them. Against this, there is unrealized profit. If it is downward, as in the transferee company has sold it to transferor company, transferee has sold it to transferor, it is downward. In this case, stock will reduce, stock credit. Debit will be out of the profits of transferee. So we'll straight away write general reserve. General reserve account debit to stock. You can write P&L account general reserve or reserves and surplus, whatever is available. If it is downward, there is no difficulty. If it is upward, as in the goods has gone from transferor company to transferee company, we call it upward. Here also stock value will reduce. We credit stock. But what to debit depends upon what is the nature of amalgamation. What to debit depends upon the nature of amalgamation. If it is amalgamation in the nature of merger, then we write reserves and surplus because we've taken over their reserves. In that only profit is included. If we don't take over their reserves, that is amalgamation is in the nature of purchase, Then we'll write goodwill account debit to stock account. Such decrease in the value of the stock will be debited to goodwill. D over R over U over M, mutual indebtedness, meaning one owes the money to the other. This is because of the debtor-creditor relationship that they have between them. So whenever there is debtor-creditor relationship between them, what do we do in that case? Reduce debtors, reduce creditors, reduce bills payable, reduce bills receivable, reduce trade receivables, reduce trade payables. So liability reducing we will debit, asset reducing we will credit. Entry will be TP to TR or BP to BR or creditors to debtors. By this our debtors creditors also will reduce. Last item, statutory reserve. This entry will come only in the case of amalgamation in the nature of purchase. This is because if we say amalgamation is the nature of merger, in the initial entry all by itself we have taken our statutory reserves. So we don't have to write another separate entry to account the statutory reserves. So what is the entry that we write? Statutory reserve will be credited, debit will be given to amalgamation adjustment. We write the entry amalgamation adjustment account debit to statutory reserve. Statutory reserve we know will appear in reserves and surplus. Amalgamation adjustment will also appear as a negative item in reserves and surplus. It will also appear as negative item in reserves and surplus. At the end of the term, we will reverse the entry. We will write amalgamation adjustment will be credit, statutory reserve will be debit, and this will be reversed. So this would have to be continued for the period for which the transferor company was supposed to maintain such statutory reserve, 2 years, 3 years, or whatever. We are however going to do only one balance sheet after amalgamation, so it would not affect us much. After this, we would have to prepare balance sheet. When you prepare balance sheet, remember the old balance sheet plus these journal entries what we passed now will affect our new balance sheet. In the new balance sheet, remember to show disclosure for shares or debentures issued for non-cash consideration. That is on amalgamation. This is how the accounting is done in the books of. Now, very good. Let's see accounting in the books of transferor. In the books of transferor, it doesn't matter whether it is merger or purchase because the approach that we follow is realization approach or dissolution or liquidation approach. What do we do? First, I'll tell you the story and then we'll discuss the entries. First, we transfer the assets to realization. Then we'll transfer the liabilities to realization. Then pack the box, give this box to transferee, collect PC from them. Then if there is any assets that they have not taken over, we will sell it. If there is any liabilities not taken over, we will settle it. Then we'll identify realization expenses, record it if we have paid, pay preference shareholders by transferring preferential capital to preference shareholders, preference shareholder to whatever we're giving them. In preference shareholders to payment, if there is any difference, that would again be debited or credited realization. So far, we have not seen any question where there is difference between how much is supposed to be paid and how much is paid. Even if it comes very simple, if you know this, you do it. If you don't know it, no, don't open two separate preference shareholder, equity shareholder. Open only one account, shareholder account, transfer everything there, it will get settled. But you won't get full marks. If it is a 20 marker question, you would get 2 marks less because your realization profit will be incorrect and preference shareholder treatment is incorrect. So you would get 18 out of 20. If you know it, very good. If you don't know it, you can do this. So after that, you identify realization profit or loss, transfer to shareholder. For that transfer entry is, if it is profit, realization to shareholder. If it is loss, shareholder to realization. Then 3 items from the balance sheet are not transferred to shareholder. What are the 3 items? Share capital, reserves and surplus, accumulated losses. Share capital, reserves and surplus, accumulated losses will be transferred to shareholder. Your entry will be equity share capital debit, reserves and surplus account debit to shareholder account. Shareholder account debit to accumulated losses. Once we do this, then only thing that's left is settlement to equity shareholder. We'll write equity shareholder account debit to whatever we give them. Equity shares in transferee company, preference shares in transferee company, debentures in transferee company, can be cash also. Once this entry is passed, entire ledger should get closed. That's what we discussed. Now we'll quickly discuss the entries once again. Shall we? First, for transfer of assets, entry is realization to assets. Asset is credit, realization debit. All the assets, whether taken over or not, should be transferred to realization at. Very good. Exception, 3 items. Share capital, reserves and surplus, accumulated losses. One more item, bank. If it is taken over, it will be transferred. If it is not taken over, if it is used to pay realization expense or settle some liability, will not transfer it here. You get it? Then transfer all the liabilities to realization. For this entry is liabilities account debit to realization. Again, don't worry about the agreed value. Write this entry at book value. Debentures is one place we need to be cautious. Be little cautious. They'll give redemption premium, they'll give issue premium, color items they give, but transfer it at book value. Get it? Once these 2 items are transferred, this realization box is passed to transferee and transferee owes us money. Create transferee company account debit to realization. This will be for purchase consideration amount. After this, immediately we'll receive our PC. Whatever we receive, cash, bank, equity shares, preference shares, debentures, whatever we receive in that company, debit that and credit transferee company. So receivable from them is over, we have received this. All of this will be used to settle the liabilities not taken over or shareholders, that is equity and preference. Once this is over, we'll pay realization expense. If we pay realization expense, we'll write realization account debit to bank. If we receive it back from the transferee, we'll write bank to realization. That will be reversal. Got that? If any assets are not taken over, we will sell the assets, bank to realization. If any liabilities are not taken over, we'll settle the liabilities, realization to bank. This entry, bank to realization and realization to bank, for assets not taken over, sold, and for liabilities not taken over, settled, will be passed at the value at which we settle. Don't worry about profit or loss, it will automatically get adjusted in realization account. Once this is done, settle our equity preference shareholders account, transfer preference share capital to preference shareholder, any difference will be realization. Then pay preference shareholders debit, give them whatever needs to be given. Then close our realization account by identifying profit or loss, realization to equity shareholder or equity shareholder realization for profit or loss. Finally, last but one entry, transfer share capital and reserves to our shareholders. Right? Share capital account debit, reserves and surplus account debit to shareholders. If it is loss, shareholder account debit to accumulated losses. Then finally, payment entry, equity shareholder account debit to X% preference share, equity share, debenture, cash, bank, whatever you give. Once you pass this, everything will get closed. PC can be given under 4 methods: NATO method, lump sum method, PC method, intrinsic value. Be little cautious. You don't have to try and identify and then learn it separately. Language of the question itself will make you understand. It is not at all a problem if you fail to spot what method is it. There is no point in identifying what method is it. Till the time you are able to solve the problem correctly, it is all good. You all got this? Very good.
Let's now quickly revise Accounting Standard 21, which is Consolidated Financial Statements. First of all, why do we do consolidated financial statements? As per section 129 subsection 3 of Companies Act 2013, every company which is a holding company should mandatorily prepare consolidated financial statements, and the sections what will apply, or the provisions of Companies Act what will apply for preparation of financial statements will mutatis mutandis apply to consolidated financial statements also. Quickly, if you look into definition given under section 2 of Companies Act 2013, subsection 46 defines holding company, subsection 87 defines subsidiary company. Section 2 subsection 46 says holding company is a company which has a subsidiary company. Subsidiary company is a company in which the holding company holds more than 50% of the shares with voting rights, or a company controls its board of directors composition. In that case, the company in which more than 50% is held will become subsidiary. The company in which composition of board of directors is controlled will become subsidiary. The company which is controlling will become holding company. And they are supposed to do consolidated financial statements. Why should they do? This is supposed to help in two things. Number one, decision making. Number two, legal compliance. Decision making. Now, if you see holding company's balance sheet, in the balance sheet on the asset side, we'll have investment in subsidiary 80,000 shares. But that 80,000 shares actually gives you control of subsidiary. Instead of writing 80,000 investment, we want to write all the assets of subsidiary, all the liabilities of subsidiary. Though only 80% belongs to me. That 20% of the assets and liabilities of subsidiary, what doesn't belong to me, but I've included it into my financial statements by line addition. I'll represent that as minority interest. The interest in the subsidiary by the people who are not forming majority. The interest in the subsidiary which is held by minority people, that will be liability in my balance sheet. So I take all the assets of my subsidiary and write it in my balance sheet, and not just represent interest in investment. This is because I have control over that company and I don't just have investment in that company. And this is legally also supposed to be compliant. So the objectives are, it helps in decision making as well as in legal compliance. This consolidation need not be done in two circumstances. Number one, the control that I exercised on this company is intended to be temporary. Maybe there is a stock dip, the price of the subsidiary company shares went down. So I went on buying the shares. It was not my subsidiary. I went on buying the shares without even realizing that I became its holding company. And I don't intend to hold it for long term. My intention is not to have control over it. By mistake, I became a holding company. Then I don't have to do consolidation because I don't have intention to continue as a holding company. Second one, I hold more than 50%. I have interest in that company, but the long-term restrictions issued by government are such that I cannot exercise any control over it. I cannot transfer cash from that company to me. I can't do it. There are such restrictions. In such case, though I hold more than 50% over that company, by substance I don't have control, so I should not do consolidation. That is exclusions. And in the standalone financial statements of the holding company, you actually apply accounting standard 13 investment. However, in the consolidated financial statements only, you will apply AS 21. Whatever working notes you do in consolidation are only in consolidated financial statements. Standalone financial statements of holding and subsidiary will continue to be like how it was previously. Understood? Then what and all does the word consolidated financial statements include? It will include balance sheet, statement of profit or loss, cash flow statement, all other significant notes and accounting policies, notes and other significant statements what is required in along with financial statements. Next, there are certain items which are considered in detail in consolidated financial statements like balance sheet and P&L. I'll cover all of those items in a brief. Shall I? To start with, consolidated balance sheet, there are certain items which are to be considered in special note. Starting with share capital. Share capital of the holding company will be appearing in the consolidated balance sheet as it is. There's going to be no change. However, subsidiary company's share capital should not be written in holding company's consolidated financial statement, because it is holding company who is preparing consolidated financial statements. Subsidiary company's share capital sally share certificate may the certificate name written is subsidiary companies. How can you write subsidiary share capital in holding company share capital? You can't. What you do is subsidiary share capital should be split into how much of it is held by holding company, how much of it is held by minority. Minority is other than majority, that is people other than holding company. And this holding company share and minority companies number of shares that they hold, we need to identify a percentage as to how much percentage does the holding company have, how much percentage does the minority has. This percentage computation is important because reserve analysis is done and the reserves are distributed between holding and minority in that percentage. Later, what I would want you to know is this share capital of subsidiary which is shared to holding, whatever holding company holds, is nominal value of the investment what the holding company has made. This nominal value of the investment made by the holding company will be later compared with book value of investment. In the consolidated balance sheet, share capital of subsidiary company held by holding is liability. It will be adjusted against asset in the balance sheet of the holding company. Investment in subsidiary, they both will be compared. Book value of investment from the asset side of holding company, nominal value of investment from the liability side of subsidiary will be compared. Book value is asset and liability is nominal value. When asset is more, it will turn into goodwill. When liability is more, it will turn into capital reserve. This goodwill or capital reserve is called by another name called as cost of control. Next, this minority share in the share capital, whatever exists, will be kept aside in a table called minority interest. Later, you will assign the pre and post acquisition reserves that belong to minority. Adding them all together, we call it minority interest, which will be later transferred to our consolidated balance sheet on the liability side. Minority interest, what will appear in the balance sheet in the consolidated form, should be after shareholders fund, before non-current liabilities. You write share capital, reserves and surplus, share application money received pending allotment. After that, before you write non-current liabilities, it's a separate line item called minority interest. This minority interest is not there in Schedule 3 format. It is in a special purpose financial statement like consolidation that it will appear. One bonus and very important adjustment to remember when you're dealing with share capital of subsidiary is bonus issue. After the date of acquisition, before the date of consolidation, if the subsidiary company makes bonus issue. I'll repeat. After the date of acquisition, before the date of consolidation, if the subsidiary makes bonus issue, those bonus shares will belong to holding and minority both. Holdings share should be added to nominal value of investment. Subsidiaries minority share should be added to minority interest. Do you guys get this? Very nice. And in this case, remember, the investment book value in the asset side of the holding company will not include such bonus issue. Question number 9 from our study material, ICA study material, is on this. Then coming to reserves and surplus, the most important part. Reserves and surplus of holding company will go to consolidated balance sheet. Reserves and surplus of holding company will go to consolidated balance sheet. However, you need to be remembering couple of adjustments. First one is post acquisition dividend. If in case the subsidiary company declares any dividend, dividend. Such dividend can be classified into two ways. One, post-acquisition and pre-acquisition. If the dividend is declared out of the post-acquisition profits of subsidiary, that becomes post-acquisition dividend that should be included in holding company's reserves and surplus. However, if such dividend is pre-acquisition dividend, that should not be taken to reserves and surplus of holding. That should be deducted against the book value of investment, which is there on the asset side of the holding company, which is investment in subsidiary. That should be done, and only then it will take it to cost of control. Then second adjustment is unrealized profit. If the holding company has sold goods to subsidiary, and such goods sold by holding to subsidiary is not sold by subsidiary to outsiders. Holding has sold goods to subsidiary, subsidiary has not sold goods to outsiders. Such inventory is remaining with subsidiary. On that, holding company has booked profit. In standalone balance sheets of holding and subsidiary, no problem. In consolidated balance sheet, such profit should not be recorded. We eliminate that profit from the stock of subsidiary. We'll eliminate that profit from the profit of holding. So this is called downstream transaction. In a downstream transaction where holding has sold goods to subsidiary, subsidiary has not sold it to outsiders, and on such remaining stock, profit element booked by the holding should be eliminated by deducting its reserves and surplus. Talking about other points to remember, if there is any pre-acquisition dividend, it should be adjusted against cost, not included in reserves and surplus. Post-acquisition dividend to be included in reserves and surplus. Unrealized profit, goods sold by holding to subsidiary on downward. If remaining unsold, then profit to be reduced from reserves and surplus. Coming to subsidiaries. Subsidiaries profit will belong to both holding company and minority. So split subsidiaries profit or subsidiaries reserves, any number of reserves given into two categories, pre and post. How do we bifurcate? It is the line that we draw called as date of acquisition. As on the date of acquisition, whatever profits and reserves are there in subsidiary are pre. Whatever profits are there in the subsidiary after the date of acquisition are post. To do this, remember, if in case the acquisition is in the middle of the year, always assume that the profits are evenly spread over the period. And this, whatever is shared as pre and post, is shared between holding and minority in the percentage that we computed here. Whatever the percentage that we computed here in shareholding, in that percentage we will share the pre and post acquisition reserves between holding and minority. Now coming to important points to remember when it comes to reserves of subsidiary. First one, like I mentioned, if the acquisition is in the middle, assume the profits to be evenly spread. You can divide it based on months. Revaluation. Whenever the subsidiary's assets are revalued on the date of acquisition, then if we should check whether the revaluation is upward or downward. If the revaluation is upward, assets go up, credit is revaluation reserve, which is surplus. If the revaluation of the assets is downward, then there is deficit. Basically, revaluation reserve will be negative. Don't apply accounting standard 10 here, saying that upward revaluation is revaluation reserve, downward revaluation is P&L. No, whether it is upward or downward, it is revaluation reserve. If the assets are revalued upward, revaluation reserve credit, positive number. If the assets are revalued downward, revaluation reserve is negative. And this debit or credit, surplus or deficit, is always pre-acquisition profits. Revaluation arising on reserve arising on revaluation of assets of subsidiary is always pre, because revaluation is happening on the date of acquisition, not on date of consolidation. Date of acquisition. And continuation of this, on this revalued portion we need to compute depreciation. Previously they would have computed depreciation on pre-revaluation asset. Old value of the asset they would have computed depreciation, but depreciation should be charged on the revalued portion. When we revise this depreciation, that excess depreciation to be charged on upward revaluation, or depreciation which is excessively charged to be reversed on downward revaluation, will be always post. Will be always post. Simple trick, don't break your head. Upward revaluation portion, on that amount compute depreciation. That upward, now you did upward, no, charge the depreciation by deducting from post acquisition profits. When you do downward revaluation, you are reducing the value of the asset. Previously value of the asset would be more depreciation would have been already charged. Now that extent of decrease is there, no, on that element of decrease you compute depreciation, that you should basically add back to your post acquisition profits. Remember, revaluation always pre, depreciation on revaluation always post. Then bonus issue. Whenever the subsidiary company makes bonus issue after the date of acquisition, before the consolidation date, we know how to adjust it with share capital. But share capital will increase by decrease in reserves. That decrease in reserves should be always pre, not post. Only when the pre-acquisition reserves are completely exhausted, then we can take the post-acquisition. I hope you remember the order of reserves that should be considered. CRR, security premium, capital reserve, general reserve, then P&L. When you come to these reserves, any of the reserves when you're taking, utilize their pre-portion first before you touch the post-acquisition reserves of that. And if the accounting policies followed by the holding company and subsidiary company are different, subsidiary company's accounting policy should be changed to give the same accounting policy what the holding company is following. Whenever you do this, you need to adjust the profit up to the date of acquisition, and up to the date of acquisition, when you change that accounting policy, whatever impact on profit arising is to be adjusted with pre. After the date of acquisition till the date of consolidation, when you change that accounting policy, whatever reserve change arising should be adjusted with post. And dividend, if the dividend is given out of pre-acquisition profits, it is pre. If dividend is given out of post-acquisition profits, it is post. The question should mention. If they don't mention, we can assume it to be pre and then deduct it from the old profits. Even if the question does not specifically mention, whenever there are preference dividends, assume that the company is declaring dividend and deduct it from reserves and also make the payment. Are you getting it? That's with regard to cumulative preference shares. By this we are done with our reserve part, which is the most important part. Then comes long-term borrowings, which is debentures. If there is any long-term borrowings, which is debentures, in the holding company's books, that will straight away appear in consolidated balance sheet. No problem. However, if it is there in subsidiary, then you need to check, does any part of that subsidiary's debentures represent investment by holding? If holding company holds it, treat it exactly like share capital. Split that subsidiary's long-term borrowings into two categories: held by holding company, held by others. Others is not minority interest. Others you post it to balance sheet, consolidated balance sheet, others. However, if it is held by holding company, you need to take the nominal value of that investment, which will come from your liability side of subsidiary company's balance sheet. You compare it with the investment which is there in the holding company's asset side. You take the difference. Asset, investment, holding company's balance sheet, liability, nominal value, subsidiary's balance sheet. If the asset value is more, liability is less, goodwill. If the asset value is less, liability is more, capital reserve. This will be treated on par with our cost of control. So what is cost of control arising in share capital treatment and this long-term debenture statement together should be taken as net capital reserve or goodwill and should be posted to consolidated balance sheet. Next we have with us payables and receivables. If there is any trade payables, trade receivables, bills receivable, bills payable, if it is of holding or of subsidiary, add them together and post it to consolidated balance sheet. What should we be posting? Holding, subsidiary together into consolidated balance sheet. However, if any part of it represents holding to subsidiary or subsidiary to holding, receivable to holding, payable to subsidiary, or receivable to subsidiary, payable to holding, that should be eliminated from both holdings as well as subsidiaries, from receivable as well as payable. This is only in consolidated balance sheet, not in standalone. Important thing with regard to bills of exchange. If there is any bills of exchange between holding and subsidiary, let's say holding has given bills of exchange to subsidiary. Subsidiary has got these bills discounted or subsidiary has endorsed these bills. To the extent bills are not there with subsidiary, don't treat it as mutual indebtedness. Mutual indebtedness is whichever is less among both the companies. A limited holding company says 10,000 bills receivable from B. B limited says 8,000 bills payable to holding. Then only 8,000 will be eliminated in both the places. Those 2,000 rupees worth of bills or something which is discounted or endorsed is a liability in consolidated balance sheet. Next, with regard to PPE, I already told you PPE, holdings PPE, subsidiaries PPE, we add them together and then write. Subsidiaries PPE can be revalued on the date of acquisition. If it is upward revaluation, add. If it is downward revaluation, deduct. On that revalued portion, depreciation has to be adjusted. On that revalued portion, you should deduct depreciation. If it is upward, if it is downward, on that revalued portion, depreciation should be added back. Remember to do this depreciation adjustment from the date of acquisition till the year end. Date of acquisition need not be beginning of the year in all the cases. May 2024 examination question, date of acquisition is in the middle. So depreciation should be computed for half the year. So check that question as well. Let's go to investment. Investment in the asset side of the balance sheet of holding company. So basically, if there is any investment, holdings investment, subsidiaries investment, we add it together and then write. If the holding company's investment represents investment in subsidiary, then that investment should not appear in consolidated balance sheet. What do? That investment in shares is asset. It should be compared with nominal value of investment from subsidiary share capital. That is basically cost of control. If asset is more goodwill, if liability is more goodwill, capital reserve. Liability is nominal value of share capital from subsidiary's balance sheet. Asset is investment from holding company's balance sheet. Understood that? And in this, we'd have to remember two important things. One, whenever bonus issue is made after the date of acquisition, before the date of consolidation, such bonus number of shares should be added to nominal value of investment. And if in case there is any pre-acquisition dividend issued by subsidiary, meaning subsidiary company is declaring dividend out of pre-acquisition profits, it should be deducted from book value of investment held by holding company. And after we analyze the reserves of subsidiary into pre and post, pre-acquisition reserves of subsidiary, to the extent it belongs to holding, that element also should be further deducted from book value of investments. Then comes to inventory. Inventory will take holding and subsidiaries inventory, add them together and write in consolidated balance sheet. If there is some inventory sold by holding to subsidiary or vice versa, and that inventory is remaining unsold in that company, buying company, then on that stock, unrealized profit margin has to be eliminated from the reserves of the selling company from the inventory of the buying company. Goods sold by holding to subsidiary or vice versa and not sold to outsiders represents unrealized profit on that inventory to the portion left multiplied by profit percentage. Such profit should be eliminated from the reserves of selling company, inventory of buying company. By this we are done with entire thing with regard to balance sheet. Couple of things to notice: always check whenever if the receivable by one company and payable to the other company is not matching, you should remember there might be some error. We need to do reconciliation and rectification. Might have done one question where the interest payable by one company is receivable by the other had not recorded it. We first reconcile, rectify the error and then do consolidation. And in order to do consolidation, dates should match. Standalone balance sheet of subsidiary, standalone balance sheet of holding, dates should match. If the dates don't match, then update subsidiary's balance sheet till the date of holding and then do consolidation. Then minority interest. Like I mentioned, minority interest represents minority share in reserves, minority share in both pre-reserves, post-reserves, along with the share capital. Stitch them all together, it is minority interest. Write them in the consolidated balance sheet on the liability side. After share capital, reserves and surplus and share application money received pending allotment, before non-current liabilities. Even if the accumulated losses is more and share of minority will become more than its share capital, in that case minority interest cannot become negative. I'll repeat, if the minority share in the losses, pre-acquisition reserves and post-acquisition reserves together, if it becomes more than the share capital of minority, it can become negative, but it should not be shown in balance sheet. Such loss will be borne by holding company. Now we'll head into consolidated profit and loss statement. Consolidated profit and loss statement, we need to take revenue as well as purchases, revenue from operations, purchase of stock in trade, everything of holding and subsidiary, put them together and then write. However, if the sale of holding is purchase of subsidiary or vice versa, such an entire transaction amount of total sale value as well as purchase value should be eliminated from the sales of the selling company and purchases of the buying company. It can be either ways, full transaction amount. Then in this case, after this you need to know other income. See, holding company can charge subsidiary company management fee. One of them can pay commission to another. There can be interest payment. There can be dividend payment. All of this. So these items should be eliminated. Other than this, holdings expense, subsidiaries expense. Holdings income, subsidiaries income. We should write them together. Special points is usually watch out for management fee charged by holding to subsidiary. To holding company it will be other income. To subsidiary it will be administration expense. In the consolidated balance sheet, eliminated from administration expense, eliminate it from other income. Then commission. If there is any commission paid by holding to subsidiary or subsidiary to holding, eliminate it from other income and other expense. Sometimes commission paid will be included in selling and distribution expense of the paying company. Please eliminate it from there. That will become simple. Tax expense. Don't touch anything. Tax of subsidiary, tax of holding, put them together, put it in consolidated PL. Got that? Appropriations. If in case there are any appropriations such like dividend, transfer to reserve, all these items, this is actually not part of consolidated PL. Unfortunately, in some questions that we do, this is given. Remember, dividend given by subsidiary, to the extent it belongs to holding company, should not be written as an appropriation. It should be eliminated from other income of the holding company and payment of dividend from subsidiary company. If it is pre-acquisition, it would be eliminated from the cost of investment of subsidiary holding company, and here you eliminate only the payment part. It will not be included in other income. Let me repeat, if the subsidiary has paid dividend, check whether the dividend is pre or post. If it is post acquisition, it would be included in other income of holding, eliminated there in the income side. Either ways, in the payment, in the appropriation side, eliminate the holding share in the dividend. Only dividend paid by subsidiary to other than holding should be written in that appropriation. Finally, we need to write minority share in that statement of profit or loss of the profits of subsidiary. Don't take consolidated profit multiplied by minority percentage, because minority is interested in profits of subsidiary alone, not of holding and subsidiary together. And we should not take the percentage of profit of subsidiary after making all these adjustments. Take standalone profit and loss of subsidiary. In that standalone profit and loss of subsidiary, before making any adjustments for this consolidation, before eliminating any intercompany transactions, whatever is the profit, on that profit, minority share will be multiplied. That has to be deducted from the appropriation. And if that standalone P&L is given, good. If not, in certain questions, you might have to prepare that standalone P&L to determine minority share in the reserves or profits of subsidiary. Once you deduct that, whatever remains at the bottom of your consolidated PL is a reserves, which is revenue reserves to be transferred to holding company's consolidated balance sheet. I hope you understood.
Let's now quickly revise Accounting Standard 23, which deals with investment in associate. It's better off reading this standard after you finish Accounting Standard 21, Consolidated Financial Statements. The objective of this standard is it will tell what are the principles and what is the procedure to be followed by an investor if it wants to consolidate its associates' results and associates' financial position into its P&L and balance sheet. You are called as an investor when you have significant influence on another entity, meaning you have an associate whose operating and financial decisions are influenced by you. How can you say that you have influence on them? You hold 20% or more shares in that company, or you can influence the board in that company. So, enterprise in which the investor has significant influence and which is neither a subsidiary nor a joint venture. If you hold 50% and somebody else holds 15%, it becomes joint venture. If you hold more than 50%, it becomes subsidiary, but you have 20% or more, up to 50%, then it becomes your associate. This associates standalone P&L and balance sheet when you prepare, 23 is not applicable. When you prepare your standalone P&L, 23 is not applicable. But if you want to include associates' financial position and performance, P&L and balance sheet, into investors' position and performance, balance sheet and P&L, then AS 23 is applicable. Like I mentioned, standalone financial statements of investor as well as associates, AS 23 not applicable, applicable only in the process of consolidation, and applicable for consolidating associates result into the results of the investor. Significant influence means having the power to participate in financial or operating policy decision making of the investee, but you should not have control over them. You should only have significant influence over them. Control means you can directly or indirectly take decisions in that company because you have more than 50% of the voting rights, or you hold the control over the composition of the board of directors in that company. Subsidiary is the company which is controlled by the holding. Parent is the company which is holding the subsidiary. Group is parent, subsidiary, associate, everyone together. Consolidated financial statements is financial statements prepared for the entire group as a single enterprise. In Accounting Standard 23, investment in associate, we follow the approach or method called as equity method. What is the method that we follow? Equity method. What do we do under the equity method? Under equity method, for the control that you have, for the influence that you have on your associate, we will not show the cost of investment. In the investor's balance sheet, in the process of consolidation, for the investment in associate, we will not write cost of investment as one line item. Cost of investment needs to be split into two. One, percentage of net assets that you get in the associate. If you get more than that, then add goodwill. If you get less than that, then you should deduct capital risk. So this is the bifurcation that you should be showing in that specific investment. How do we do that? We take all the assets of the associate, all the liabilities of the associate, take the total of assets and deduct the liabilities. That is called net assets of the associate. So we take assets of the associate minus the liabilities of the associate. That is nothing but equity plus reserves. This will be multiplied with the percentage that you hold in that company. That becomes the percentage of net assets. If this percentage of net assets is not equal to the investments that you make, then there is goodwill or capital reserve. If the investment that you made is more than the net assets, that excess that you paid is goodwill. If the investment's book value that you have is lesser than the percentage of net assets, you made profit, capital reserve. In the consolidated financial statements prepared by investor, you will not write cost of investments. You will write percentage of net assets in the associate that you get plus goodwill, or percentage of net assets minus capital reserve. I'll repeat, you will not show the investment in the balance sheet which is prepared in the consolidated form as cost of investments. Cost of investment should be shown as a split, which is percentage of net assets plus goodwill, percentage of net assets minus capital reserve. When we do this, we get the investment in associate. From now, keep the mindset that of a partnership firm. To a partner's capital, you will add the profits earned after the capital is received, deduct the drawings. Same way, to the cost of investment of the investor, after investing in the associate and making it your associate, whatever post-acquisition profits are earned by the associate will be added to this cost of investment. And from this, we deduct the dividend, if any, which is received from the associate. Remember, this dividend is post-acquisition dividend. If it is pre-acquisition dividend, such dividend should be deducted from the cost of investments here. And then we will do this add profit and less dividend. I hope you people get that. So basically, cost of investments in the consolidated financial statements prepared by investor will not be shown as cost of investments one line item. I will write percentage of net assets plus goodwill minus capital reserve. To this, I'll add the post-acquisition profit and deduct the dividend to identify the carrying amount. And in this process, at any point of time, if this post-acquisition profits, what I'm adding becomes loss, it will be deducted. If the loss is so huge that the entire carrying amount of the investment, if it is eventually becoming zero, don't write it as negative, write it as zero. If the loss post-acquisition is overshooting the cost of investments, making the carrying amount negative, don't show that as a negative amount, show it as a zero value in the consolidated balance sheets prepared by the investor, including the results of an associate. Got that? So one short revision of everything. In the case of associates investment, as investment in associate to be recorded by the investor, we should not be following some random method. We have to follow equity method. Under equity method, what is it that we do? The investment in the associate should not be shown as investment in associate. It should be split as to how much is the percentage of net assets and how much is other than that. Net assets is formed as assets minus liabilities or equity plus reserves multiplied by percentage that we hold. When we do that, we get net assets. If this net assets, whatever we get, this has to be compared with cost of investment. If the investment made is more, amount money paid is more than the cost of net assets, excess we paid is goodwill. If the investment money book value is less and net assets itself is more, that will be capital reserve. In the consolidated balance sheet prepared by investor, including associates return, we should show percentage of net assets plus goodwill minus capital reserve to arrive at the cost of investment in associate. To this, post-acquisition profits will be added and post-acquisition dividend will be deducted. If it is pre-acquisition dividend, it will be deducted from the cost of investments before computing goodwill or capital reserve. And if at any point of time post-acquisition reserves becomes negative, because of which from the cost of investment less loss will make it negative as carrying amount. Don't show carrying amount at negative place, show carrying amount at max at 0. And this is accounting standard 23. The most cutest standard in our syllabus, accounting standard 27, which deals with investment in joint venture. So under this method we do consolidation, but the consolidation here is proportionate consolidation. And joint control or joint venture starts when you don't have control over the entity alone. There is somebody else also has control over it. So you have slightly more than significant influence, but you are not the only one who has control. So then it becomes a joint venture. For instance, I hold 50% and you hold 50%. Together we hold 50-50. I don't have alone control and I can't call it influence. I have more than influence, but I have slightly lesser than unanimous control. That becomes joint control. In this case, how do I consolidate the joint ventures assets and liabilities into my consolidated balance sheet? That is what we'll learn in accounting standard 27. This case may will divide the particulars into three categories. 1. Jointly controlled operations. 2. Jointly controlled assets. 3. Jointly controlled entities. Let's start with jointly controlled entities. I am A Limited, you are B Limited. Together we form a new company called C Limited. In C Limited, I hold 50%, you hold 50%. That C Limited is jointly controlled entity. The assets and liabilities of jointly controlled entity C along with its share capital will be proportionately divided between A and B. Line by line, each item 50% will be added to each other's assets, liabilities and capital. That is jointly controlled entity. Jointly controlled asset is there is no separate entity created. I am A, you are B. We together buy one asset. That asset is registered in both of our name together. I get to use that asset for some days. You get to use that asset for some days. Whatever repair expenditure, maintenance expenditure, insurance expenditure, depreciation which is there on that asset, we will share it. All of this will happen at one agreed ratio. And that asset, that expense, that depreciation, everything will be proportionately divided between both the joint venturers, co-venturers, and it will be written in their P&L and balance sheet. Then comes jointly controlled operations. It is an arrangement between two or more venturers who combine to bring in their operations, resources, and expertise. For example, for construction of a building, I will put land, you will put building material, someone else put labors, all three of us together will build the building. And in that building, we'll divide the number of flats that each of us gets. That is this jointly controlled entity. Sorry, jointly controlled operations. In that jointly controlled operations, I will not include the joint ventures transactions in my books. I will record my transactions in my books. You will record your transactions in your books. If you make any payment to joint venture, you will write it as receivable from joint venture. And at the end, in the joint venture, we write all the expenses, all the incomes. There is no going concern. Determine profit or loss. That profit will be shared to all the co-venturers. I'll record that profit receivable. There is no separate entity actually. So whatever receivable I have from the joint venture is from the other co-venturer. If I have a receivable, to the same extent you will have payable. If there are three co-venturers, if one has receivable, then other two together will have same amount as payable. Can be in different ratio. Depends upon what they've got to the table. Depends upon what they've taken from the table. Very simple standard. So far there hasn't been a question on this standard ever in your CA intermediate. But remember to practice those 3-4 questions what is there in the study material. Too easy to do. And that's accounting standard 27 joint venture. Let's now quickly revise the topic of buyback of securities. Buyback of securities is opposite of issue of shares. In the event of issue of shares, shareholders give money and company will give the share following the blue line. Buyback is opposite. Shareholder will give the share back to the company and company will give the money. Why does a company go for buyback? Very simple. To increase its earnings per share, because the numerator being earnings available to equity shareholders, denominator being number of shares, we compute earnings per share. In order to compute earnings per share, either you would have to increase the numerator or decrease the denominator. By decreasing the denominator, by buying back the number of shares outstanding in the market will be less. By this, the earnings per share available will become more. And to avoid the hostile takeover where someone is acquiring the shares of your company to take over control of your company. Or in order to increase the promoter holding to take a major decision where the directors want to take the decision but shareholders are not in the favor of it. In such a case where the shareholders might not vote for such decision, promoters want to increase their holding and then go for buyback of share. And if in case the company's share price is dipping way below where it should be, And if company believes the true value of the share is much higher than that, company will support the price of the share by offering buyback. And as we've discussed in the past, buyback price per share will be much higher than the market price prevailing in the market on that date. And lastly, if in case the company has no option or no better strategy or no better project to invest the money in, it will let the shareholders realize their gain by whoever wants to sell the share. Let them give it back to the company, and company will offer them a price. That is to liquidate their shareholding that they have in the company. And this is regulated by provisions of Companies Act. The base to provisions of buyback is section 67. It says that shares cannot be bought back by company. However, it is allowed under three provisions. Section 55, which talks about redemption of preference shares, is now shifted to foundation, and reduction of capital, which turn in internal reconstruction. And what we're discussing in this chapter is buyback of shares. So buyback of shares is actually not allowed as per section 67. However, if a company wants to buy back shares, it has to follow the rules given under section 68 of Companies Act 2013. Section 68 of Companies Act 2013 says that BB is allowed, but in order to do BB, there should be one approval. We'll discuss the provisions first and then come back to that. So the provision goes like this. If in case a company has to go for buyback of shares, there should be authorization in the articles of association. Only then it has to go for buyback. If there is no authorization in the articles of association, company would have to pass a special resolution to amend its articles of association. Then it will go for buyback. And though there is power in articles of association, in order to do buyback, in order to execute buyback, it has to pass a resolution. Is that resolution board or special resolution? Depends upon the percentage of buyback. If the company is buying back 10% or less percentage of shares, then the company can just do it by passing board resolution in the board meeting. However, if the company is buying back more than 10% up to 25% of shares, then it needs a special resolution in the general meeting of the company. However, if the company intends to buy back more than 25% of the shares, it has to override Companies Act, which is illegal, which is not possible. So basically, a company cannot buy back shares beyond 25%. In order to buy back a share, the share should be fully paid up. A partly paid up share cannot be bought back. Then, doesn't look. In order to buy back a share, company share should be fully paid up. And in order to go for buyback, company has to fulfill certain conditions. These conditions are called as DRS test, debt equity ratio test, resource test, and share outstanding test. Debt equity ratio test says that the maximum amount that the company can buy back is to ensure that the debt equity ratio does not become bad than 2:1. After the buyback, equity will reduce. Such reduced equity, if you do into 2, so much of debt should be there, and you cannot have debt more than that. So debt has to be maximum 2 times equity after buyback, or equity has to be minimum half of the debt after buyback. This is the first condition. Debt equity ratio test cannot be more bad than 2:1. Debt cannot be more than 2 times equity after buyback. Second test is resource test. It says that maximum amount of money what we can use for buyback cannot exceed 25% of PUC plus free reserves plus security premium. The Companies Act only says free reserves, but whenever they say free reserves in buyback context, will include security premium also in the context of equity. Then the last test is share outstanding test. Share outstanding test says that the maximum number of shares that can be bought back is number of shares outstanding multiplied by 25. You can't exceed this. This entire buyback has to be completed within a period of 1 year. So this is how we'll remember the entire thing. So whenever the company wants to do buyback, the sources of funds can come from only 3 places. SPF, security premium account, proceeds from fresh issue, or free reserves. Compiling that together, this is the chart. So BB, in order to happen, you need to apply sunscreen, which is SPF. So SPF, sources of funds, security premium, proceeds of fresh issue, and free reserves. Cannot take from other than this place. And in order to get married, they ensure that there is no child marriage. The share should be fully paid up. Then you should take approval. If the age gap between the bride and the groom is less than 10, close family people say yes, sufficient. Board resolution is sufficient. If the age gap is more than 10 years, oh my God, what will 4 people tell? Everyone should accept. Everyone should be eagerly waiting for that wedding. Only then it's allowed. So you take special resolution if the percentage of buyback is more than 10. If it is more than 25 years of age gap, no. It will become a public nuisance. Don't get married. So more than 25% share buyback is not allowed. And whenever you are taking such a big decision, no, review the decision like MS Dhoni does. DRS, debt equity ratio test, resource test, share outstanding test.
Debt can be maximum 2 times equity after buyback. Resources used for buyback, security premium, paid up capital plus free reserves plus security premium cannot exceed 25%. And share outstanding, number of shares bought back cannot exceed 25%. How to do this test is a very tricky part. There are questions in ICS study material where they will tell how many shares we should buy back. And then those many shares will write simple journal entry. Writing journal entries is very simple. Share capital is decreasing. Same thing if you want to read it in the form of section, I've given it here in the chart. You can read it later. So I'll come back to CRR also slightly. We'll finish this journal entry part. Yeah. Whenever we're buying back the share capital is decreasing, so we'll debit share capital. And cash has to be decreased. So cash will be created. Journal entry is share capital debit to cash. However, we'll route it through a dummy account called as shares bought back account. My journal entry will be equity share capital account debit to bank, which will be routed through dummy account called shares bought back, which is credited here, which is later debited. So journal entries will become equity share capital to shares bought back to bank. If in case we pay slightly more than nominal value, that amount is debited to premium on buyback. This will be adjusted against security premium if available. If security premium is exhausted and we paid much more than that as premium, we can adjust that against free reserves, general reserve and P&L account also. So we write the journal entry equity share capital account debit, premium on buyback account debit to shares bought back account debit to bank or cash account. Then premium on buyback, whatever was debited, will be adjusted against security premium first, then with free reserves. So the entry is security premium account debit, free reserves account debit to premium on buyback account. Ultimately, after you do this, till section 67 should be there haunting you that capital of a company cannot reduce. The only and only way by which the capital of a company can reduce is by way of capital reduction, which is approved under the scheme of court. That is only capital reduction, internal reconstruction. Other than by that way, capital cannot reduce. When you do buyback, share capital account here is debited, because of which our capital is reducing, which cannot happen. So what do we do? To the extent of which our share capital is reducing, we create capital reduction reserve. What is capital reduction reserve and why do we create it? This is to comply with provisions of section 69 subsection 1 of Companies Act 2013. Section 69 subsection 1 of Companies Act 2013 says that capital cannot reduce other than by way of capital reduction, approved under the scheme of the court under internal reconstruction. By way of redemption of preference shares or by way of buyback of equity shares, what we're discussing in this case, if the share capital reduces to the extent of nominal value of share capital reducing by way of buyback or redemption, we create CRR. From where do we create CRR? Taking the money from free reserves. Free reserves are general reserve and P&L account. We debit general reserve, we debit P&L account and credit CRR to the extent of nominal value of preference shares redeemed or equity shares bought back. What can we use this CRR for? CRR can be used only and only for the purpose of bonus issue. When we do bonus issue, as you already know, the share capital will increase back to the same. Now, this question might come in your mind. Sir, should we create CRR in all the cases when we're doing buyback? Answer is no. You don't have to create CRR when you are buying back equity shares and in order to source the finance, you are not taking the money from free reserves, but you're taking the money from fresh issue. That fresh issue cannot be equity shares. It has to be a different class of shares, like preference shares. Let's say you are buying back equity shares and in order to buy back equity shares, you issued preference shares. 1 lakh of equity shares is bought back. 1 lakh of preference shares is issued. So 1 lakh preference share capital, equity share capital decrease, 1 lakh preference share capital increase. On the whole, share capital is not decreasing. In this case, you don't have to create CR. However, let's say your equity share capital bought back is 1 lakh. For this purpose, you are issuing preference shares only to the extent of 20,000. So equity share capital decrease 1 lakh, preference share capital increase 20. There is still decrease of 80,000 in capital. So we have to issue shares to the extent of 80,000. So how do we remember this in the exam? Very simple. Write the journal entries for buyback. Write the journal entries for issue of shares. Write the journal entries for sale of investments or whatever. After rating everything, before you identify CRR, see the journal entries. Wherever you written capital credit, that means capital is increasing. Wherever you written capital debit, that is capital is increasing. Take the net difference. To the extent capital has decreased, you create CRR. If equity share capital is debited by 1 lakh and preference share capital is credited by 20, that means equity share capital is decreasing by 1 lakh. and preference share capital is increasing by 20. Net difference is 80. 80,000 you take it from general reserve and P&L account and then create CRR. I'll get back to what I was telling. The questions are very simple and easy. If they tell how many shares are to be bought back, we'll write it this very simple way. For that amount, we pass the journal entry. Questions become interesting where they won't tell how many shares to buy back. They will ask us find out as to how many shares should we buy back. They'll tell we want to do maximum buyback possible. Please help us with this and tell us how much is the maximum buyback that we can do. If in case they offer us buyback and they don't tell how many shares can we buy back, in this case, ICA study material answers are a little complicated. They take X, they take Y, they solve simultaneous linear equation. Oh my God, it becomes way too complicated. Simplified way of this is, I told you this, after buyback, equity will decrease. The decreased equity should be minimum half of debt. Or after the decrease in equity, debt cannot exceed 2 times. So 2:1 is the ratio. Am I right? So do it the very simple way. What is the maximum possible shares that we can buy back? Equity is PUC plus free reserves plus security premium. PUC plus free reserves plus security premium. In excess of 50% of debt can be bought back. In excess of 50% of debt can be bought back. So PUC plus free reserves plus security premium minus 50% of debt. Divide this by nominal value plus buyback price. Nominal value plus buyback price, because in buyback price there is nominal value and security premium. Nominal value and security premium in buyback price. Nominal value will decrease share capital, security premium will decrease security premium. Buyback premium will reduce security premium. Why do we add nominal value again to denominator? Because to the extent of shares bought back, we'll create CRR. When we create CRR, free reserves will decrease, CRR will get created. That CRR which is newly created is not part of equity. Equity is PUC plus free reserve plus security premium. There is no place for CRR in this. So what do we do? Very simple. In order to find maximum permissible buyback, complying debt equity condition, do PUC plus free reserves plus security premium minus 50% of debt divided by buyback price plus nominal value per share, you will get the maximum possible number of shares. No X, no Y, no simultaneous linear equation. I've explained the logic. If you want, you listen to it again. If you don't understand the logic, vomit this formula, you will get the answer right. It will save a lot of time. I bet it will save a lot of time. Trust me on this. Second one, resource test. Resource test is very simple. Take paid up capital, free reserve, and security premium. Add all three. Multiply it by 25%. If you multiply by 25%, whatever you get, that is the maximum resource which can be utilized. If you divide that by buyback price per share, you will get the maximum number of shares that can be bought back. I'll repeat, you will take paid up capital plus free reserves plus security premium, multiply that by 25%. That is the maximum resource that can be utilized for buyback. You divide that by buyback price per share, will get the maximum number of shares that can be bought back. Last and final test, share outstanding test. Easiest of all. Number of shares which are there multiplied by 25%, you will get maximum shares that you can buy back. Take whichever is least among these three and that is allowed for buyback. Don't forget to check the cash available. Even though all the three tests will allow you to buy back certain number of shares, check whether do you have sufficient cash to do this buyback. And that will help us identify the number of shares that can be bought back, which is an examiner's favorite question of late. And by this, we have completed the entire discussion of buyback. I hope it was helpful. I hope you people understood what's the buyback. Cool. Let's now quickly revise the topic of internal reconstruction, which is chapter 14 of your syllabus. A company will go through internal reconstruction when it is on the verge of being liquidated. The assets are overvalued, the payments are due, the liabilities are not paid on time, expenses have also been not been paid, creditors have stopped supplying the goods, debtors have stopped paying the money, and the company has huge accumulated losses and net worth is also negative. Only option in front of the company is liquidation. In that point of time, if they want to revive themselves, the option that's available is internal reconstruction. Like I mentioned, the situation has huge accumulated losses, overvalued assets, overdue payments, unsettled liabilities. The process is they will reconstruct themselves by revaluing the assets, bringing them to the most realistic value, restating the liabilities by actually negotiating with the debenture holders, creditors, and people to whom they owe money. They will negotiate and ask them to decrease the liability to the extent possible. and we'll reorganize the capital. We'll reduce the capital if possible, subdivide the shares or consolidate the shares, convert them to stock, whatever is best possible. We are basically doing a major surgery inside to revive the company's balance sheet and make it look much cleaner with assets at presentable value, that is reduced value, liabilities at settlable value, write off the liabilities to the extent possible. And in this process, we take one big bandli with us or big bucket with us wherever we go to pick. That is called capital reduction. Ma, please give something. Shareholders will put something, and then asset we whatever that we accumulate, no, debentures will put something, creditors will put something. That pegged fund, credit, whatever is there, will be used to write off the overvalued assets, accumulated losses, and if there is still something left, that will be capital profit, capital reserve. And this entire process is very closely monitored by three important sections of Companies Act. Section 48, which talks about variation of rights. Section 61, which talks about alteration of share capital. Section 66, which talks about reduction of share capital. Variation of rights, to start with, talks about changing the rights of the shareholder without changing the share capital. For example, the best example or the most logical and practically done example in the class is changing the dividend rate of preference shareholders. There are preference shareholders to whom you have not paid 3 years of dividend, arrears of preference dividend 10%, but you don't have money to pay. What do? You request them, Anna, please write off that 3 years of arrears of preference dividend. Why? If that dividend outstanding goes on for longer, your business is affected. That's a liability in the balance sheet. You'll ask them to write off. But we need to give them something, no? We'll tell, from now I'll make more profit, I'll give it to you. So I will change your 10% preference share capital to 15% preference share capital. Meaning you will now have 15% dividend. I'll convert your normal preference shares to convertible preference shares if you want. I'll convert your preference shares to cumulative or participating preference shares. I'm variating the rights which is there with those shareholders, and that's variation of rights. And this is done in order to strike a deal in reorganizing the capital. This is what Companies Act section 48 talks about. There is reorganization with regard to voting rights also. With regard to a shareholder, you can give them extra voting right, or we can reduce the voting rate of a specific shareholder. But that's not a transaction. For that, there would be no journal entry. But the journal entry what we pass for variation of rights under section 48 is preference shareholders dividend rate being changed. The next section of Companies Act what we need to learn about is section 61 of Companies Act. Here again, there is no reduction in share capital. There is no decrease in share capital. Share capital will remain the same, but we are altering the share capital. What are we doing? Very good. Alteration of share capital can be done under 4 types. Number 1, subdivision. Number 2, consolidation. Number 3, conversion of shares into stock. Number 4, conversion of stock into shares. We'll discuss one at a time. To begin with, subdivision, which is also called as splitting. Under splitting, we split one share of higher value or higher denomination into shares of lower denomination. Let's say we have one share of rupees 100. The company wants to divide one share of 100 into 10 shares of rupees 10. It's like 100 rupees note being exchanged for 10 notes of 10 rupees. Do you guys get this? So this is called subdivision or splitting of share. Share of a higher denomination is divided into more number of shares of smaller denomination. This the company does so that it will help them in reorganizing later. They can opt for share surrender later or any of that thing. So this is what we mean when we say subdivision or splitting. Remember, in this there is no decrease in share capital. The company had 1000 shares of 10 each, 10,000 rupees. Now it is converting it into 10,000 shares, 1000 shares of 10 each, 10,000. It is dividing it into 1 share into 10 if they divide. It will become how much? 10,000 shares of rupees 1 each, 10,000. 1000 shares of 10 each, 10,000 is now divided. 1000 shares. Each share is divided into 10 shares. It will become 10,000 shares of rupees 1 each, 10,000. Share capital before subdivision 10,000. Share capital after subdivision 10,000. Number of shares before subdivision 1000. Number of shares after subdivision 10,000. Nominal value per share before subdivision 10. Nominal value after subdivision 1. So number of shares will become more. Nominal value per share will become less. Multiply ಮಾಡಿದ್ರೆ product amount will remain same. That is subdivision. Next, we have consolidation. This is opposite of subdivision. In subdivision, one share will become many small shares. In consolidation, many small shares will become one share. Let's say the company has 1000 shares of 10 each, coming to 10,000. Company will convert those 1000 shares of 10 each, 10,000 to, let's say, 10,000 shares of rupees 1 each. Sorry, one share of rupees 10,000 each. Are you getting it? So number of shares will be merged together to make one. So let's say 10 shares will become one share. There are 10 shares of rupees 10 each. Company will convert 10 shares of rupees 10 each into one share of rupees 100 each. That is consolidation. Company might want to eliminate small shareholders who doesn't want to be taking risk. They want lesser number of people on the board to take a very risky decision. So in that case, company can go to consolidation. Again, in this case, pre-consolidation, post-consolidation, share capital amount remains same. Just that pre-consolidation number of shares were many. Post-consolidation number of shares will become less. Pre-consolidation per share value was small. Post-consolidation number of shares value will, per share value will become more. Multiplicand, whatever you get product amount, that will stay same. Next one is conversion of shares into stock. Whenever we talk about share capital, it will have fraction and denomination. Meaning 10,000 shares of rupees 10 each. 10 each is denomination. 10,000 shares is fraction. So 10,000 shares into 10, 1 lakh. The company wants only 1 lakh. It doesn't want that fraction of 10,000 shares. It doesn't want the denomination of rupees 10. So it will convert 10,000 shares of rupees 10 each, rupees 1 lakh share capital into share stock of 1 lakh. There is no number of shares, there is no denomination. This is conversion of shares into stock. The company, when it has not decided what way to subdivide or what way to consolidate, it has not taken the decision, but it want to freeze the trade in the market, it will convert shares into stock. Later it can decide what denomination it wants, what fraction it wants. Then it can convert the stock to shares. Stock is rupees 1 lakh. There is no number of shares, there is no per unit value. Then they can later decide 1 lakh rupees to be divided into 10,000 shares of 10 each, or 1,000 shares of 100 each, or 10 shares of 10,000 each. That's up to them. That is conversion of stock into shares. And during this entire process, like I mentioned, the share capital will remain same. It will not reduce. In alteration as well as variation in rights, the share capital doesn't change. And to do this, company must have power in articles of association, and it should also pass an ordinary resolution in its general meeting. And the last section of Companies Act 2013 relevant for our internal reconstruction is section 66. This section comes because as per the provisions of the act, the company's capital should never reduce. That is the reason we create CRR whenever we do buyback or redemption of preference shares. In this chapter, we are reducing the capital. It should be within the purview of Companies Act 2013. So section 66 says that reduction can happen in two ways. There is more than two ways, but they are not practical, very theoretical, and practically also not viable. Exam also it's not there. So we'll do only two. Number one, reduction only in paid up value. Number two, reduction in nominal value as well as paid up value. What do you mean by reduction only in paid up value? The company has shares of rupees 10 each. They are going to reduce shares of rupees 10 each fully paid up to shares of rupees 10 each, rupees 8 paid up. So nominal value of the share remains 10. Paid up value is reduced from 10 to 8. This is reduction only in paid up value. When they do this, journal entry will be share capital debit to capital reduction 2 rupees. We'll write the entry only for reduction. Why does the company do this? Later, when the company wants cash, company can make that partly paid up share fully paid up by making the share call and collecting cash from the shareholder. However, the company can choose to reduce not just the paid up value but also nominal value. Why would the company do this? The company would do this to reduce the or free up the capital within the authorized limits so that it can give shares to somebody. Even if a 10 rupee share fully paid up has been reduced from 10 rupee share fully paid up to 10 rupee share rupees 8 paid up, authorized capital limit is met andre they cannot make further issue of shares to debenture holder or creditor for settling liability. In this case, what the company does is shares of rupees 10 each fully paid up will be reduced to shares of rupees 8 each fully paid up. Here we are not just reducing the paid up value, We are reducing the nominal value also. The beauty of this case is that 2 rupees need not be called from the same shareholder. We can issue a fresh share to another person for cash or to settle a liability. This is what we mean when we say reduction in nominal value as well as paid up value. Instead of going for reduction or alteration, company has an option to go for share surrender. Share surrender is a case where you go to the existing shareholder and ask him to give some shares to the company, donate. A shareholder has 10 shares, you will ask him, please give 2 shares of yours. When you take 2 shares from that shareholder, share capital is decreasing. Debit share capital account, credit share surrender. Share surrender is a dummy account, and these shares surrendered will stay there. They can be kept in the equity form in which you took the surrender, or you can convert them to preference shares. If you do conversion of the surrendered equity shares to preference shares, there will be no journal entry. Later, you can use this share surrendered to settle. You can give this to debenture holders. You can give this to creditors. Let's say I have some shares surrendered from my equity shareholders. I wrote the entry equity share capital to share surrendered. After this, I am asking my creditors to be taking these surrendered shares and settle their liability. When I settle, debit your creditors account because it is decreasing. Don't credit share surrendered or equity share capital. Credit capital reduction and close that creditors account. I repeat, share surrendered entry, share capital to share surrendered. When the creditors are settled by share surrendered, write the entry creditors account debit to capital reduction. Close the creditors account, and out of the share surrender you will give shares to creditors. There the entry will be ulta of what you wrote when you got the share surrendered. When you got the share surrendered, share capital to share surrender. When you issue these to somebody, share surrendered to share capital. That credit share capital can be equity or preference. Understood? So when surrendered shares are given against liability, that liability should be first transferred to capital reduction, and share surrender entry share capital to share surrender, issuing from that surrender entry share surrender to share capital. If there is any balance in share surrender account at the end, let's say you took surrender of 10,000 rupees worth shares, you issued only 8,000. 2,000 balance in share surrender should be closed by transfer to capital reduction account. And throughout any profit, any loss, any expense, any income, any change in the value of asset, any change in the value of liability, settlement difference, everything will be routed not to P&L but to one account called capital reduction account. And in the capital reduction account, whatever balance is there after all of this and after transferring share surrender also will be utilized to bring the assets to realistic value. If the asset is overvalued, we will write off that overvalued portion to bring it down using capital reduction. We use this to write off accumulated losses, P&L debit balance, preliminary expenses, share issue expenses, or any other expenses which is there which is not written off. We'll use it to write off. After all of this, if still some part of capital reduction is pending, it will be transferred to capital reserve. We can use this to write off intangible assets which don't exist anymore. Patents, goodwill was there when the company is good. Now the company is not good, it's not required. No, we can write off overvalued assets, intangible assets, accumulated losses, and excess will be transferred to capital reserve. And once you do all of this and then prepare the balance sheet, in the balance sheet for the next 5 years, whenever you prepare balance sheet, in the name you should write unreduced as on followed by the year date, just to make the user understand that this company has gone through the process of reconstruction. However, court can tell you don't have to write, but whenever you seek the permission of the court usually asks you to include these statements. Understood? That's internal reconstruction.
Come on, guys. Let's now discuss chapter 15 of your syllabus, which is branch accounting. One of your favorite topics, which has hardcore accounting to it. Let's begin. So, in this topic of branch accounting, to do accounting, we divide the branch into 2 categories. One, branch which is situated within the geographical boundaries of the country. That's called as inland or domestic branch. The branch which is outside the geographical boundaries of our country, which we call as foreign branch. We'll discuss foreign branch towards the later part of our discussion. Right now, our focus will be concentrated inland or domestic branch. Further, inland or domestic branches will be classified into 2 categories: dependent and independent. Dependency is in the business world seen slightly different from the accounting. In the business world, it is based on the operative and financial decision making. The branches depend on the head office for goods, The branch is dependent on the head office for money, decision making, sale price fixation, hiring employees, location of business. Then it is dependent branch in business world. But in this topic, we are only focusing on accounting. In this topic, we decide a branch as dependent branch if the branch does not have accounting, and accounting of the branch should be done by head office. Then it is dependent branch. On the other hand, if the branch has an accountant, the branch can do its accounting on its own. The branch will not be called as dependent branch. It will be called as independent branch. Right now, our discussion is now focused to dependent branch. Later, we'll come back to independent branch. Further, for the purpose of accounting, this dependent branch can be classified. This classification now this time is based on the rate at which head office will choose to send the goods to branch. If the head office decides to send the goods to branch at cost price or invoice price, treating the branch like a debtor, it will be treated as accounting to be done under one of the three methods: debtors, stock debtors, and final accounts. However, if the head office treats itself as a wholesaler and treats the branch as a retailer and sends the goods to branch by booking the wholesale profit, then we'll apply another method called as wholesale price method. Now we'll focus on these three methods: debtors, stock debtors, and irrespective of the fact whether you use debtors method, stock debtors method, or final accounts method, end up getting the same profit as others. To begin with, let's see debtors method. Under this method, head office will treat the branch as a debtor, and branch owes money to head office. Head office in its books will open one ledger which is like debtor, but it will be called as branch account. That branch will be one separate ledger for every branch. Let's say I have 4 branches: Chennai branch, Hyderabad branch, Mumbai branch, Pune branch. I will open one ledger for each of them. Chennai branch account, Mumbai branch account, Pune branch account, Hyderabad branch account. We'll open 4 separate branch ledgers. Each branch account, debit side I'll write the opening balance of assets in the branch. It can be stock, it can be furniture, it can be any other asset, cash balance, bank balance, debtors, everything that's there at the branch as an asset is mine, and I'm supposed to receive it from the branch. So in my branch account, I would write all the opening balance of assets on the debit side. All the closing balance of the same assets will be written on the credit side. See, branch asset, branch debtor, branch cash, branch petty cash, branch stock, all of them. If in case at the branch there is some liability, opening balance on the credit, closing balance on the next, whatever I send to branch will be written on the debit side. Whatever the branch sends to me will be written on the credit side. Then if I find the balancing figure, that would be my branch. And in this process, throughout the accounting when it is done, head office is treating branch as a debtor. If you send something to branch, value at the branch will increase, debit the branch. If you receive something from the branch, value at the branch will decrease, credit the branch. Basically, branch is your debtor. That's what I did mention. And next thing that you would have to have is assets, debit side, opening balance, closing balance, credit side, liabilities, opening debit balance, credit balance, closing debit side. And there are certain transactions which are ignored. If the transaction is happening between branch and third party, head office will not do accounting. This is because accounting is done for the branch but by the head office. Accounting is done for the branch but it is done by the head office. This is debtors method. I can discuss journal entries, but I'll keep it pending for now. What will I do? I'll teach you stock debtor system and we'll see debtors and stock debtor system journal entries simultaneously. Flip to stock debtor system. Under stock debtor system, what we do is we'll treat the branch as a debtor, but there is a small upgrade. This method is improvised version of debtors method. Under debtors method, like I mentioned in the ledger, we write opening balance of assets on the debit, closing balance of assets on the credit. In that opening balance of assets, it is not asset but assets. There are several items: debtor, stock, furniture, cash, petty cash, so many things. Now for each of them, we'll start opening separate ledger. That improvisation will shift it from debtor to stock. We'll cut that one big branch account into 4-5 ledgers. That will become stock debtor. Under debtor system, I told you certain transaction which involves branch and somebody else. We used to not write entry. Here we write entry for. Let's see the transactions and the entries for them. To begin with, if the goods are sent to branch, under debtors method, the journal entry is branch account debit to goods sent to. However, under stock debtor system, it will not be branch, it will be branch stock account debit to goods sent. Later, this goods sent to branch will be deducted from the purchases of head office. So the entry is GSB to purchase. That's the follow through. Then, if the expense is incurred at the branch, it can be paid by head office or it can be paid by branch. If the expense which is incurred at the head office, if the expense which is incurred at the branch is paid by head office will write the entry branch to cash under debtor system. If it is stock debtor system, we will not write branch, we will write more specific name. We will write branch expense account debit to, and later this branch expense should be transferred to branch P&L. The end. I'll teach you the entry for that. If in case the same branch expense is not paid by head office, but it is paid by branch, under debtor system will not write any entry because this transaction affected between branch and third party. However, if the expense of the branch is paid by branch and we are maintaining stock debtor system, we do write entry. Here we don't write because the entry will be branch to branch, but here it is not branch. Branch expense account debit to branch cash. We don't write entry for this under debtor system because under debtor system, one ledger what we open, that ledger itself as expense account, that ledger itself as cash account. So it will be reflecting both debit and credit aspect in the same ledger. So we ignore it under debtor system. Under stock debtor, that one ledger is cut into 4-5 ledgers. So expense is debited in expense ledger, cash is credited in a different ledger. So we can do write a journal entry. Next, if the goods are sold at the branch, it can be credit sales or cash sales. Under debtor system, for both cash sales as well as credit sales, there would be no journal entry because this transaction is affected between branch and third party. However, if it is stock debtor system, we usually write journal entry for credit sales, debtors to sales. Here we will not write debtor to sales, we will write branch debtor to branch stock. Sales account is not maintained, we call it branch stock. If in case it is cash sales, our usual journal entry is cash to sales. Here we will not write cash to sales. We will replace cash with branch cash and sales with branch stock. That would be the accounting entry. Sale of goods, not cash and credit, for which actually there is no entry under debtor system. Next, in case we are doing collection of cash from debtor, under debtor system there is no entry. Why? Cash is also there within branch account, debtors is also there within branch account. So two items, debit credit, are in the same ledger. However, when you do stock debtor, it's broken into several ledgers. Usual entry for collection is cash to debtors. It will be branch cash to branch debtors. Next, what if there is bad debts or discount alone? Again, under debtor system, there is no transaction, no journal entry because it is transaction affected between branch and third party. Or if you have to write that bad debts or discount is identified as profit or loss impactful item in branch, debtors is also there in the same ledger. So you don't have to write it separately. If you write opening and closing balance of debtors, closing balance after deducting cash collected, bad debts, discount, automatically the difference will impact our profit. However, under stock debtor system, we do have to write an entry. We can write it as branch expense account debit to branch debtors. Usually we write bad debts to debtors. Bad debt is replaced with branch expense and you can credit branch. As a shortcut, instead of writing branch expense, you can straight away post it to branch PL. That will save your effort in opening one ledger. Next, we have with us goods returned by branch. Whatever goods we had sent to branch, branch is returning it back to us. We will reverse the entry what we had passed here. Here we wrote the entry branch to GSB or branch stock to GSB when the goods were sent. When the goods were returned, we will reverse it and write GSB to branch or GSB to branch stock. Next is goods sent by one branch to another branch. When the goods are sent by one branch to another branch, it should be treated like goods are sent by branch to head office and head office to another branch. Same entry for GSB return. If you see GSB to branch, GSB to branch, GSB to branch stock, GSB to branch stock. Next we have with us branch remits cash to head office. Branch is giving cash to head office. Head office is receiving cash. Head office will write cash account debit to. Under stock debtor system, we will not credit branch, we will credit branch cash. The cash is paid directly by debtors or outsiders to head office for the sales made by branch. Then it will be same entry like what we wrote before. Cash to branch under debtor system. Under stock debtor system, we write cash account debit, but it is not reducing branch cash, it is in fact reducing cash. Credit will be given to branch debtors. Next we have with us goods sent to branch but not reached branch yet. The goods are sent to branch. Head office has written the entry goods sent to branch to branch to goods sent to branch is sent. But that branch cannot sell the goods, branch cannot keep the stock in its closing. So we would have to write it in an account called Gita. goods in transit account debit to branch. In branch ledger, we'll write on the credit side, Gita. And in stock debtor system, it is not Gita to branch, goods in transit to branch. It should be written as goods in transit to branch stock account. Next, we have with the same thing can happen with cash. Cash is sent by head office, not received by branch. In the branch debtors account, it will be written as Sita to branch. Or you can write Sita to branch cash. And normal loss, abnormal loss, usually there is no entry under debtor system. Under stock debtor system, we just have to still write the entry. It will be debited to branch adjustment where we usually remove load, credit branch stock because stock is decreasing. However, if it is abnormal loss, then we'll write branch adjustment account to the extent of load, branch P&L account to the extent of cost, and total invoice price will be credited to branch. And then we have insurance claim. If in case on this abnormal loss, if you have insurance claim, and if insurance claim is received by branch, head office will write no. In this case, we can still write cash account debit to branch P&L, branch cash to branch P&L. If head office receives it, it will write cash to branch under debtor system. Under stock debtors, it will write head office cash to branch P&L. Understood? Ultimately, all of this is done to determine profit. Once we find profit, that profit will be transferred from branch P&L to head office P&L under debtor system. Head office P&L will be credited, branch P&L will be debited. And one thing that you would notice in stock debtor system, to identify profit, close every ledger, close debtors, close cash, close expense, close petty cash. In this, if there is any balancing figure missing, find that number and then close it. After you close all the expense ledgers and then post it to branch PL, then you close branch PL to determine the profit. Hope you guys got this. And another thing that you should note in branch debtors and branch stock debtors system is, what if the goods are sent by head office to branch, not at cost, but at invoice price? In your debtors, opening balance of stock will be on the debit, should be there in the branch stock account at cost. It is there at invoice price. On the credit side, we should remove load. See, branch stock in the debtors account be there at cost. It is at invoice price, we remove load on the credit side using the name stock reserve. In the credit side, closing stock should be at cost. If it is at invoice price, we remove the load on the debit side using the word stock. Exactly similar to this, if in case our branch goods sent by head office, if it is at invoice price, still goods sent to branch, if it is at invoice price, load is removed on the credit. And similarly, on the goods sent to branch return, if there is invoice price, load is removed on the debit side with the same thing. Opening stock, closing stock, goods sent to branch return in the debtors ledger should be at cost. If it is at invoice price, remove the load on opposite side. On opening stock, load removal on credit side. On closing stock, load removal on debit side. And GSB, load removal on credit side. GSB return, load removal on debit. Opening and closing stock, load is removed by the name stock reserve. On GSB and GSB return, load is removed by the name same name. This is under debtor system. Under stock debtor system, if you have to remove load, something what we do is very easy and simple. Whatever the item is there in branch stock account, if it is at a higher price, for example, opening stock, load will not be removed in the branch stock account credit side. We'll write it in branch adjustment account credit. In the stock account, closing stock is at invoice price. Load is removed on the debit side, not of branch stock, but in branch adjustment account. CSB in branch stock account, if it is there at invoice price, then on this the load will be removed on the credit side, but not in branch stock, but in branch adjustment. Goods sent to branch return, what is there in the credit side of your branch stock account will be removed on the debit side, but not of branch stock, but in branch adjustment account. This load on goods. Load will not be removed on sales. Load will be removed only on opening, closing, goods sent to branch and goods sent to branch. By doing this, you will be done with your debtors and stock debtors method. Then comes the third method, which is called final accounts. This is our traditional approach, preparing trading account and P&L account. Usually what do we do? Trading account, opening stock, purchases, sales, closing stock, GP. GP you bring to P&L account, expenses, income, GP, MP. Same thing we'll do in branch. But in the trading account, stock items like opening stock, purchases, closing stock should be always at cost price. Sir, what if we've sent the goods at invoice price? Something very simple. Remove load. Right? Opening stock, inner column invoice price, minus load, outer column cost. Purchases won't be there. Goods sent to branch will be there. Goods sent to branch at invoice price, less load, outer column, cost price. Closing stock at invoice price, inner column, minus load, outer column, cost. Find GP, bring it to P&L. That's it. That's how you do problems under stock data system, as well as final account. Let's proceed on to the next method, that is wholesale price method. Wholesale price method is followed when the head office will treat itself as wholesaler, it will treat branch as a retailer. Head office will transfer the goods to branch at wholesale price, branch will sell the goods to customers at retail price. This is similar to invoice price, but it has its differences. Head office, usually if the cost was 100 and if it was sold to end customer at 150 by the branch, head office used to book 50 rupees profit through the branch. Cost 100, branch sold it for 150, branch will book 50 rupees profit. Head office used to book branch profit in its P&L account. But under wholesale price method, it is different. Head office will tell my cost 100. If any other retailer comes, I'll sell it to him at 130. He will sell it to customer at 150. It will treat branch as a retailer, head office as a wholesaler. Head office on every unit sent to branch, head office will record 130 rupees sale price, booking 30 rupees profit. Later when the branch sells the goods to customer at 150, branch will book 20 rupees profit. So same 50 rupees profit under debtor system, stock debtor system, final account system. Branch used to book full 50 profit and that was later transferred to head office. Under wholesale price method, head office books 30 rupees profit, sending the goods of 100 to the branch at 130 wholesale price. When the branch sells that 130 rupees goods to customer at 150, branch will book 20 rupees. Later the 20 will come back to head office, but 20 will come to P&L of head office. 30 will be there in trading account of head office. That is wholesale price method. Under wholesale price method, head office sends the goods at wholesale price to branch, branch sells the goods at retail price to customer. Cost plus wholesale margin or load is what we call as wholesale. This wholesale margin is profit booked by head office. Wholesale price plus retail margin is retail selling price. This retail price is the profit booked by branch, which is anyways later transferred to head office. And because as I am head office and I have sent goods to you at 130, if you sell it, you book 20, I book 30, no problem. If head office has sent the goods to branch at 130, branch has not sold that goods and it is remaining in closing inventory, it will be there at 130. So head office has booked 30 rupees profits on goods sent to branch. The branch has not sold. Like how we do in amalgamation and consolidation, we can call it unrealized profit. On the closing stock remaining in the branch, profit which is already booked by head office should be reversed. Unlike debtor, stock debtor, final account system, where we remove load on opening, GSB, closing, everything. Here we remove load only on closing. Closing stock is there in the branch account on the credit side at wholesale price. On that load will be removed on debit side, not in branch account. Head office P&L account. Why? Head office has booked profit no on that sale. I recorded that 130 rupees as sale and I booked 30 rupees profit in my P&L. It has come to my trading to my P&L, it's come, but you have not sold that goods. So to you cost is 130, but you are ultimately extended part of my business. I should reverse that 30 rupees profit. So 30 rupees, that is unrealized profit on the stock lying unsold at the branch, will be written on the debit side in P&L account of head office. That, my friends, is wholesale price. The ledger will look somewhat like this. We'll prepare a proper trading account. Opening stock should be at wholesale price, goods sent to branch at wholesale price, and then we'll write goods sent to branch returned at wholesale price, sales at selling price, closing stock and abnormal loss at wholesale. We'll determine profit. This GP what you get, it is not total profit. It is not 100 and 150. It is 130 wholesale price and 150 retail price. 20 rupees profit at the branch. And we'll write branch expenses and then transfer. And whatever here closing stock is remaining at the branch, on this stock, load will be removed in head office P&L. And on the opening stock, previous year's closing it was, the load would have been removed last year, that will come in credit side in head office P&L. Remember, in head office P&L, on the opening stock, load will come on the credit, on the closing stock, load will come on the debit. Previous year's unrealized profit is realized this year, current year is unrealized profit is postponed to next year. In P&L account of head office, previous year's unrealized profit, opening stock's unrealized profit is booked as profit. On the current year closing stock, will reduce the profit by debiting it, postponing it to next year. That's our wholesale price method. And in the next video, we'll see how to revise quickly with regard to your independent branch updation, that is abridged consolidation, detailed consolidation along with foreign. Welcome back to quick revision on branch accounting. This is part 2, and in this part we'll be discussing independent branch and foreign branch. If in case you have not seen part 1, you can go back and watch part 1. The link is also there in the description of this video, and once you finish that, you can come back to part 2. Just to give you a heads up, the branch can be divided into two categories, that is inland branch and foreign branch. We have covered inland branch. It is dependent in the first part. Further, that inland branch can be divided into dependent and independent. Dependent branch can be accounted under debtors, stock debtors, final accounts method or wholesale price method, and this complete thing what you see here is covered in part. Now in this video what we'll be discussing is we'll be revising independent branch accounting in the books of the branch, by the branch, and updation and consolidation, detailed and abridged. Further, we'll also revise foreign branch. Let's get started. Let's begin with independent branch. Under dependent branch, accounting of the branch is maintained by the head office. Accounting for the transactions made by the branch recorded from head office perspective. Whereas in this case, accounting is done for the transaction of the branch from the perspective of the branch. Accountant is sitting in the branch and it has accounting. Two parts has to be learned. First part, how to do accounting. Next part, how to consolidate this into head office. To consolidate, you have two methods, abridged and detailed. But to begin with, let's discuss how to account for transactions in the branch. Let's begin with. So whenever we're doing transactions at the branch, we need to see what is the corresponding transaction entry in the head office entries, head office books also. For the goods sent by head office to the branch, head office should record the entry branch account debit to goods sent to branch. Same entry what we discussed in the past. In the branch, we have to record goods from head office account debit to head office account. Throughout, in head office books, we'll have branch account. In branch books, we'll have head office account. In the head office, if you have debited branch, in the branch, you would have credited head office. At the end of the year, head office account balance in branch books, branch account balance in head office books should match. If they don't, something is wrong. We need to rectify and reconcile. Only then we'll do consolidate. Next transaction. The goods are purchased by the branch, not from head office. Directly, it is purchased from somebody. Payment can be made by branch. Payment can be paid by head office. The payment is made by branch. Goods are purchased by branch. Head office will write no entry. The payment is made by head office. Then head office will, if the payment is made by branch only, branch will write the entry purchase account debit to cash. Just normal entry. Independent books, normal entry. What if the goods are purchased by branch? Payment is made by head office. Very simple. Branch will write purchase account debit and it will inform the head office to credit cash. And in the head office books, we will debit branch. In the branch books, we will credit. Because it is like branch has received money from head office. So branch owes money to head office. It will credit head office. Head office has paid money to branch. Is supposed to recover that money from branch. So head office will debit branch. Got it? What if expenses of the branch are paid by the branch? Head office will write no entry. Branch will write expense to cash. What if the expenses of the branch are paid by head office? In that case, head office will write cash account credit. Branch will write expense account debit. Branch has debited expense. Head office has credited cash. In branch, credit is missing. In head office, debit is missing. So head office will debit branch. Branch will credit head office. Branch will credit head office because branch owes money to head office. Head office will debit branch because head office is supposed to receive money from. Next, what if the goods are sold at branch? Head office writes no entry because branch has to pass. If it is cash sales, cash to sales. If it is credit sales, debtors to sales. If you have collected money through check, you can write bank to sales also. Entries in the books of branch are very independent, just like any other separate entity. If the goods are sold to branch, sold by the branch to the debtors on credit, and the money is collected by the branch. Basically, money is collected by the from the debtors by the branch. There will be no entry in the books of head. Branch will write the entry cash to debtor. However, if the goods are sold by branch to the customers, and these credit customers, debtors, they paid money to head office straight away, then what will happen? Head office has received money. Head office will debit cash. branch debtors have decreased, branch will credit data. So cash account is debited in head office books, debtors account is credited in branch books. There is missing debit in branch books, which will be head office. There is missing credit in head office books. That head office has collected money on behalf of branch. Branch is supposed to recover that money. So you debit head office account in branch. Branch has basically, head office has collected the money on behalf of branch. So head office will credit branch account. But this, it's like they have collected money from the branch. Branch as an asset will redeem. What if the goods are returned by branch to head office? Goods are returned by the branch to head office. So then you will reverse the entry that you had previously passed. In the books of head office, the entry is goods sent to branch to branch. In the books of branch, the entry is head office account debit to goods from head office. See this? The goods were sent, your entry was branch to goods sent to branch. Now we'll write goods sent to branch. Previously it was goods from head office to head office. I will write head office to goods from. Going further, assets are maintained at branch. The branch can say I am incompetent to maintain asset entries. I don't know. You maintain asset. When I say maintain assets, no, head office is maintaining asset ledger, not the asset. Asset is installed at the branch. Asset is used by the branch. But ledger account of asset is maintained by head office. In that case, what would be entries? If the asset is purchased and the amount is paid by branch, the asset is purchased and the amount is paid by branch. Who's maintaining the asset? Branch only. In this case, who's maintaining the asset? Branch. So branch will write the entry asset to cash. The office will write no entry. What if, begin with the heading again, asset is maintained by branch, asset is purchased, but the payment is made by head office. Then branch will write asset account debit. Head office will write cash account. In branch, credit is missing. In head office, debit is missing. Head office will debit branch because head office has paid money to branch. Branch will credit head office because branch has collected cash from head office. And depreciation entry will not be passed by head office. Entry will be passed by branch. Branch will write the entry depreciation account to asset. Depreciation because it's an expense. Asset account credit because it is for asset. This is the entry. The assets are maintained by branch. If in case the assets are maintained by head office, then wherever asset is there, the debit credit should be done by head office. Asset is maintained by whom? Head office. And the asset is purchased, payment is made by branch. If the payment is made by branch, branch will credit cash account. Head office will debit branch account, asset account. Asset account debit is recorded by head office, cash account credit is recorded by branch. So in the missing debit, we'll write head office in branch, missing credit will be branch in. What if the asset is maintained by head office, asset is purchased and payment is made by head office? The payment is made by head office. Then what do we do? Branch will write no entry. Why? It did not make the payment. It is not maintaining the asset ledger. Asset ledger is maintained by head office will debit branch. Payment is made by head office will credit cash. Got it? But who's using the asset? Branch. Where is the asset situated? Branch. If there is depreciation on this, that expense has to be debited in branch books to find the correct profit. But asset credit branch cannot. Why? Asset ledger is maintained by head office. So head office will write branch asset. Got it? The missing credit in branch books is head office. The missing debit in head office books is branch. Ultimately, the amount will be remitted by branch to head office. Head office receives cash. If the head office is receiving cash, cash to branch. If the head office is paying cash, branch to cash. And the opposite entry will be passed in the books of branch. Similar to this, there was one question in the recent examination. Again, I have shared it with you people. You can check in the description. You can try that question. So far, the questions in the examination on branch have been pretty simple. Short 4-marker and 6-marker question. In the old syllabus, they used to be pretty lengthy. Now let's discuss updation or what we call as consolidation. Branch has maintained its records independently. These records have to be now brought into head office books and then merged with head office books. How to merge them? There are two methods of consolidation. One, abridged consolidation. Two, detailed consolidation. One, abridged. Two, detailed. What is the difference? The detail in the difference lies with the accountant who's there at the branch. I'll tell you theoretically as well as practically. Now, practically what happens is, in the case of the branch, if the accountant at the branch is smart enough to prepare trial balance,
ledger, journal entries will be passed. He'll prepare ledgers and he'll prepare trial balance. And the accountant at the branch doesn't know how to go further. So what will he do? He'll dispatch the trial balance to head office. Head office prepares accounting. That is called as detailed consolidation. Head office has to detailedly take item by item from trial balance, add it into their trial. However, branch accountant is slightly smart and the branch manager wants to know the profit at the branch. Not from head office, but he wants to hear it from the branch manager. So in that case, branch manager after trial balance goes one step forward and he'll prepare final accounts of the branch at the branch. Once the final accounts of the branch is prepared at the branch will send final accounts to head office. Head office does not take trial balance to update or consolidate. Head office will take final accounts of the branch and update it into the head office record. That is abridged. Here we are not taking detailed trial balance, we are taking abridged. Final accounts is summary, trial balance is detailed. Detailed line by line item will take from trial balance. Detailed. I'll take balance sheet and P&L and then abridged. The difference. Everything that's there in trial balance will be added to head office for corresponding item. Every asset will have debit balance. Credit that asset, debit head office. And later you take it to respective. Every liability will have credit balance. Debit that liability, credit head office account. This is the entry in branch books. And in head office books, it will receive asset, debit the asset, credit the branch. For asset received. For liability received, credit the liability, debit the branch. And repeat, for every asset transferred by the branch to head office under detailed consolidation, branch will write the entry asset credit, debit head office. Asset transferred to head office. Head office will write asset received, asset account debit to branch. For liability transferred, branch will write the entry liability debit to head office. Head office will write the entry branch account debit to liability. For each asset and each liability. Same is done for expense and income. Expense will be usually having debit balance. Branch will credit the expense, debit head office. Head office will debit the expense, credit branch. And incomes, sorry, this is detailed consolidation. And incomes will be usually having credit. Branch will debit the income, credit head office. Head office will debit the branch, credit the income. That way you transferred each expense, each income, each asset, each liability into your trial balance. Then you will prepare balance sheet, trading account, P&L account for both head office and branch. This is detailed. In the case of abridged, head office doesn't take each asset, liability, expense, income. It will straight away take the profit of the branch and then include it. It will take trading account items and then include it. It will take P&L account items and then include it. That is abridged consolidation method. By this, we are done with consolidation. Now it is. I have given in detail the entries in abridged and detail. Next up, we have with us foreign branch. But I have done a little bit of this reference in accounting standard 11 as well, pretty much the same. Foreign operations is the name under accounting standard 11. So the operations of foreign branch can be categorized into two. One, integral, two, non-integral. Integral is extension of the head office operations is there in foreign. Non-integral is branch is treated as a separate entity. Does this matter? It definitely does. Based on the fact whether it is integral or non-integral, we will do accounting. If it is integral operations, we will try to translate opening stock at actual rate. Actual opening stock rate. If not available, we'll take transact. We'll take the opening rate. Closing stock will be tried to be translated at actual rate of the stock, the date it was purchased. If not available, we'll get closing. If it was non-integral, opening stock opening rate, closing stock closing rate. So what is this rate? Trial balance of the foreign branch will be in foreign currency. The trial balance which is there in the foreign currency should be converted into home currency. Only then you can draft final. So the trial balance of the branch which is there in the foreign currency, how do we convert it into home currency? We should apply exchange rate. What exchange rate to apply? That depends upon the fact whether it is integral operation or non-integral. Integral, for opening stock, try actual, if not available, opening rate. For closing stock, try actual, if not available, opening rate. For non-integral, opening rate, closing rate. Got that? And goods sent to branch, we will not apply any rate to transfer. Why? Goods sent to branch is there in the foreign branch account in foreign currency. But Indian head office account, we know the Indian rupee value of it. Write that Indian rupee value. Actual value of the goods sent by head office is available in head office books. Write the same value.
Don't try to write the branch value which is in dollars or some foreign currency. Then with regard to revenue items, that is expenses and incomes, these are there throughout the year. We cannot apply actual rates, so we'll write average. We'll write average both in case of integral as well as non-integral. And monetary items and non-monetary. What do you mean by monetary items? Items which can be expressed in fixed and determinable amounts of money. For example, cash, debtors, creditors, loan, borrowing are all monetary items. What are non-monetary? Fixed assets, investments, inventory, all of these are non-monetary. So if it is monetary item, under integral operation as well as non-integral operation, we will record it at closing rate. However, if it is non-monetary item, under integral operations, we will write it at original rate, that's the transaction date rate. If it is non-integral, we will write it at closing rate. And then we have head office balance in branch account, branch balance in head office account. This will be recorded at the actual value. If I am head office and you are foreign branch, in your branch of records, my name is there. In my books, your name is there. In my books, your value is there in Indian rupees. In your books, my value is there in foreign currency. I don't want your foreign currency value. I have Indian rupee value, that will be recorded. But before you take that, if there are any errors, we need to rectify. Finally, when you draft this trial balance of the foreign branch, is there in foreign currency, when you convert it into home currency, the new trial balance in the home currency will not tally. Why? We did not multiply everything with same rate. Different amounts we multiplied with different rates. The trial balance won't tally. If it is integral operation, such difference in trial balance will be posted to P&L account of head office. P&L account of head office, remember. If in case it is non-integral branch, such difference in trial balance will not be posted to P&L. It will be kept in a reserve called FCTR, Foreign Currency Translation Reserve. Foreign Currency Translation Reserve. This foreign currency translation reserve will be maintained in head office books till the time the branch is there. Next year, difference also will be adjusted against it. At the end, when we close the branch, like we are closing this video, that FCTR will go to general reserve if there is some balance. I hope this was helpful when it comes to branch accounting. As a bonus, I have added some 3 questions, one on debtors, one on stock debtors, one on final accounts, as well as on foreign branch. One of these questions, if you can do, you will be done with foreign branch as well as every aspect of branch. Please do check the description for that video. And I hope this entire revision of branch accounting was helpful.